my super smart buy sell indicator. This strategy is my own private strategy. I've spent months of energy building it. It's a scalping trading strategy for day trading forex, crypto, options, stocks, whatever you need to do. And it's a live trading strategy. I brought you the best trading view indicators that will give you the best entries. And this, again, the strategy is used in forex, crypto, stocks, options, everything. It's very useful for scalping, trading, and swing trading. This strategy is a combination of divergence, price action, and a bunch of other things. I also did a bunch of live trading with this strategy just to prove to you that it's the best kind of strategy. Here we go. Now, of course, I'm not going to give you that sort of thing because that sort of thing doesn't exist. But before you go, hear me out. I do have two strategies that will allow you to always profit in the stock market. But first, let me explain why that sort of thing doesn't exist. So to have a 95% or better, 99, 98% win rate, you need to have an incredibly high draw on your losses. Because basically what you end up doing is scalping little bits every now and then. And then your losses end up being, whenever you're not able to get that, you end up topped out and you end up drawing all the way down until you're like, all right, I gotta abandon this. And if you're trying to get that little bit, 95% of the time, it's usually built in take quite big drawdowns if you're just trying to take a little bit. So sometimes, yeah, you get that little bit right away. Sometimes it goes like this. But sometimes it's just going to go like this. It's never going to come back. And that's when you're going to take your massive losses. And to win 95% of the time or better, 98, 99, there's no all winner. I mean, you can get above 99, you can get 99 point change, whatever it is. But to get that high, you're going to have to take massive losses, very seldomly. Oh, there's ways around this with your risk management and other things like that, but that gets incredibly complex. It's not as simple as an indicator. You just throw in the chart and you take every trade. It becomes an entire combination of your strategy, your technical analysis, which comes into your risk management and your gambling strategy, which is basically your risk management is your risk to reward ratios on your trades, and then your gambling strategy is your sizing. Am I going to size up here, size down? How much relative to my total pool am I going to put the work on each trade? That sort of stuff. So it's three different components usually that all come together to make a strategy. So you really can't just throw up a bunch of indicators and expect to make tons of money. It just doesn't happen. If it did, if that was possible, then whoever thought it up would quickly, within weeks, months, maybe even days, depending on how aggressively they wanted to put this to work on all sorts of markets and stuff, quickly become the richest person on earth. And since the person who made this video, which I'm making fun of kind of here, got 250,000 views in a couple of days, but it's already been a month, and they are probably not flashing videos of them driving to their diamond-plated mansion in their golden Lamborghini on top of their giant pile of unobtainium ore with their king of the world crown. So I don't think they've actually found that sort of thing. But again, I do have two ways for you to always profit in the stock market. And I'm going to tell them to you now. First of all, I'm the auger. I'm a stock trader and options dealer. So that makes me uniquely qualified to talk about the first option, which is to be a dealer in the marketplace. So dealer strategy in the marketplace is actually more about your risk management and your gambling strategy than any sort of technical analysis or anything like that. The way dealer strategy works is the same way you would function as a bookie or a casino in real life. In a lot of ways, you're operating as a merchant in the marketplace, for instance. So in a more traditional market, like say an agricultural market, there's two parties: the people who grow food and the people who eat food, and there's space in the middle. Now, literally in that market, it's distance usually. And there has to be someone or some party, if it's not going to be the farmers or the people there, like if they're not right next to each other, that takes the food from the farmers to the people who want it. And they usually charge profit in some form like that. So their opportunity is distance. In the marketplace, stock dealers, option dealers also operate between two parties over a distance. We have people who want to buy stocks to hold them for a long time for their retirement, and we have people who want to sell stocks in their retirement. And then there's also additions to these groups that are caused by distance. And that distance is all about one emotion. And it's the same emotion, but people call it two different things. It's just the same thing reflected in different ways. But that's fear and greed. Now, fear and greed creates distance in the stock market because it creates imbalances in how many people want to buy and how many people want to sell. So when people are afraid, there's a lot of sellers, not a lot of buyers. So there's a distance to take from those extra sellers to buyers eventually, if that makes sense. So without getting into further detail there, how do you always make money in the stock market doing this? Well, if I'm a merchant in real life and I'm, say, trying to move a bunch of pumpkins around, I'm going to go, like an old-timey merchant, I'm going to go to a person who has a lot of pumpkins, probably a pumpkin farm, and I'm going to buy a lot of pumpkins. Then I'm going to take those pumpkins to a nearby town, and I'm going to try to sell them for a markup. If the people in this town don't really want those pumpkins at that price, well, I might have to abandon those pumpkins. Depending on how much it costs to carry them around and everything like that, it might make sense to. But I'm going to keep a couple of them, as many as I can fit in my wagon or whatever. And then we're going to bring those with us to the next town. And hopefully we're able to sell these pumpkins eventually. And that way we're churning inventory, we're distributing pumpkins, but we're also slowly amassing a growing pile of pumpkins. Imagine my cart can hold infinite pumpkins, okay? I mean, this gets a little off into the weeds in the metaphor. But essentially what I do in the stock market, what other people do in the stock market, is take a bunch of stock from somewhere where people want to sell a bunch of stock, and they go ahead and move it to a place where someone wants to buy a lot of stock. The way I do it personally is I offer to, say, buy a lot of stock. If in a little bit of time people are willing to pay me more for that, I'll go ahead and take that profit. I'll sell the whole lot. If people are not willing to pay me more for it, and I am either stopped out or anything like that, what I do is I sell most of it for a loss. And then I assign that loss to the few shares that I have left, because I can carry those forward in time. If people who are familiar with options, this is sort of like rolling an option. Only I'm rolling it out to infinity, basically. And to do so, I'm putting down more cash. So I am greatly increasing my odds of success by rolling out in time and in risk, which makes sense, hopefully, to everyone. All my options guys out there, all the tasty traders and whatnot. So obviously to do this, you need a lot of money, because you need to be able to do this over and over and over and over again, right? So unfortunately, this isn't something most people can do in the marketplace. You need a big bankroll. Just like with professional gambling, you probably need a big bankroll. Even if you have a little bit of an edge, you got to go in there and make big bets or lots of bets or whatever it is, right? The same thing goes with being a dealer in the marketplace. So there's a second way that you can always make money in the stock market using a much smaller amount of money, starting with a much smaller amount of money. I'm going to tell it to you now. So the second way you can always make money in the stock market is the traditional way. You can become one of these people who want to buy stock or sell stock for a real reason, like the people who want to buy stock for their retirement account and hold it for a long time, or the people who have held stock for a long time in their retirement accounts that want to liquidate that for money in their retirement. It's the way the market's supposed to be used. That's the way most people should use the market. So if you don't have a lot of money, if you don't really know what you're doing, you're probably your best bet to always make money. 100%, like, not guarantee, obviously, because I don't know when you have to sell it, but if you had an infinite time horizon to always make money, is to get with a good financial advisor, a smart guy, start a traditional retirement account and dollar cost average into it. Use good stuff, indexes, There are plenty of other ways. There's plenty of ways to trade and make money, but not many of those are going to have high win rates. Most of those actually have low win rates and are much more focused on the gambling side of it, where they're looking to take much larger wins than their little losses, and every little loss they'll add size. So when the big one comes around, they're well sized and they're well, it means enough for them. It eats up a lot of those little losses to finally get that big win in size. That's the sort of thing that traders commonly do in the market in various ways, especially ones that are profitable, ones that I know. I'm sure there's other ways to do it, but a lot of it is more about gambling strategy and sizing than your technical indicators or anything like that. All of that is to just help you make consistent decisions in deploying your risk management and your sizing and et cetera, et cetera. Like I use technicals all the time as a dealer, but that is to help me know, to consistently offer those shares at at a regular time interval. I have an indicator that tells me when should I go ahead and offer to buy a load of shares to carry for a little bit of time and try to sell for a quick profit. Then I also have another indicator that tells me, okay, you've taken those shares to a place where you didn't really want to take them and no one really wants to buy them from you. So you should go ahead and sell most of them for a loss and then carry the rest. And then I have a third, but you understand, I have a risk management strategy and the indicators just move the money through it. But the real magic happens in that risk management strategy and then the gambling and accounting associated with that on the other side. So like anyone who watched this video to learn a magical indicator that's going to make them a lot of money, what I just told you over the last so many minutes is going to be so much more valuable than any sort of indicator you could find. And that's exactly why I structured the beginning of this video and the thumbnail the way I did. So I hope you watched till the end. I hope you enjoyed it. I hope you learned something. If you want to learn more about trading, dealing, working in the stock market, or investing in general, go ahead and subscribe and like the video and check out the rest of my stuff because it's all I talk about. You have a great night. Hey traders, how are we doing today? Today we're going to talk a little bit about the Arun indicator. A somewhat popular indicator. It's on TradingView. It's definitely the first one you see when you open it up if you're looking for that sort of thing. I'm going to tell you a little bit about how it works and talk a little bit about strengths, maybe some weaknesses. I'm going to play with it a little while, see if we can make it a little bit better, and then run some back testing on it. So with all that said, jump right into it. I have it set for a pretty long length right off the bat because I really don't like the short-term Arun. It just travels back and forth. It's terrible. I went ahead and built a strategy for it. It was pretty simple. I actually just used the moving average equation and then threw in some stuff in there to get that done. So then what we get is this equation. This crosses that, it sells. That crosses that, it buys. It's very simple. I have it set to an hour in length, so it should reciprocate around 60. And if we go to the strategy tester, we can see that it does. Reciprocates right around 60. 57 bar average. So the way this works is it just takes the high and the low over the last so many bars, and it just tracks how come it just takes the high or the low over so many bars, and it just tracks how close price comes to breaking that low or breaking that high. So right here it broke that, and it means it broke the high on the last 60 bars. Break that, it means that the trailing high was somewhere in here and it broke out of there, right there, so you bought it. And then when it broke under the trailing low down here, you sold it. So it's basically just another moving box indicator. We've seen a bunch of these. And it's probably about as effective as the other ones. Depending on how you set it, you can get different lengths, different things like that. The reason the Arun is interesting is it gives you a little bit of structuring inside there for the trends themselves. So one of the strengths is it's definitely pretty good at measuring trend. I mean, as long as it doesn't break the low or the high over so many bars, it's going to keep you in there until it does. It's a interesting little indicator. So let's go to the strategy and look at how it does. You can see it didn't do well. I lost a bunch of money, and yeah, it's one of those trend traders. So the thing to understand with things that reciprocate around the mean like this, that have they win about a third, and then they take on the good time. This one's kind of poor. On the good times, it should try to win twice as much as it loses, if it's only winning a third of them. But the way you could use something like this to do some sort of trend scalping, etc., is like, let's take this one right here. This is your entry. That down there is going to be your stop. So you enter, hold, and then this push here pops you up. What that is signaling by this going up is it breaking above these highs, which you entered at. So you can take that one, and then there's your scalp exit. If you took this one, there's your scalp exit. If you took this one right here, there's your stop right below it. Same thing here. You say you take this one, and there's your stop right below it. Then you could do a short, there's your exit. You want to do short this one, you probably have to wait for it to cut in that effect. Short there, there's your exit. Short there, there's your exit. Short there, there's your exit right there. So of course these are little scalps. You can see they don't, you'd have to set it bigger to get larger deviation in between. That's a nifty way to use the Arun, in my opinion. And it is basically just trend inside a trend. The Arun is measuring longer term deviation and then has shorter term deviation. So very straightforward actually. I mean, sometimes you don't get it. It's a little choppy sometimes. But that's how I would use the Arun if someone put a gun to my head. This one was pretty nice. Come in there, exit. Come in there, exit. Come in there, exit. It's all about trading trend, right? You can even say, let's set it longer. Can't go that high. Oh yeah. You can set it to like 1,000, see? There's your entry down there, you hold, exit. 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 Stop. And you can take one of those. I guess it's little. But the problem is the further you set it, obviously, the further the length, the longer your deviation stop's going to be. But you're also going to get higher hit rates. Bigger wins. You could even do... There's a bunch of fun ways you could use this. Let's throw the strategy out for a second. Let's go Let's go throw on. And it's not what I wanted. Let's go throw on and let's go ahead and set this for 60. Boom. You can even use something like that where you have a stochastic inside of this. So you get the top as this is coming down, and then you have your exit down here. Let's see, top, exit, top, exit. Then same thing on the low side. You didn't really get any there. You never made a new high. But you have all these. As it comes up here, your bottom, down below. You can take any of these little pops as exits. Or you could, hell, you could even just use this. Buy that, sell that, buy that, sell that, buy that, sell that. It's going to be very similar. It's just trend inside trend. This is just a funky way to kind of look at it. So yeah, it pops up. You have all these up. Still green, you got these guys up. And this one, like you see at the bottom down here, you could have gone for that. It comes up and it stops you out. It's not that bad. It's not that bad. You could do worse, even at this length. And this would be tough. But still, you sell the top, you sell any of these tops up here. It does stop you out way over there. It's a couple of points. There's some bad trades, there's some good trades, but I'm just saying how I'd use it. Anyways, I hope you guys learned a little bit about how the Arun works, its strengths, its weaknesses, and a couple of interesting things you can do with it. So yeah, thanks for watching. You guys have a great night. Hey traders, today we're going to talk about a pivot point and stochastic combination. So the pivot points are a popular indicator that are built just by taking the high, low, midpoint of yesterday's range, doing some mathematics to add them together and subtract them from each other to put a bunch of lines on the chart. I'll show them all here. We count them as 1, stop 2, stop 3, stop 4, stop 5, and then resistance 1, 2, 3, 4, and 5. I guess support. Just a way to measure support and resistance. That's based on, I don't know if you can tell, but like this line is the close plus the low or something like that, and then that sort of stuff. I don't really use it myself. However, a lot of people do. And they're more for longer term traders, people who are looking for better places to take longer term positions intraday. However, they're also used for day trading, swing trading, and everything else by people. So let's talk a little bit about them. So one way you can use the pivot points with another indicator to scalp or trade intraday is to combine with them a stochastic. I went together and built a quick little stochastic strategy and went ahead and threw it up on the chart here. to help us look at the pivot points and see if we can use that in the stochastic to assist us in any way. And you can see it's actually fairly simple. We can just look to use the pivots as stops or supports or resistances of sorts and wait for the stochastic to confirm momentum, and then that can give us some decent trades. If you're using one stochastic to enter, I prefer to use a separate stochastic to exit just to work off the fractals, but this will work for us here. Like for instance, if I was going to enter on this one, I might skip that one and go to the next one. That sort of idea. But I would be using different kinds of combinations to do that more subjectively. So you can see they do a solid job of finding longer term positions. Like what a lot of traders will do, especially larger traders, is when they're looking to enter the day, they have things they're looking to sell and they have things they're looking to buy to balance out their portfolios, either delta or their share balances, and they will often use the pivot points as good areas for them to do their long-term work. Like say I came into today and I, had a bunch of call spreads to roll and then a bunch of put calendars I wanted to roll as well. Well, I'd probably roll some calls up there, then you wait for it to come down here towards one of the supports, and that's where you start rolling your short sides. And it's kind of that idea. That's how they're traditionally used by larger players. What a lot of retail uses them as well to do sort of this sort of stuff, is they know the larger players are going to be interacting with price at those levels. So it's sort of minnows biting on the big fish. And some people have great success with it. Some people have a lot of faith in pivot points and support and resistance and stuff like that. I find them a little not super objective because there's a lot of wiggle room around there. They're hard to use as a definitive stop or something like that. So I like to think of them more as a guideline than anything else. But still, you can do something with it. Depending on your use of stochastics and your risk management and everything else, it could be a viable strategy. And if we just look at the base stochastic, all of them, it's not very great. But we can go around and let's mess with the stochastic a little bit, see if we can make it better. So it's going to be hard to modify this, or hard to run a back test on this, so what I did is I just modified this instead to be a stochastic inside a stochastic. So basically a trend inside a trend, it's probably the best I can do. So basically it's going to be weeding out a lot of these. And you might even want to run it, I don't even want to run it like that. So I have this super smoothed out, right? This is going to be downtrends, this is going to be uptrends. In big old uptrends, you want to try longs over shorts. And then when it gets into downtrends, you want to try shorts. And that way you're trading on the right side of trend and helping it progress. There are definitely areas where it gets a little choppy. You have some nice ones in there. And you might want to be a little bit loosey-goosey with your exits. Try to hold it into trend as long as possible, right? But it's workable. I mean, it would be a tough one. I don't really like the pivot points myself. Use those to confirm trend. Like you can see here, it crosses under this pivot point, crosses under this trend here. Like maybe it's trending down from this pivot point. Yeah, it chomps up around it a couple times and crosses it like probably 6 times in there. But eventually does trade down and continue trend to this last pivot point here. And that's this pivot point down here is where trend stops. And I mean it does, again, it chops back and forth across that line probably a dozen times, maybe more. But it eventually does come up off that line. And then it comes back down. But you know what I mean. Anyways, I hope this was educational for you. I hope you learned something about trading and investing, technical analysis, and charting. And make sure to leave any questions in the comments. Be happy to get back to them for you. And if you like this and you like other content like it, make sure to subscribe to my channel. Thank you. Have a great night. Howdy traders. Welcome back to the channel. And if you're new here, my name is Yager of Avon. I do videos about stock trading, technical analysis, I talk about my day trading business, all that sort of stuff. So today we're going to be talking about a very interesting set of indicators for intraday trading. This is going to be using a combination of the PSAR, the parabolic support and resistance, along with the super trend indicator. This is going to give you a pretty useful trend inside of trend scalping mechanism, and I'm going to break it down for you, how it works. Then I'm going to go run about 100 back tests, and we're going to cover the results, and we'll find out if it's a useful strategy that may be employable to us in one way or another. So the way it works is very simple. You have a longer term trend, which is the super trend, and you have a short term trend, which is the parabolic support and resistance. When it's a general uptrend, a large one, you want to be taking PSARs in the upward direction, not the downward direction, the upward direction, the upward direction. We've combined this with the Heikin-Ashi bars for better trend reading and a little bit of smoothing added to our price. And with that, I'm going to get testing here. Oh, before I begin, here, let me show you. I've developed a brand new piece of software. Now, I've spent hours of my life and millions of dollars developing the UI and complicated technology behind it, and I want to show it to you now. Boom. Highly advanced technology. We're going to be using this for our back testing. I developed it myself inside of licensed software. Yeah. Very, very advanced. Without further ado, alright guys, I'm back with the back test, and you can see it was a fairly decent strategy, a fairly decent test on it. We ran back about 33 days, or just under 13,000 1-minute bars to get the 100 trades. So that means that we had to wait a little while. At 1-minute bars, at only about 3 trades per day, you did a lot more waiting than you did trading. And that's true from a lot of these selective strategies where you're trying to get, the smaller trends inside of a bigger trend. You're not going to be in it for a majority of the time. You're actually going to be in a small minority of the time, which can be a drawback. Because at the end of the day, trading is about making money. So if you spend a lot of your time waiting, not a lot of your time trading, even if you have a great strategy, it can be slow to roll, right? At the same time, another thing I noticed was this was a relatively trendy period. And, if you ran this sort of back test on either a different market or a less trendy period, I'm sure you'd have less trendy results. Maybe even wait longer or more time. It would take you, say, 40 days or 50 days to get 100 sample. What we can see by looking at this is it has a decent win-to-loss ratio, about 1.4. Which is fine when you're winning more than half your trades like it was. What about 7 and 10? But again, this is a pretty trendy period. And it wouldn't be very surprising to me if in more choppy periods that dropped down to 50-50 or even less. And maybe your average loss would, kind of flatten out as well. So it probably might be a scratcher and, more consolidated markets or things that are choppier and less trendy. But what it does do a good job of doing is getting trends on both sides, nailing both bearish and bullish trends in its operation. But it does have some healthy drawdowns. You can see in the chart here, there were a couple of spots where we got a good number of consecutive losses. And again, those are periods where the market's chopping back and forth, and really either trend, bullish or bearish, is not going very far. So every trend inside of those trends doesn't go very far. But when the market is trendy, we can put up a good series of large wins in a row. So, all in all, I mean, depending on how you run things and what exactly your game plan is as far as risk management and stuff, I could see this working if you have a way to, if you're only looking at very volatile markets or you're trying to only go after active tickers, stuff like that. Things that probably aren't going to spend too much time consolidating. It can be relatively solid. At the same time, you spend a lot of time waiting, and it has a lot of big wins. So the problem with that is you kind of have to be on the ball all the time. It's really easy to miss 1 or 2 big wins with a strategy like this, and just mess the whole thing up. Just ruin your average win because you missed like 1 or 2 big ones. And even if your winning percentage stays the same, your P&L might get toasted. So yeah. Anyways, I hope you guys learned something. If it's something you want to, look at for yourself, the strategies are all easily available on TradingView. And running a back test to me is relatively easy. You can just kind of have, you can, yeah, at least on this one, I could code half of it. I could code the entries. I couldn't code all the exits. So at least half of it was semi-automated, so it really wasn't that time-consuming, let's say. But if you have any questions on how to do that or anything you've seen here, make sure to put them in the comments. I'd be happy to answer them for you. And I hope you guys have a wonderful day and enjoy the video. Hey there guys, thanks for joining me today. In this video, we're going to talk about the Bollinger Band and Super Trend combination strategy for intraday scalping. So this is I don't know if it's commonly used strategy, but it's somewhat common in its nature and what it's doing. And we're going to go ahead and break that down, talk about exactly how it works, what it's looking at, its strengths, its weaknesses. Now, before we begin, for those who are new to my videos, I'm the Augur of Avon. I'm a stock trader and options dealer. I talk about trading, finance, technical analysis, all sorts of stuff like that. So if that seems your type of content, go ahead and like the video and subscribe to my channel for more. And with all that out of the way, let's just start talking about the fun stuff. So you can see actually right here, the trade pretty much just set up and finished. What it is you're using the Super Trend, which is a longer term trend indicator, to give you, well, an indication of trend. And then what you do is you're using the Bollinger Bands as a short term reciprocator to look at that average, evaluate extremes above and below it based on its average true range, and then you take trades based on, well, expecting the trend to continue, where you would buy from the lower extreme in the trend and sell to the higher extreme in the trend, as long as the trend continues. And it's a fairly simple strategy. People do this in all sorts of ways, whether they're using series of moving averages, or they're using a reciprocator with a longer trend, or even a deviation reader along with like a 200 moving average or something like that. There's a lot of ways to do this trend inside of trend trading, where you're just, it's very simple. For this long-term trend to continue, these short-term trends have to be overall bullish. So you're just trying to get in and take advantage of one of these short-term trends inside of this long-term trend. You know this is gonna, as long as this stays green, this will hit this line eventually. That's just the math. This is pushing up from below, and that's pushing up down from above. It's basically creating a wedge. It has to hit one or the other in some length of time. This is a less sensitive average true range. This is 3 average true ranges, and this is only 2, and this is based on the absolute, and this is based on a moving average. So if the trend is moving up, then this moving average and these bands around it are going to be more sensitive in most cases than this trend itself, right? So basically, if it went any further below that, it would have broken this trend, would have invalidated this trade, and you pretty much had like a 1 point stop on that, and you can make a couple points. It's definitely a scalp. It probably only lasts a couple of bars. You see, like, let's go find another one. It also doesn't set up all the time. You gotta kind of watch, like you might have been able to take that one somewhere in there. The idea is just like to wait for it to retrace in a trend where there's low risk, and then just try to hold it for the next extension in that trend, just assuming the trend will continue. Now you can see sometimes it doesn't. You come down here, you could have taken that, it's incredibly low risk, but then you lost. But it was low risk, so that was the point. I mean, maybe you got out up here, you got out like right on that bar, and you're lucky because it was close, but it's not really algorithmic, and didn't even break that line. So like that would have been better. This was a downtrend, so you wouldn't have taken that. See? So there's definitely some issues with how often it sets up to the letter of the law, right? Like that was a valid setup. I went from there to there. But let's just keep going back and see. I mean, that one was valid, but it failed, and just keep going back. No. Yes, you got one right here. You got several actually. If you wanted to sit here and smoke this, came down. It got to the bottom. He tagged it there, or you got it there. Then it hit the top, bottom, top, bottom, top, bottom, top. You could have been 3 really quick trades for a scalper. With probably it's not a great risk to reward ratio, but you could have done it. And that one was a little bit better than the last ones, but yeah. This one was really good down here. Got that one. It pops up. That's that. So I would say the weakness on this is sometimes you sit here, you wait and wait and wait and wait, and it never sets up. It's just kind of waste of time. And that's definitely a drawback to an indicator, not having frequency. Because then you're either, well, to make the money you want to make, sometimes you're forced to take larger trades than you'd like to take, which can be uncomfortable and can actually end up causing problems in your account and all that, right? So, often having an indicator that makes you wait very patiently for long periods of time can cause people to get emotional and stressed out, and that can be almost as bad as, it causes them to lose discipline, which is a risk, really. And you think about it, everyone loses discipline every now and then. Even the best of us won't be 100% perfect in their execution. And I think of that as a risk, and that's usually based on stress and all sorts of other stuff like that, right? So there's definitely that risk involved in something like this, where you could end up waiting a long time, or other times like this where you have like a dozen trades in a row. You get like one. Okay, maybe I was lying, but there would be times where it's going to be stop and start, where like sometimes you get a lot of trades, and sometimes you just sit here and do nothing. So it's going to be very frustrating to a certain kind of person. At the same time, it does have, overall, it has decent risk to reward, stuff like that. This is one where I'm not going to spend the time to actually throw together a strategy, just because, well, time constraints. To actually run a full back test on it over the last, 10,000 bars, I think it loads. You just kind of, take it as it is, I guess. Eventually I will start doing the back tests on the indicator stuff, but it's just a pain in the butt to code, to tell you the truth. So anyways, I hope you enjoyed that. I hope you learned something about technical analysis, trading. It helps you become a better trader and investor and whatnot. And thanks for watching. Hope you have a great night. Hey, welcome to the channel. I suppose you found your way here because you're interested in the bullish engulfing candlestick strategy and ways to use it. I remember when I first started trading, there's just a lot out there as far as information goes, and it's hard to sift through. So I figured I'd take some time to, help you sift through it and do a bunch of back testing for you in front of you, talking about strategies and ways you can use them. All this to help you become a better trader and investor yourself. I'm the Augur. I do videos about technical analysis, trading, my trading business. So without further ado, we're just going to hop right into the chart here, and I'll explain the strategy, and we'll start back testing it. So the bullish engulfing candlestick strategy works by measuring the highs and the lows of bars against each other. You can see, like in this one, this bullish candle started below the last candle, and it finished above it. So it engulfed it, and this is supposed to represent a reversal signal. These did not work, but however, this one did. And there are certain interesting things about reversal signals and risk management that you can combine to make an effective strategy, and we're going to talk about that now. So being a reversal signal, this should be the bottom of what particular trade we're going for. So that allows us to set a very minuscule stop. So if we're going to take this trade, we buy that. Oh, that's a bearish trade. We buy that. And our stop loss on the trade would be right there, at the bottom of that bar. So in this case, 34 cents. And then with this trade, we would take it until the volatility stop here got triggered, which would be 64 cents. So that's about 2-to-1 risk reward ratio. This one didn't even work that well. You can see on some of these other ones here. Let's find one that really worked very well. You don't have to have the stop along with it. The stop helps you, basically is a profitable exit, or you can take one of these further in the trade. So for example, if we were going to take this short up here, we'd enter at the bottom of this bar, right to the top, and then we could take this all the way down here to this bullish engulfing bar. So that would be your first exit there, because this happened before this. Otherwise you could take this. And that one gave us a 2.61 risk to reward ratio. And on the flip side, when you go ahead and lose them, like this one you probably would have lost. You only lost 30 cents. So what it does is your winners tend to be bigger than your losers, but you tend to have, frequent losers. And sometimes they can be painful. So that's how the strategy works and what we're going to be testing. And now let's talk a little bit about the back testing software I have. Alright, this is the back testing I have set up where we will record our trades. So I'm going to start with $5,000. We can do 100 trades and we're going to figure them all out. We're going to copy them all down here. We're going to keep a running P&L and then I'm going to go over the results. That's the first trade. We'll go ahead and record it. Now we lost the first one. Not the best way to start. And we're trading 10 shares at a time. That's why I gave it $5,000 so it could take those trades. We're going to go ahead and deal without fees and commissions for right now, just to see what those are, because I don't exactly know what those are going to be for you. So I just kind of filter those out. You're going to have to run it yourself. You probably should run it yourself a couple dozen times, depending on what you're going to do with it, different ways you're going to use it. Alright, and I'll be right back when I'm done finishing the test. Alright guys, what's up? I'm back, and I finished the back test, and it wasn't very impressive. What happened was, we went ahead and we back tested 100 trades. We had 26 winners, 74 losers, for a 26% win percentage. We actually made money, but not much, about $70 on 5,000, which wasn't that much, but also we did it in 12 days. So, it's not terrible, I mean, at least at that respect. But the issue was, well, just kind of it's the way it kind of panned out here. The first bit was really choppy, and then you saw some bits in there that were pretty choppy too. It has lots of losses, lots of small losses. The average loss is about $3, the average win is about $10, or about risk to reward ratio of 3.4 to 1. But a lot of that was just a couple of trades, if you look at this. And if you look at these here, lots and lots of little losers, and then big winners. And I'm not really a fan of those sorts of strategies myself, because, well, it's really easy just to miss one of these, or after losing, 5 times in a row, even if they're small, just not want to take that one. It's a really grueling, emotional thing to do with that kind of winning percentage. So that's why I'm not really a huge fan of using the 1 minute engulfing candles, either bullish or bearish, on their own as an entry signal. Even with a trailing stop and some other things on it, like profit targets and stops and stuff like that. Just more of them fail than succeed. It's easier to see a retrace through engulfing candle than it is for it to go to the moon. So yeah, that wraps up my summary of the 1 minute engulfing candle strategy. And if you like this, make sure to check out other videos on my channel. I do a lot of stuff like that. And I hope you guys enjoyed it. You have a great night. Goodbye. Good evening, traders. In this video, I'm going to teach you about the RSI divergence strategy. We're going to cover how it works, its strengths, its weaknesses, and then I'm going to show you something that's going to change the way you think about RSI and its divergences forever. All this to help you become a better educated trader and investor. So, quick about me before we begin. I'm the Augur. I'm a stock trader and options dealer. I make videos about trading, investing, economics, finance, that sort of stuff. So if it sounds like something you like, take a second to click some buttons and help me grow. And with that out of the way, let's get into the fun stuff. So we can see here I have up a great example of the RSI divergence strategy and how it's supposed to function. The way it works is it takes a RSI and it compares the change in time over price to the change in time over RSI. So what happens is this comes down and it hits the bottom of the RSI and it starts to go sideways here. And then it makes a lower low on price, but it makes a higher low on the RSI. So we'll go ahead and print a bullish divergence. And we're expected to buy there. And the trend continues and continues until we see the same thing on the top, where RSI makes an equal high, but price makes a higher high, at which point we see bearish divergence, and the indicator instructs us to sell. So this is a great example of one of the strengths of the RSI divergence indicator. When it works, it can work well. It has a tight stop on it at times, and it can carry you through large trends. So what are some weaknesses of this indicator if it's so good? Well, what you can get is you can get it kind of dragging against a very large trend, like in this example here, where you get nothing but bearish divergences and no bullish ones along the entire uptrend, which can be hard to deal with because, well, that's just a bunch of losing trades if you're going to short every one of these along the way. And it can cost you a lot of money. So let's talk about an amazing unique and interesting way to look at divergences in the RSI and the RSI itself. What the relative strength index is just that. It's a indexing of the relative strength. Strength being, is it making highs or is it making lows? Relative being compared to the last couple of bars. And the length of those bars is determined in the settings of your indicator. So that is exactly what the RSI is and what it does. So what a lower high or equal high with higher price, creating a bearish divergence in the RSI, is actually telling you is that price made a new high, but relative to the last high it made, it's either not as strong or it's shorter. You see what I'm saying? So like if you compare this little run to that little run, this one is bigger than that one. So it prints a bearish divergence. It's not an incredibly complicated indicator, and while it can lead you some problems in very trendy markets, as we've seen, it's much better as a reciprocator in, markets where there are prices bouncing up and down in a range, if you're going to use it its standard way. But let me show you a way to change it and make it so you're not using it in standard way and you're getting a different sort of information from it. So ready? Here we go. Okay, so what we've done is we've taken the RSI and we've made it so slow. We put it to 100 length, which is, well, unheard of for most people's use of the RSI. But what we're going to start looking at is its time spent above and below the midline and the signals we get therein. You can see you tend to only get bearish signals above the midline and bullish signals below the midline. So I went ahead and flipped those. I prefer that signals above the midline on a long length with small bars are bullish signals, and signals below the midline on a very long chart with fast bars are bearish. And the idea is you're simply trying to take from an earlier one and sell to a much later one as long as trend persists, assuming that the measurement of RSI over a long length relative to the midline is a great representation of trend over that length. So we can see, like here for example, the RSI crosses the midline several times. We could really use any of those for a potential entry, and I guess you could use a stop based on an ATR or something. This is more for trend than risk management. But if you're looking for a place to exit, any one of these so-called bullish divergences would be an amazing place to exit this trend trade. And the same thing on the upside. Say you wanted, let's go back to that very first one, the one that would have hurt us so badly. Let's say you wanted to trade this trend bullish. As it starts to hold its weight over the midline, you can take an entry for a longer term trade. And then you have any one of these bearish divergences, which are actually little tops along the trend, because that's exactly what it's measuring. Is this top stronger than this top? If not, it paints a bearish divergence. But that does mean price is higher here than it was here. Price is higher here than it was here. So if you're looking at a place to exit, these are great places to exit long trend in a trend trade. I went ahead and threw a 4 hour, 240 length moving average on this chart. Look at how it compares to the RSI. They look incredibly similar, do they not? So you could take this trade here, carry down, and look at this trend. Then cross back over here, over here. What I'm trying to get at by displaying this at these settings is that a lot of indicators are very similar. An RSI at a longer length, well, at any length really, is just looking at momentum. It's a moving box. It's checking the highs and the lows against each other over time. The moving average just takes a single point, the close, and compares it to itself over time. But at the right measurements, they're very similar. All indicators are. There's only two variables you can stick into an indicator: price and time. You can add all sorts of smoothing to it. You can add all sorts of other stuff to it. I mean, I guess you could use volume too, but I don't. But there's only so many ways you can slice this pie, right? So at a certain level, it's all looking at the same thing. What we're talking about when we start using indicators and other stuff like that is different ways to measure the same thing. So I've been doing this a long time. I've been working with technical analysis and indicators for quite a while. And at this point, I can almost make any indicator say the same thing as any other indicator, simply by playing around with the settings and code in that indicator. They're just tools to measure things. And what you're measuring, you have to really understand. That's what's important, right? So in this case, we're looking at momentum. This is momentum on one way to measure it, and this is momentum another way to measure it. But at the right lengths, if we're measuring them, putting the right amount of data into them, they're almost the same thing. I think this is a little bit, we had to slow this down a little bit, I think. Maybe speed it up to match it perfectly. But the point is, if you just look at it like dials and you just start turning one until it lines up with the other one, like you could do it for just about any indicator. But that's how I would use divergence. I would use it as a way to call out highs or lows along trend. In this case, calling out lows along a downtrend, or calling out highs along an uptrend. Sometimes you don't get them. But that's how I'd use it. I would use the divergence indicator as an exit indicator, not really as an entry indicator, or a risk management indicator for that matter. It's very much looking at, in my opinion, good places to get out in a long trend. Anyways, I hope that was helpful for you and educational and entertaining at some level, and hope you guys enjoyed watching and have a great night. Make sure to check out my other content. It's just as good as this. Hello, in this video we're going to look at a Bollinger Band and Heikin-Ashi scalping strategy for the 1 minute chart. I'm going to start by showing you how to set up the strategy. I'm going to talk a little bit about how it works, a little bit about pros and cons, then I'm going to run a back test on it, and then we're going to cover the results. I'm the Augur. I do stock trading and technical analysis videos, talk about strategy, my trading business, and all that stuff. And with all that introduction out of the way, let's get right into the charts and building the indicator. So the first thing you want to do when you pull up a TradingView or something similar is you want to go ahead and change the candles to Heikin-Ashi. That's going to give you these nice smooth candles, and that's going to allow us to look at the trend following part of this strategy. Then what we're going to do is we're going to simply go and add a normal Bollinger Band. The settings on the Bollinger Band are going to be 20 and a standard deviation of 2. So the way this strategy works is it's very simple. You see the Heikin-Ashi bars break through the top of the Bollinger Band with the candle itself, which means the average of the two candles is above the Bollinger Band. Then it falls back inside. Once the candle crosses the midline, or the middle of the Bollinger Bands, that is a signal. And we're going to use the Fibonacci retracement to go from the low to the high. And that's the wrong one. So on this short position, your stop is the high, and we're looking for a target of 2.618 of our risk. So that's the trade. And you can see it comes down here, breaks outside, but it doesn't come up and break the middle. It comes down here and then breaks the middle here. So that's another trade. It comes in here, breaks the middle. So you go from the top to the bottom, and it hasn't gotten there yet. It hasn't stopped out or gotten there yet, but that's essentially the trade. And if you're not already in a trade, you see how it comes up here, and it comes and then breaks to the bottom as a short trade. So some of the pros and cons is this can work very well. You can see like right here in trend following, and it can give you some very large trades like that one there. A solid scalping trade. It took you about took you about 20 minutes, and it went up about 0.5% at a risk of just a couple of pennies. You can see here, this is what happens when it doesn't work. It breaks that. We have a target down here. It doesn't quite get there. See, it comes out, reverses, and give you one in the other direction. So with all that being said, I'm going to go ahead and start setting up the back test, doing all the testing, and then we will come back and look at how it looks in the software. Okay guys, I'm back with the completed back test, and you can see that this was a pretty effective strategy. However, you spent a whole lot of time waiting. You had 69% winners. You had just a little bit over 1-to-1 risk to reward ratio because we set it to 2.618 to 1. And we won a little bit over half. So that makes about sense because that's about half of 2.6 is about 1.3. Hopefully that carries. What you saw was at most you had 3 or 4 consecutive losses, and at most you had about 5 or 6 consecutive wins, with a lot of even scattering. It took 31 days to take 100 trades, and at only about 20 or 30 bars per trade, you really didn't get that much action. It was only a couple of trades per day. And at all, you probably spent less than 1 hour per day total in the trades. So you weren't really trading that much, and it was a lot of waiting. But all in all, it was an effective strategy, at least for this time. Perhaps in choppier markets it might not perform, and as always you'd have to backtest it on your own day, tickers, and in your own areas to make sure it will be effective for you with other strategies and risk management that you employ. And with all that being said, thanks for watching. I hope you enjoyed it. Make sure to check out my other indicative videos, and you have an excellent night. Thank you. Welcome to the video. If you're looking for an intraday strategy that involves RSI, how to use it, how to build it, and what it does, then you've come to the right place. Let's take a look at a double RSI strategy. This functions with a certain trend under trend element to it. If you watch my other videos, you understand that. That's a good note. I'm the auger. I make a lot of technical analysis and trading videos. I run a stock trading business, and I do other stuff like that. So this indicator strategy is built using 2 RSI. Inside of the RSI, on its standard settings, you're going to see this down here, the moving average settings. So we're going to want 2 moving averages. We're going to set the first one up at 14, and we're going to set the next one up at a 5 ratio to that. So 70 because 14 times 5 is 70. And then we're going to color the fast one green, and we're going to color the slow one red. Now this gives us a certain sort of moving average convergence divergence indicator, but is built using relative strength data. So it's somewhat similar to some of the other methods that I employ myself. And this can be a very powerful tool when you're looking at relativity relative to itself over time. And what this does, it does a great job of looking at trend. Because what this breaking this is actually a period of price staying above the prior highs. That's what would make this roll this. So it's sort of like taking a slower chart, like a 5-minute chart or a 10-minute chart, and we're speeding it up. So using this, your short entry on this would be like when these lines cross, this bar or this bar, and you could hold it next at any time. But for this back test, we're going to hold it all the way until the lines cross, which is not exactly optimized. You could run various sort of things inside here, like a faster trailing stop or even a faster RSI to get better exits inside of the larger trend. But this will do for now, and this will demonstrate the power and efficacy of this sort of strategy. So like, look at this one. It crossed here, and the line didn't cross all the way back over till here. It was long the entire time. It can be a very powerful trade if you use inside here, if you buy these lows, sell these highs, or however you want to do it. But just for this strategy, that's going to be our trade. We're going to buy it when it crosses there, and we're going to sell it when it crosses there. So without further ado, I'm going to go ahead and get into the back test. welcome back. We finished the test, and you can see it did really well. It started off with $5,000, enough to buy 10 SPY shares or sell them. It reran it for 13 days or 5,070 bars. We had an average win of $14.78, an average loss of $10.81 for a risk to reward ratio of 1.367. We had 100 trades, so the back test was 100% completed. We had 65 winners, 35 losers for a 65% win to loss ratio. This gave us a total profit or loss without fees and commissions of $582.03, or an average trade return of $5.82 to make an 11.64 return on capital, which is great for the small time we ran the test. If you want to trade this sort of strategy, make sure to run it under different conditions and on tickers you might trade besides the SPY. And I hope you learned something, enjoyed the video, and make sure to check out the rest of my content. Thanks, you have a great night. Hey there, in this video I'm going to teach you an interesting way to look at the moving average convergence divergence indicators and use them in combination with one another for an effective 1-minute scalping strategy. This is yet another strategy based on the general trend inside of trend thought process that we've used before for several other strategies on this channel. I'm going to go over how it works, what it's looking at, the settings for the indicators, then we're going to run a 100 sample back test to see how the strategy works, and we'll figure out if the moving average convergence divergence combo scalping strategy is something that we should employ in our own work as traders and investors. So we're looking at the SPY here, and we're going to start off by setting up two moving average convergence divergence indicators on our screen. The first one is just going to be the standard settings. This is what you get on when you click the indicator. So we're just leaving that one as is. And I usually go ahead and turn these off so I can look at the histogram better. If you turn these on, you see how small that gets. Turn these off, it's much easier to see. This one is the one we're going to change. Again, I turned off the lines. So I'm going to set the fast length to 50 and the slow length to 250. This is a 1 to 5 ratio. Then I'm going to set the smoothing to 25. This is a standard ratio that I use often with the 1 to 5 and then a half measure on that one. And these are all EMAs. So what this gives us is a longer term trend and then shorter term trend inside of that. With the idea being for this trend to continue, these little downtrends have to be stronger than these little uptrends. And we can take advantage of that as long as the trend continues. But you can see what happens often. It goes ahead and reverses. It's going to reverse in an uptrend, or it's going to reverse in a downtrend, or a choppiness. So it's hard to get caught really lopsided on that. And that's the entire idea behind this. So I've gone ahead and set up a strategy for the fast one. And this will just follow this. So you see it sells when this crosses over that, and then buys when it crosses back over this. So we can use this inside of trend here. When this is going down, we want to take the short scalps. And when this is going up, we want to try the long scalp. Very simple. See, it flips. It's going up. That one fails. You lose like 30 cents. And then this one works. And you make money there. What this provides is really good risk to reward ratios. And you lose a decent more than you win. Or you win them decent more than you lose. Or supposedly. In the right circumstances. Under the right conditions. So without further jibber jabber, I'm going to go ahead and hop right into the back test. And meet you guys back here with some data. Alright guys, I'm back with the back test, and it took a little while, but we got it done. You can see it's a pretty even strategy, and it definitely didn't perform as well as some of the other ones we've looked at on this channel. We started with $5,000, we took 100 trades, we only won 49, and we lost 51, so it was about 50-50. Made about $100 or $1 per trade. We only returned 2% on cap. It took us 31 days, which is a little bit longer than the other ones, or 12,000 bars, and we weren't really in the trade that long. These are some quick trades. I'd say you'd only really in the trade maybe 5 or 10% of the time. It really took a while for all those to line up. Your average win was about $8, and your average loss was about $5.74 for a 1.395 risk-to-reward ratio without fees and commissions. You can see, looking at some of the data, it was pretty choppy. Obviously, like when it's in a downtrend, you're scalping short. When it's in an uptrend, you're scalping long. There's some chop in there sometimes that throws you off. But in general, your winners are a little bit bigger than your losers, and it kind of carries itself on that way. So I could see if you had the proper setup and everything like that, you could use something like this. But for a lot of people, it won't be incredibly helpful. If you like that video, make sure to check out my other videos about the same sort of stuff, where we cover a lot of other strategies, and cover my other trades, my trading business, and some other stuff like that. Well, anyways, I hope you enjoyed that. Thanks for watching. I hope you have a great night. Hey, welcome to this video. Here we're going to use two parabolic support and resistance, or chandelier stops, to maximize our ability to take advantage of trend, to scalp on the 1, 5, 10, 15 minute charts intraday. So without further ado, I'm just going to jump right into how the indicator is used and how it's set up. You set up this indicator strategy with two support and resistances. You can go to the indicator tab under technicals, and it's going to be the parabolic support and resistance, parabolic SAR. So you want to select two of these on your chart. Then we're going to change them. The fast one, we're just going to leave these as is, and we're going to color it white. You can leave it blue if you like, but I like to change the color, so there's two kinds of colors on there. Let's take the second one. And the second one, what we're going to do is we're just going to add an extra 0 in there. So it starts like that. We're going to add an extra 0. Same thing for this one on the increment. It starts like that. We'll add an extra 0, and we'll leave max value alone. So what this does is we have a trend that'll start off of a smaller trend, and then it'll either continue or not. That's the entire thought process behind this. Like in this long trend, you're going to have extensions, you're going to have pullbacks, extensions and pullbacks, extensions and pullbacks. So to trade this long trend, ideally, you want to buy one of these pullbacks and then sell into one of these extensions. But what's a concise way we can do that? Well, easy. When it goes to make one of these pullbacks, we can go ahead and draw an extension off the last extension. So I made a pullback, we're going to draw it down to the start of this line right about there. And you can see as it goes forward in time, kind of losing my thing a little bit. It has one exit you could take there, but preferably you take this exit up here, the 2.618. Those who are familiar with the last couple of videos know that I tend to set these a lot. And sometimes it doesn't work. Like on this one, it comes up down here, starts to trend, pops up here, basically fails about as bad as it can, and never gets, and you're stopped out when it hits the longer trend and breaks that. Because this itself, as you can see, is actually even longer trend. If you had another line starting down here that went all the way up, this is one of these in that. That's why I say the market's fractal in nature. It's all built inside each other. You can do this endlessly. Is in this big line will be one of these inside an even bigger line, and it'll continue on forever. And if you want to zoom in really far, maybe make your bars a little bit faster, you could start doing this inside of these, and you can start splitting apart even faster if you want. It's just the fractal nature of the markets. So that's very much how the strategy works and how it's set up. And without any further ado, I'm going to go ahead and set up the backtesting software, and I'm going to run a 100 sample backtest, and we'll see how the strategy functions. Well, that was a fun backtest. It seemed to do very well in trendy markets, and it seemed to be challenged in the shop. It didn't do as well as some other things, but it was performing alright. So without further chit chat, here's what she looks like. See, we started off with $5,000, we took 100 trades, we won 41, and we lost 59 for a 41% win to loss ratio. We made a total of $236.99 for 2.37 on an average trade. Now return on capital is about 4.5%, but then again, this was a particularly trendy market to the downside. So you might want to backtest this over other periods and on other tickers. It took us 9 days or 3,500 bars to to get our 100 trades. Our average win was about $18.91. That's trading 10 SPY shares. And our average loss was about $9.12. For a nice, even, just about 2-to-1 risk-to-reward ratio. So even though we lost more than we won, the fact that we won more than 30% of them with this ratio made it a profitable strategy overall. But it was pretty choppy, as you can see. I hope you enjoyed that. Thanks for watching. Make sure to check out my other strategies and videos, and all sorts of other educational materials if you're interested in my trading or becoming a better trader yourself. So with all that said, you have a great night. Thanks for watching. Hey traders, what's going on? I'm the Augur of Avon. I'm a stock trader and options dealer, and today we're going to talk about the ADX directional strategy for intraday trading. And people tell me that I talk a little bit slow, so I'm going to try to speed this one up. The ADX, Average Directional Index, and DMI, Directional Momentum Index, are usually combined by traders for all sorts of trading, swing trading, day trading, investing, etc., etc. They're simply they're just simply momentum indicators. They work on a bounded basis between 0 and 100, and they plot relative direction. Basically, they're looking at the range, and they're asking, is the range moving up or is it moving down? And relative to itself over time, is that more up or more down than it was before? That's a directional momentum index. It's indexing the directional movement, if that makes sense. And hopefully it does. And the ADX is the average directional movement, or the average directional index. There's a lot of directional index we're talking about. It's confusing them a lot. But this one is the ADX. This is the DMI, and this is the ADX. This is just the average of the two of these combined. So this is like an absolute value. This is like the same thing, but split over the zero line. So the way people use this is they wait for the absolute value to start to rise, and they'll enter on whatever side is dominant. Or they will take signals when this is rising to indicate that it's, maintaining a previous strength in the trend, and didn't take that because it's not all the way at the bottom. See, this one's there, that one's higher, so this one's better than that one. In that logic. So to backtest this strategy, I went ahead and threw together some code to run a DMI script. So every time this crosses down, it sells. Every time it crosses up, it buys. Very simple script. Let's see how the backtest went. Well, you can see that this kind of made money, but the problem with it is it had a lot of trades and didn't hold very long. So this one is, in my opinion, set too fast. Set too fast. You definitely want more than that many bars in trade, because in my opinion it takes one to think about entering, one to think about exiting. So if you're only there for an average of 12, that means about 8 to 10% of the time you spend in a trade, or your total time in the strategy, is spent just thinking about entering or exiting. And that's a lot of slippage and drag, which we want to try to avoid in trading strategies, because that can result in, bad results. So let's mess with this a little bit and see if we can make this better. Okay, I'm back with something I'm kind of proud of. So I built an ADX intraday indicator strategy that runs off of what I call, it basically runs off throwback waves, but that's hard to describe. So what I'm going to describe here is failed momentum. So we can see we have a bullish wave here. It starts with a nice bullish pump, a lot of directional movement on the bullish side. These, by the way, are set to 60 or 50 on the slow line and 30 on the fast line. So when you get a nice short-term pump that starts to drive some longer-term action, and it continues, at a certain point it'll fail. If it doesn't regain that, guess what? We're going to sell. This sold because this green crossed under the ADX here, which you're like, okay, so why is that an interesting signal? Well, it means that the combination of this and this cut in half, and you look at just the buying, is less than the average, which is kind of a complex mathematical thing. But it means that the buying is very low, and that's because it's been nothing but selling. But usually that implies something about the marketplace. And if you see a lot of short-term selling coming to a point that drives it below this average, which is calculated by the sum of the total movements of this and this, it can be an indication for future events. And as long as those carry, they'll boom. And so when does this thing take profit? It takes profit at the moment of maximum, or the point of maximum failure in momentum. So this is going to drive it up exponentially, this sort of move. That's what this arcing red is a exponential curve, and that's going to be a slow exponential curve. At a certain point, it's just going to run out of people in this move, and it's going to crack that down below the average. Just boom. So what we're looking at is a bullish failure to start the bear wave, and then we're looking at a bearish failure to end it. And yeah, sometimes it chops you about. Definitely, like anything else, there's going to be some nastiness to it. Let's even look at this nastiness. It sold that because it was a giant spike, but basically the bar before this got driven. So let's cross that. It sold it, and then this got smashed right down after it, which means they bought it. We sold to these buyers and hopefully hopefully it took us 5 seconds, and then we bought to these guys. So it's kind of like operating against. It's operating the short-term guys against the long-term guys. Let's put it that way. See here, we had a bullish attempt and then a failure, so it bought. And then we had a bearish attempt and then a failure, so it sold. We had a bullish attempt, and then a failure, so it bought. We had a bearish attempt and then a failure, so it sold. A bullish attempt and then a failure. A failure is when it crosses below that last low and bought. And then we had a bullish failure or a bearish failure, where it crossed below one of these lows in the measurement of directional index. Then it popped up, so it sold. So it's kind of a complex one to understand. It took me a little bit of fiddling to figure out how to code this correctly. So it would probably take you some fiddling to figure out how to code it correctly. See, come up there, bear or a bull failure right there, pops up, sells. Boom, 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 boom. Yeah, a bear move, pops up, breaks, buys. Then this thing here. Basically, it's trading against. It's trading these tweezer moves, but at different lengths. As a variable length to the tweezer move. It can pick it up on 1 bar. It can pick it up on like 6. It can pick it up on 3. It can pick it up on 1 bar. I don't even know what that is. I don't know what's picking up in there. Just kind of a mess in there. But yeah, that's basically what it's doing. It's trying to trade against rejections. And it actually does a good job at holding through some pain. That was nice. But yeah, anyways, I hope you guys learned something about the average directional index, how it works, and some other cool stuff like that. Oh, let's check out the back test. What are we doing? Back test was great. Look at that. 121 trades. More than half of them were profitable. And the ones we won were almost 50% larger than the ones we lost. So, like, look at that. 51. Wins about half. But its winners are better than its losers. Especially the largest. Look at that. Nice reciprocations. Say it's about 100 bars in every trade. This is, I would call this a good one. I like the way this one is set up. Okay, anyways, thanks for watching to the end to see that back test, and I hope you guys caught all the cool stuff in there. And I hope you have a great night. Bye. Hey traders, what's up? Say I did something special for you today. I made your strategy. The CCI strategy, we're going to talk about it. We're going to talk about how it works. We're going to talk about its strengths. We're going to talk about its weaknesses. And we're going to talk about a couple of tweaks you can make to make it better. So the CCI indicator, the Commodity Channel Index, is a bounded indicator. It ranges between, it actually isn't really bounded, but it's bounded in a lot of ways. The higher it goes, the harder it is for it to go higher. So it's bounded in an exponential manner. But it's not technically bounded. It could go on forever, but it just becomes harder and harder. And the market can't go on infinitely, so eventually it will seize up. Let's see if we can find some big spikes, like right here. See, it can go pretty freaking high when it starts to move, but it can't go up forever. And then it comes back down really fast. So that's just kind of how she works. And I mean, there's a lot of indicators that work like that. The MACD isn't actually bounded either, but you won't see the MACD get above a certain level, just because the market's mean reverting over every length you can find. And, well, it just can't get past a certain extreme usually, especially in an exponential manner. So, how do people use this to trade? Well, they use it a lot like the RSI. A lot of people use it to scalp, and as far as a scalping indicator, it's pretty dang good, honestly. However, the problem with a lot of scalping indicators is it has some very big drawdowns built into it. That's account blowers right there, especially if you scalp with size like some people do. So like any scalping strategy, you're going to need to develop some sort of advanced stop mechanism or something go along with this. I want to just run this by itself in this form at this length. So let's look at a back test to see how it performs. So you can see it just kind of chopped around the 0 line. It really didn't do anything spectacular either way. You can see those big drops like I was talking about, really evident. And it does weigh it down. So at this length, it's really not going to do much, and it has an extremely large sample size and small hold time, so you can spend a lot of time thinking about that, or the indicator will. About 10%, 15% of the time it'll be just thinking about entering or exiting a trade, which is not really what you want. It's going to give you this reciprocation. So how can we make this more interesting? Well, what we're going to do is we're probably just going to slow it down, and we'll watch the magic happen, see if that does anything. Alright, you can see all the signals disappeared, at least on this screen. They're still there. I just multiplied the indicator by about 6. So what happens when you take a fast chart with a fast indicator and then you start running on really slow speeds? Because you're actually probably trading more. It's more like you're trading that same indicator on a higher time frame chart with a little bit more bar-to-bar accuracy. If you've ever had the problem where your indicator is dragging, and I consider that, well, let's just say right here. It says, let's say you wanted to buy there. That's where you feel like the indicator is entering, and you're waiting for this close. And you can see how far that bar moved between it crossing this line and it closing above this line. That's why I call it drag. The more difference between your standard observations, the length of your bars, the bigger drag you're going to have. So like if your indicator takes 1 bar to think, 1 bar to think on entry, 1 bar to think on close, and it's only in there for 10 bars, there's going to be a lot of that like drag space, right? It's about 10% of the total distance on a absolute basis. So what we can do to fix this and kind of make things a little bit more precise is we can just back this indicator far out, and we can eliminate a lot of that bar drag, which is going to give us a lot of that weird reciprocation we see around the 0 line on the results. So let's go ahead and sorry. So let's go ahead and pull up the results, see what this looks like. Bam. See, it was actually a pretty solid indicator, and this one is probably more people would consider more as a trend trader, but I still consider a reciprocator just because you set it to a longer length, and each trade is probably going to stretch across what people would look at it on a single screen. People would call it a trend indicator, but a trend is just a long reciprocation and vice versa. Reciprocation is just a very fast trend, and I think we'll get into that another time. So this did very well. Let's look at the performance summary. You see there's a few good things right off the bat. First of all, average trade, pretty good. Then we can look at, say, you have the winning side and the losing side, because it's been a very bearish market. So if we look at the ratios from the largest loser to the largest winner on the winning side, and the same on the losing side, and compare them, you get a really good average ratio out of it. And then you have pretty good win rates at about 70% across over 100 samples. That's solid. So again, I built this indicator myself. The way I did that, I just took the standard code for the commodity channel index that's built into TradingView. And what I did was I simply copied a good portion of that into the standard RSI strategy provided by TradingView. It's pretty easy to do once you figure out what you're doing with your code, how these things work, stuff like that. But you can build all sorts of simple stuff like this relatively easy. I think this took me all of 5 minutes to build. It took me longer to record this video than to build this indicator and strategy. So, that all being said, I hope you enjoyed this. I hope you learned something about the CCI indicator, how to use it, how it works, thought process behind it, and a couple of ways to modify it to make it more interesting. Which is, well, the same way I modify a lot of indicators. You throw a random indicator at me, the first thing I'm going to do to see if it works better is I'm going to start playing with the length, and I'm specifically going to start trying to back it off. Usually more patience is what's going to give you better results. So anyways, with all that being said, I hope you had a great night and enjoy the video. Bye-bye. Hey traders, in this video I'm going to go over an awesome scalping strategy utilizing two indicators, the VWAP indicator, volume weighted moving average, and the divergence indicator on the RSI. So I want to get something out of the way. How is this thing 100% accurate? And what does that even mean? Well, that's actually a math joke. The two things you see on your screen, the volume weighted average price and the divergence and relative strength indicator, are both mathematical concepts. They're defined by an equation that looks at objective data like price and time, then uses that equation and those inputs to spit out outputs. So those outputs are always exactly what the equation is meant to tell you. Now, does that tell you much about price and the market in the future? Well, not particularly. It won't tell you if it's going to be a profitable trade. It won't tell you what's going to happen in the future. But, I mean, if you ask it, what is the volume weighted average price, and you give it a series of data, and it comes back with the number, I don't know, 396 in this case. That is what it is. It's a mathematical equation. You got a mathematical answer based on objective inputs. What you do with that is, well, less objective for most people. And the whole goal around trading and using technical analysis and your risk management and sizing and all that is to make the decisions based on objective observations more consistent, as consistent as possible, so that you can, well, make them better in the future. The only way to make something better is to measure its progress, or measure where it's at now, figure out ways to improve it, and then enact those ways. And to do that, you need to have consistent measurements. And the only way you're going to get consistent measurements of something as chaotic as the market is to use mathematical equations that use objective inputs. So that's what I mean by this indicator is 100% accurate. It always tells you exactly what you are asking it to tell you. The volume weighted average price always tells you what the average price is weighted by individual volume over time. That is literally what it's telling you. A divergence on the relative strength indicator is literally telling you there's divergence in the relative strength of price over time along some length. But what that actually means is, and how we're using it here, is we're using the volume weighted average price as a rough estimate of trend. As trend is deviation over time in one direction over the other. If price is below the volume weighted average price, then it's safe to say that it is deviating in a downward manner because it is currently below the average. If that makes sense. That's the statement of fact. So we're gonna jump right into it. But first, if you're new here, I'm the Augur. I'm a stock trader and options dealer. I talk about technical analysis, my trading, my business, finance, economics, all that. So if you like that stuff, make sure to check out the channel. Alright, let's go. So, this is a powerful combination, and it works for a couple of specific reasons. First of all, you're not going to get many trades. So, you can always set up a chart to make it look like it's awesome. That's why I started here. It was a particularly good time for this indicator. Combination strategy. And the way this would function is very simple. The volume weighted moving average price is just that. It goes ahead and takes average price over time. They usually start at the beginning of the day, so it's just average from there. Then when there's more volume, the average is like that. Price is weighted more in the average. When there's less volume, it's weighted less. So it's volume weighted average price. That's a very true mathematical definition, right? Like if you know math, the name is exactly what it is. And divergence is divergence on the RSI. So basically what we're looking at down here is momentum in a lot of ways. You can see as the RSI peaks up towards the top and then starts to fall down, what that is a dropping off in momentum while still maintaining higher prices. That's why these lows are getting lower, but they're still coming up to the top here. If that makes sense, how that indicator actually functions, because it's a moving box function. So what it does is, as it moves up, the box comes up with it, and it shrinks because it's moving slower and slower. And then as it shrinks, but it's still hitting the top, so it's still doing ping, 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 it's also starting to hit the bottom of the box a little bit. It's starting to go down, pull towards the bottom. Now when it hits the bottom of the box. See how that works? So this is basically just a keeping a moving box on side with trend. And then when it works, it can work very well. Like we can see, this literally like top called it. And then you could, you had go take it down there, another profit you take anywhere down there. Basically, if you took this thing, you had quite a while where you could have taken profit anywhere and made money. This one was a little bit quicker, but same idea. It came up, it basically nailed the top. You could have just if you did buy there, you could set a stop right above that bar more or less. I don't know where that wick came in, but you'd ignore that usually. And then yeah, you get a couple of entries. So it works great. And it's the strength. When it works, it works great. Problem with this indicator, and I'll show you the weakness to it right now, is that in a lot of markets, you don't often get what you're looking for. Like, so you got a little bit of what you're looking for there. Or you got a bull, it's under the line, you got a bear signal, so you got one sales. Didn't really get an exit, but you probably could have made money there if you're quick. But then like, these are just all, as it gets another line there, it just gives you bull signals under the line until it gets all the way down here. And then vice versa here. Once it gets above the line, like most of these are bear signals, all the way above the line. So sometimes you get, you get one here, you get a little one there. See, you kind of get one there. See, like you didn't get that one because it was above the line, then below the line. So you got nothing. You got nothing in all this whole day. You didn't get a single trade basically. And this is looking at a 1 minute chart, so you really can't get that much faster than this. That whole day, you really just got a failed trade. Unless you're trading like 6 in the morning. Unless you're trading like 6 in the morning, you didn't get any trades that day. This day, you got a good one right there. You got it was really early in the morning, so you got 2. But the problem is for all the bad signals, basically relative to all these that you have to ignore, you could have taken these. But for the ones you do have to ignore because they're on the, they're bull signals under the line or they're bear signals above the line, all the ones you'd ignore, relative to the ones you can take, there's so many that it becomes a tough strategy to play for another reason, which is time effective, which is something most people don't think about. At the end of the day, trading's a business and it needs to be effective time-wise. If you are only taking like 6 points, but you can take that 6-10 points like almost every single time you can get it, but it's very long amounts of time in between, you need to take huge risks on those that show up for you. So if those don't work out, it can become a very tough strategy to play really quick. Like anything else in this game, it's gonna be a lot more about your risk management and your sizing. And I'm sure, like, if you kept this in the back of your mind along with other stuff, and took a little whack at it when it did show up for you, maybe it'd be a great addition to other things you're doing. But I just don't see this becoming the backbone of someone's work. But at the same time, I do that same sort of thing where I have a couple of different tips and tricks that I have that work, and I'll use them when they show up, because none of them really show up at the same time. So there's always work to do, if that makes sense. But yeah, that is the RSI and VWAP divergence strategy. It's actually more common than you think. A lot of people try it because it does, if you back test it correctly, it's an incredibly hard back test to build once you start throwing in a filtering indicator. It's becoming something I'm not going to try to build for a 10-minute video, and I'm not going to plagiarize. Unless I do it by accident, I really don't want to plagiarize someone else's indicator, so these are just the standard built-in indicators I can talk about. So I'm either going to try to attempt to build my own to show you guys, or I'm going to use the standard one TradingView applies. I know most creators on here really wouldn't mind me showing off their equations if they're, if they release them open source to the public, but at the same time, I don't feel that's very genuine, right? So I'm not going to do that. So these are all just the standard TradingView indicators. Anyone can pull them up anytime. And these are most of the standard indicators on TradingView are all equations from like the 60s and 70s too. All the standard technical analysis people use is old math these days. Well, but we have to get through all that old math to get to the new math, right? So anyways, I hope you learned something from this video. I hope you enjoyed it, and make sure to like and subscribe, follow my channel, and check out more of my technical analysis videos. Bye-bye. Hello! In this video, I'm going to teach you about the volatility stop indicator and strategy, how it works, its strengths, its weaknesses, then we'll look at a quick back test. And I'll show you 1 or 2 tweaks you can do to make it even more interesting. All this to help you become a more educated trader and investor. So I'm the auger. I'm a stock trader and options dealer. I make videos about trading, investing, economics, finance, stuff like that. If it sounds like your thing, go ahead and like and subscribe to see more of that. So let's go ahead and get into the charts on TradingView here. So I've go ahead and loaded up the volatility stop indicator on my chart and went ahead and gotten a strategy together around that, which was actually a little bit difficult. It's kind of a weirdly built strategy, but it just runs off of the true range of a factor. In this case, it's set to 20, and a true range of 2, or a range of 2 over the last 20 reflected up and down. So that's how it sets the line. So the way it works, this price comes in here, it breaks above the line, it closes above the line, it buys. If the line follows it up, the line only goes up, it never comes down. It's a trailing stop at that average true range. And it comes up here, and then when it finally does break it, it sells. Then when it comes to break that line, it buys. It's a very simple indicator, just based on true range. It operates very much like the super trend indicator, but there are some slight differences in the calculation. It just has to do with how the period is set. Like this one counts, like if I set this one to 20, it's like setting the super trend to like 18 or 19. But besides that, they're very similar equations. And well, the way it works is this indicator and the strategy, it's not really designed to guess direction. It just kind of follows along as long as the market doesn't break that little line. And that line is based off of the range of the bars. So as long as the market continues the sort of deviation it's trading in, it'll hold that line. See, there's a lot of interesting things about deviation. Like you can see right there, it held deviation all the way down, even on that little bump there, until here, where it broke it on one big bar. And then that started an uptrend, and it really didn't get that much further down below the lows here. And so there is something to be said about the importance of changes in deviation over time, and what those mean when you see them in price. It's just kind of a change in mood of the participant. You see, like again, even though we had a huge drop there, the fact that it bounced back up more than the range of any of the other bounces up over this period was a sign of at least a little bit of strength until it continued lower. But again, it kind of held that line again. It's just interesting to me. Deviation and the way trends build and develop are what I think about a lot. So let's talk about some of the weaknesses. It's a great display of some of the weaknesses right here. Because it's such a tight stop, or it commonly comes as such a tight stop, and people don't really change the settings that much, and stays like 2 ATR, 3 ATR, it can get chopped to pieces a lot, especially in, reciprocations. At the same time, I mean, it does do a half decent job at catching some big trend moves with low risk. I think that's a very high risk to reward ratio on that trade, even though you had to deal with all this junk. So the question becomes, like on any indicator, does all this junk outweigh the big hits? And then, in addition to that, how can you structure your risk management and your understanding of this data to take advantage of that? So we can see, like, it's been an incredibly bearish market. I'm willing to say that this one is winning more on the downside than on the upside. But you can see it has some upside winners. That one was a nice win. And you got, 705, 40 points, and you're really only risking 4, 6, It's good. That's a solid 10 to 1. So, I mean, all this junk here could have been beaten out by that trade if you did it right. Maybe, it almost looked alright too. You had a little bump there. She had some mess in here. Real mess. Anyways, let's look at the back test. And you can see it actually performed pretty well here, but it's also been an incredibly trendy period. Let's go look at a couple of other ones once we fiddle around with this. Well, see if I go ahead and flip it to a 30-minute chart, it doesn't work at all. It has a lot of the same data, percentage profitable, total closed trades, average bars in trade, but it's a big fat loser. Then I change it to the 1 hour, and it's a big winner. So really what this is speaking to is the total volume of closed trades. It has like the tiniest edge depending on when you catch it and how trendy it is. But it's not really winning that much per trade, and they're really fast trades. So this is sort of just kind of the buildup of the data. But you can see how a lot of the trades, I'd say 90% of the trades are small trades that don't really go anywhere. Yeah, maybe you have some burn there, but they don't really go anywhere. And then sometimes you have these big moves. You can catch some big ones. So if your risk management strategy was set up right with something like this, and you had very low fees and commissions, if you're a professional shop, if you're working with large volumes, all sorts of robots and fancy stuff like that, you might be able to take advantage of something like this. But you could also, at that same rate, talking about those same sorts of people, you could build a robot that flips coins and just follows for the trailing stop and probably have very similar results. It would be very much about your risk management and your sizing and your financing and cash flow and all those sorts of fun stuffs at that point. So as far as we're concerned, this is going to be something hard to work with. Now you can see it comes in very close. Obviously it was bearish, so the bull side lost, the bear side won, but so slightly, there's such a tiny difference. It's just the fact that difference is multiplied by like 1,000 times, right? And then this looks like there was one really big trade or two really big trades that changed this data. So the important part to understand when we're talking about something that works like that too, where one or two big trades are what this is chasing and the rest of it just kind of chops back and forth around zero, is you need to have a way to take every iteration. You need to either have a bot or something that's going to take every single setup, because you can't afford to miss the big one. Otherwise, the entire thing's a waste, right? So that's the entire idea with that. And this one, it really doesn't look like the big hitters are that frequent. So it would honestly be a tough one to do, especially as a retail trader. That's just my opinion on it. And boom, we have something slightly more interesting to look at with the volatility stop indicator. So I've gone ahead and I've added a very short-term RSI to that, and about 3 length standard settings besides that. And this is now a 1-minute scalper or something similar. And this is how a lot of people set up something similar. So we know from our last episode of the RSI. If you haven't watched that, go ahead and check that out. I'll make sure there's a link in the comments below, where we talk about the function and how that works and whatnot. So we know that it is basically just a moving box, but if we set a moving box inside of a larger trend, which is just itself a larger moving box, we can trade that box inside itself, basically. And that's how a lot of scalpers will function. And it's not like they'll take every single one of these, but what they know is that, like, for instance, after their RSI trigger short, these are all relatively high prices compared to this. So it creates, like I said, like I referenced in the super trend video, it creates a condition where only one of two options can happen. Either this will go up here and break the trend, and then it'll, stop you out of that trade if you're a scalper, because you're not really going to get in there. You might wait a little bit, get one of these guys. You definitely want to scalp off an uptick, scalp off the ask if you're shorting, and then they're probably going to take it as it falls down here, maybe somewhere in this bar, depending, and that just helps them basically with their risk management, because if the RSI functions as it should, on average, the distance between the top of this box and that box relative to this box, which is this and like this, since this box is set above the midline, if that makes sense, the risk is is not this is not as big as this on average over time. So that's how that would be set up. And this is still a lot more about your risk management than anything else. Like anything else you're going to do, This thing will have its times where it's really making you mad. Let me see if I can find, yeah, like right up in here. And this will be a very frustrating time for you. Now, you can come up in here, you have a long, you got one, maybe two, three good scalp. Okay, so you got some good scalping in there. I lied. Let's say on this one, like you're short there, it's gonna, like, I don't even know what to do with this one. You'd be kind of in a rough pickle on that trade. You have to figure something out. But it doesn't stop you out. It just comes up here and the RSI triggered the exact other way because of this quick V in like 3 bars, which is what happens when you set an RSI to like 5 and then it gives you a V and it closes the box. Same thing happens there and there. So it's one of those things where, like, you might want to think of adding an additional exit factor to this, or I'm sure there's ways you can make this better. Now, this is just something I kind of whipped up out of the top of my head that I know that is it's not exactly what other people use, but I know some people who will do cycles inside of cycles like this to scalp. So this is kind of a good way to illustrate that thought process in a technical manner. And like I said, I'm sure there's the way you would go ahead and keep this sort of thing on track is you have iterative testing, whereas you figure out what works best. You're gonna have to adjust with the market as it moves and all sorts of stuff like that. But yeah, we know the RSI works better when it's working with a larger trend. So this is just a good way to display that and then add a stop to that trend at the same time. So there's really no rocket science or magic to it. It's just helping with your thought process. It's supposed to help you keep you consistent, if that's the route you're going to take. Then you could have some fun, something like that, right? Pew, 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 pew. It's one of those things where you could just start floating, float bids, and when they fill, go ahead and ask. And just cycle through it. But, like, you still kind of need a big account, because this is only, like, what, 96.5, 92, it's only 4 points. So you need a pretty big account to actually make decent usage out of all these. And these are only, like, even on the SPY, it's only like a 30, 40, 50 cent move. So, yeah, you'd have to, I guess you could scalp, like, YOLO options off this, but it would be very tough. The spreads would kill you. Wow, that was a lot of fun. I hope you enjoyed it too, and I hope you learned something about the trailing stop indicators, volatility stop, super trend. They're all kind of the same sort of idea. And how to use certain oscillators inside of those to help you with certain strategies, and all that is sort of stuff you'd have to learn, to follow more in your own data testing, but I hope it was able to point you in the right direction if that's something you really want to do. And with all that being said, you have a great night. Remember to like and subscribe. Hey everyone, this is going to be a special recording today, because I don't think many people talk about this. We're going to talk about how reciprocation around averages and divergences in them can define levels of support and resistance in price action. That's a fancy way of saying this is how the MACD defines support and resistance, or supply and demand, in the chart. So what your MACD is the combination of two moving averages and the difference between them. You can select that. That really doesn't matter. What we're going to look about is the divergence itself, which is the MACD. So let's talk about what support and resistance, supply and demand is first. Supply and demand, support and resistance, are areas in price in which there are a group of people who want to buy or sell, usually based on either prior orders, which I consider entangled, or some sort of future perception, which is considered observational entanglement. So what this means is, as price comes up into an area where there are a large amount of sell orders, for instance, you'll see momentum slow. And we can actually pick that up objectively using the momentum properties of the MACD indicator. So I just went ahead and for a little while, every time this crossed, I missed a couple in there, But every time this crossed like significantly, I went ahead and did a vertical. And then when that vertical intersected with price, I did a horizontal. And then I colored them based on if price bounced or cut through or bounced off them to the top. And you can see this is what you get. And this is kind of amazing to look at. You're like, how can the MACD define areas of support and resistance so well? And, well, that's exactly what it's meant to do. It's looking at momentum. It's looking at the change in slope over time. So as this slope comes up, hits this resistance, and begins to curve because it's running into that, as it curves, it flips the MACD. Same thing on the bottom. So you can use a MACD as well as just some simple coding if you want to code it yourself. This is actually, well, I guess it's not simple. It's kind of a pain in the butt to code verticals and horizontals. You have to get kind of into it because you need. It's not something I'm going to do here. It would take me more time than I want to spend on this video. But you can also just kind of do it with your eyes. Like, let's just start doing it way over here. Just grab a bunch of verticals. You got 1, 2, 3. Skip these. 4, 5, 6. Then you come up in here with the horizontal ray. You got 1, 2, same place. 3, same place. And then let's color them. This top one is resistance. It's red. This one is support. It's green. This one's support. It's green. And that actually ends up turning into, I don't know if you saw that line that was extending through here. One of those green lines we just made ends up becoming this support bounced off there. So these are important lines. Like, we just drew this line randomly, right? I just drug it back and clicked a couple of random buttons. I didn't, that wasn't pre-selected. I actually used, for this line, I used this low, and then these. So, that actually was this one, my bad. Anyways, for this line here, I used these lows. So, off of, it was like one of these. I wanted to find one that was a little bit back and below it, just so they give me a reference point to show this green line. But yeah. So you can see how it works. It's actually incredibly simple, and the reason it works is actually incredibly mathematically valid. What you're doing is you're just measuring momentum. Oh, I guess that was support. So boom, boom, look at that, look at that. So the reason it works is just the MACD is just measuring momentum, and support and resistance will have impacts on momentum over time. And that's what the MACD is built to measure. So they can be used in all sorts of interesting ways. If you want to get like this, if you want to use support and resistance like this, find important levels. You could actually use the MACD or other momentum indicators to do that, which is something I don't see a lot of people doing, so I figured I'd make a video about it. Anyways, I hope you enjoyed that. I hope you found it educational. I hope you found that entertaining or educational. If you like other videos like this, make sure to check out my channel. I do all sorts of stuff like this, interesting takes on indicators, I build strategies, do TA testing, all sorts of interesting stuff along these lines. So, yeah, hope you enjoyed it. You have a nice night. In this video, I'm going to teach you about the parabolic SAR strategy, how it works, its strengths, its weaknesses. Then we'll look at a quick back test for the strategy, and then I'll show you 1 or 2 tweaks you can use to make the strategy much more interesting. All this to help you become a more educated trader and investor. Hey, I'm the Augur. I'm a stock trader and options dealer. I make videos about trading, investing, finance, and economics. And if that sounds like something that's up your alley, then take a second to click some buttons and show me some love. Help me grow the channel. So without further blather, let's get into all that fun stuff. Okay, so I've gone ahead and pulled up TradingView, and we can see the parabolic SAR strategy. So first, I'm going to talk a little bit about how it works. So the parabolic SAR strategy simply starts at any place you pick, usually at the beginning of the data set, in this case, and it just starts drawing parabolic lines. Right here, it broke that last parabolic line, so it starts a parabolic line here, based on you have an average true range setting in here that's labeled as a factor. Actually, the settings on the parabolic SAR strategy are very confusing, so I might talk about those a little bit when we go to modify it at the end. As far as how it works, yeah, it just takes an average true range, draws a dot, and then every bar it moves that dot up a little bit, and also adjusts it as it moves in that direction. So if the dot it basically, if an average true range from the close is higher than the dot would be if it moved up by a factor, it uses that one. If it isn't, it uses the factor length that you set in the settings. So like you see here where it makes that big up move, it moves up fast, and then where it's going flat, it's moving up at the parabolic setting, and then it moves up again, so it goes fast, and then the same thing here. So I hope you understand that. It's kind of crash course in how the parabolic star works, but just drawing parabolas on your chart. So one of the strengths of the parabolic star is you can see it's actually not bad. If you're a super fast trader, you can get some super fast ones out of here, but there's a lot of mess. And you guys know me already if you've seen a couple of these. I hate anything that's super messy. Anything that sends signals way too quickly is kind of annoying for me, and I'll show you why, because it usually shows in the back test when you have all these chop signals here. Well, that one wasn't terrible, but like all these chop signals here and stuff. So I guess it's kind of the strength and the weakness. The strength is like if you're looking for fast trades with trend, I mean, it's not that bad. You can get some solid ones here, right? And that's why some people like the parabolic SAR. Is it's not bad for a stop if you're using other things as entry, exit, or other stuff like that. Like it's called the parabolic SAR, and SAR stands for stop and reverse. So that's very much the original intention of the equation, is to act like a trailing stop of sorts, and that's how most people use it, as a sort of chandelier stop. So let's take a quick look at the backtest and answer the question, does the parabolic SAR strategy even work? Well, you can see set at its standard settings, it's kind of a mixed bag, right? It lost a lot at the end, but it also made some money at the beginning. But it had an awful lot of trades, like 1,300 trades over this sample size is an incredible amount when you look at some of the other indicators we've looked at. Only a third of them are profitable, exactly a third, and it lost a little bit more than it made on every trade. So it didn't even have, it wasn't even, winning that much bigger than its losses, even though that's what it kind of looked like when you take a quick peek at the indicator. You can see in trendy markets, it probably does really well, and some big wins when it catches trend. When it gets chopped to pieces, right? And it's, average bars in trade, not much at all, 12 bars. So that means it spent the entry bar thinking, closing bar thinking, so I had 10 bars to actually trade. That's a very, very tiny trade, in my opinion. So with all that being said, let's take a look at one or two ways you can modify the parabolic SAR strategy to perhaps be more interesting, maybe more beneficial to you. I don't know. You'd have to answer that question. So I've done something very simple with the parabolic SAR. I've gone ahead and slowed it down by probably about a factor of 10. And we'll go look at the settings here. So it starts off at 0.02, 0.02, and 0.2. So all I did was change those by, I guess, a factor of 20. And we get this, which is still a trend indicator, but it's much less sensitive, right? It stays in trend a lot longer, and you can see, I mean, it has some losers, it has some winners, it has some winners. That one's a good one, huh? Yeah, it has some winners, it has some losers. But you can see that it has two kinds of trades at this point. It has flattish trades, and then it has the big curvy trades. And I want you to take a second to just appreciate how long some of these curvy trades are in relative to the fat consolidation trades. Like, your consolidation trade, curvy trade. You have a series of consolidation trades, but they basically open and close around the mean. And that one was kind of rough, huh? That one was rough. So that's just a reciprocation, full reciprocation. See, you sold almost the same spot, bought the top, full reciprocation. That sucks. Sometimes you'll see those in big trendy indicators, and that's just because you're opening up your average true range. So let's look at the really interesting stuff. Let's look at the numbers, right? Because that's what everyone wants to see. So, bam, numbers. Yeah, this one stayed in trades quite a bit longer, 95 bars average, which is a solid length for it to stay in a trade, about 100 bars. If you can get above 100 bars, it's a pretty long trade, relative to what most people are doing. So I had 156 trades. Not a crazy sample size, but also it's not like 20 trades, right? It's over 100. It's a reasonable sample size statistically. It was profitable. It made some money. It's interesting. Let's dive into the numbers real deep here. So this is probably the interesting part. Average bars in winning trade, 142. Average bars in losing trade, 66, 73, 136, 148, and 59. So that gives you about an average of 100. So let's look at largest winning trade, $7,000, $1,800. Largest losing trade, 800, 700, 800. Average winning trade, 650. Average losing trade, 350. And you're winning almost 40% of your trades. So you're still losing more than you're winning, but because this is such a timed trend indicator, you can get very large wins. And that's what's going to pull it ahead. And you're definitely going to have to take advantage of that with your risk management if you're going to do something with it. Because at the end of the day, an indicator is just an indicator. Just a way to make your observations or build something around your observations that's consistent. So your risk management behind those observations, like how you take advantage of those observations with your risk management, is going to be far more important than the lines and other stuff you teach your computer how to draw to help you stay consistent in your decision making. If that makes any sense. Hope it does. So with that, I hope you learned something new about the parabolic SAR indicator, how it works, its strengths, its weaknesses, and one or two things that you didn't think it could do. Hey, thanks for watching. I really hope you enjoyed it. If you haven't already, do the clicky thing for the like button and the subscribe button, and help me grow. And then check out my other technical analysis videos. And I hope you have a great one. Ciao, ciao. Hey! In this video, I'm going to teach you about the Keltner channel strategy, how it works, its strengths, its weaknesses. Then we'll look at a quick back test of the strategy, and then I'll show you one or two ways you can tweak it to make the indicator more interesting. All this in order to help you become a more educated trader and investor. I'm the Augur. I'm a stock trader and options dealer. I make videos about trading, investing, economics, and finance. If that sounds like your thing, take a second to click some buttons and help me out. And without further chit chat, let's get right into it. Alright, I've gone ahead and pulled the Keltner channel strategy up on the screen in front of you. So the way this works is it runs off a user-defined moving average, which in this case we have it set to the default 20 with a multiplier of 2 over the 10 length ATR. So that means this chart goes back 20 bars, takes a measure for the moving average. Then it goes back 10 bars and takes the average true length of average true range of those bars, and then applies that length to the top and the bottom of the moving average to give you the top and the bottom of the Keltner channel envelope strategy. Envelope. The common thinking of this is to actually use it the opposite of the Bollinger Bands, which is interesting in its own right, since they're going to be relatively similar measures. It always interested me that someone would look at the Bollinger Bands and be like, oh, I should sell the top of this and buy the bottom of that one. And then looks at the Keltner channels, which are very similar if you set them the same way, and says, well, I should buy the top of this one and then sell the bottom. I'm like, how'd you look at the same thing on the same chart with a similar indicator and get the exact opposite? Okay, well, let's put it this way. If you want to play extensions, you use the Keltner channel. If you want to play traces, you use the Bollinger Bands. If you want to just keep them set at the default settings, let's put it that way. So that's how it works. It'll, like I mentioned, it's very similar to the Bollinger Bands in that it's just a moving average and then a high and a low plotted against it. And the way this strategy works, so the way that most people use the Keltner channels in a common strategy, is as it moves above the top Keltner channel, people will buy it, assuming it's an uptrend. And when it moves below the bottom Keltner channel, they'll sell it, assuming it's in a downtrend. And you can see how it functions. you get a win there, you got a loss there, you get a loss there. So some of the strengths of the Keltner channels, at least when you use it like this, is you see you can get some pretty interesting trend trades, right? And those might pay off. We'll definitely have to look at the back test to figure that out. But I mean, definitely hit some bangers every now and then. You got this, well, yeah, you got this one, it held all the way through that, boom. Then you got that one, boom. So it's got a couple of bangers in there, and it's got a couple of losers. So the strength is that if you use it in this way, it can be a pretty effective way to trade trend. I might combine it with something else, and we can get to that in the last section when I talk about some things you can add to the indicator and make it a little bit more interesting. But as far as strengths, yeah, it looks halfway decent for trading trend, right? We can see that pretty clearly. So what's some of the weaknesses of the Keltner channel? Well, when you have it set to 2 like this, it has a pretty high chance of getting just torn to pieces in choppy markets, right? Those actually aren't even that bad. Let's see if we can find... Yeah, here you go. Look at all of these. Oh, you made a little bit of money, and you lost some money, and then you lost some money, then you lost some money, then you lost some money, then you lost some money. Hey, you made money on that one. Then you lost some money, then you lost some money. Then you made money on that one. Then you made money on that one. So, like, you can see how when it's choppy like this, like, you'll just tear you to pieces, because in my opinion, if you're going to trade deviations or true ranges, just setting it at 2 is, I mean, so statistically speaking, there's a relatively high chance for it to make 2 standard deviations. Not super high. It's just a hair over 10%. However, I mean, that's on both sides, obviously. However, if you're looking at 1 minute bars, there's a lot of 1 minute bars in a day. It's going to happen a lot, right? if you have a like a 10% chance to trigger this on any one bar, there's going to be definitely some times where it triggers a lot. There's some times it triggers even more frequently than that, right? So I guess that's kind of the strengths and the weaknesses and how it works. This is actually a pretty good day if you trade the Keltner channel. So you had a little boom and then boom. Anyways, I'm getting off track. Let's go ahead and look at the back test. So looking at the back test of the Keltner, looking at the back test of the Keltner channel, we can see that it definitely didn't work. It's also been a choppy market, but at the same time, we had 170 samples, which is decent. Just because we held, the only reason I say that, and I've said the other ones were good at 200 to 300, was once you get down to 100 samples or less, you start to throw in a little bit of the randomness in there, right? So it might not make a difference. About 170 samples, I mean, it's worth talking about. So over 170 samples, we can see basically its performance was sort of like we expected. Lots of little losses, then you have big wins. Little losses, big win. Little losses, big win. Little losses, big win. Little losses, big loss. Losses, big win, big win, big win. Compared to all these little losses, the wins are big. However, it doesn't mean you made money. If we go to the performance summary, you can see the average win to loss ratio was only about 1.5. And since it was in a very bearish market, it was a little bit better on the short side than the long side, but still only 1.5. And you see your percentage profitable was 31%. If you're only winning 1/3 of your trades, you want to be winning at least twice as much as you're losing, if that makes sense. So what we're looking at here is, well, just to break it to you, it's a mean reversion strategy, and it's called, or it is commonly referred to by traders I know as rubber banding. And this is kind of a roughshod way to do it, but this is essentially how it works. You have 2 moving averages, or you can even use, we'll use 2 Keltner channels. That way it'll be even more interesting. Alright, this looks really funny looking, but let's talk about some rubber banding. So, rubber banding is using 2 alternating envelopes, one faster than the second, to gauge momentum as it reciprocates. So essentially rubber banding is you're taking extremes against themselves. So like, for instance, one rubber band trade would be you'd enter as this crosses up above as this envelope crosses this envelope, you're going to enter, and then it would fail as you fell back in. But the point is, it doesn't fail by much. The most you're going to lose rubber banding is the distance between the top and the bottom of the smaller envelope in most cases. And then what it does is it allows you to carry trend. So like something like this, where it breaks down here, it's like, all right, this is basically all downtrend. All this extra area here. So you probably want a separate timing indicator. This is kind of a longer term thing. So you might want a quick range cycle indicator of some sort to give you highs and lows to sell along this trend. So I'd probably call out somewhere around here, somewhere around here, somewhere around here, somewhere around here. Just like a quick stochastic or something. Same thing here. You can see this actual one was really clean. It fell, it crossed out from below there. It's in the extension area here, and it rides that all the way down. And when the price gets back up into the band at some point, that would be where you get out. It's very much a momentum strategy, and at its heart, it's a mean reversion strategy. You often see that these come up to the prior high of the slower band, if that makes sense. So you can even do it that way. I've seen people who will, like as it crosses out of here, they'll trade it to the bottom of this. As it crosses out of here, they'll trade it to the top of this. As it trades out of here, they'll trade it to the bottom of this, if that makes sense. There's a bunch of ways you can use rubber banding. It's actually it kind of takes advantage of the fractal nature of the market. Basically, for the big band to be moved, the little one has to start going first from both directions. So in most instances, this will give you it is a very clean way to read trend, right? And it's kind of hard for me to explain, I guess. But yeah, there's a million ways you can use something like this. So that's my favorite. Oh, that's a beautiful one, huh? Look at that. That's my favorite way to modify something like channels. Personally, I use a sort of channel, the kind of volatility defined channel that I plot with some pretty interesting math, but there's still, at its heart, what I do is a very similar concept to this rubber banding method, but mine is, I use a lot more code than just two equations. I wish mine was two equations long. So yeah, I hope you enjoyed that. I hope you learned something. This is actually like a secret of the pros. No one's teaching you. Hey, thanks for watching. I hope you enjoyed it. If you haven't already done the clicky thing to help me grow, go ahead and do that for me, and then check out my other technical analysis videos. And I hope you have a great one. Hey, in this video, I'm going to teach you about the slow stochastic strategy, how it works, its strengths, its weaknesses. Then we'll look at a quick back test. Then I'll show you one or two tweaks you can do to make the indicator more interesting. All this to help you become a more educated trader and investor. I'm the Augur. I'm a stock trader and options dealer. I make videos about trading, investing, economics, and finance. If that sounds like your thing, take a second to click some buttons and help me grow. And without further blather, let's get into the fun stuff. So I've gone ahead and pulled up the slow stochastic strategy on the chart here. So the slow stochastic strategy works by running a 14th length stochastic with two sets of slowing on it. And it basically uses this as you would like a MACD or any other sort of moving average line, where it crosses back and forth and it takes those as signal. Now it has two lines on it, the top and the bottom, which the indicator considers overbought and oversold. However, I take my own issues with that. But for as far as how this works and how the strategy is set up on TradingView, that's how it works. And to show exactly how it works, once it comes up and then there's a cross above the overbought area, it's a sell signal. And then when it comes down and it's a cross up below the oversold area, it's a buy signal. And it just keeps doing that. You can see here one of the strengths, or I guess the strength of the slow stochastic strategy. It works very well in range-bound markets because that's exactly what the stochastic's doing. It's just measuring price against itself over time. So it's going to plot similar highs and lows as the last one. And sometimes it works, sometimes it doesn't. I can see there, it definitely didn't work. There it worked, there it worked, there it didn't work. There it worked, there it worked, there it worked. So like a lot of these other bounded indicators, when you use them this way, you can see that when your wins are wins They're, small, but you see a decent bit of them, right? And when you have losses, sometimes they're pretty significant. And that would be the weakness of the slow stochastic strategy, that oftentimes it encounters very large losses. So you'd have to build a way into your strategy to mitigate those losses. So let's take a quick look at the back test on this sample and see how the slow stochastic strategy did. To answer the question, does the slow stochastic strategy actually work? So I've gone ahead and brought up the back test for the slow stochastic strategy, and we can see quite plainly it just does not work. It just generates lots and lots of losses. To be simple, running a quick stochastic, buying the top or buying the bottom and selling the top doesn't work. But this is a two-sided market, so when something definitely doesn't work, that implies something else, and I'll let you take your own I'll let you draw your own conclusions from that. So what's something we can add to the slow stochastic strategy to make it maybe more interesting and useful? I've gone ahead and thrown a 100 period moving average on the chart, this white line, and you can see pretty plainly what I'm about to talk about. So when the moving average is going down, indicating a downtrend, and your slow stochastic is set much faster than your moving average length, your odds of winning shorts are increased. And if you don't, you know very quickly, either by the stochastic stopping out or the moving average changing direction. This isn't an exact science, and would be kind of difficult to make into an objective trade. You would perhaps have to build in some sort of trailing stop metric, or just a set stop metric, but something to reduce your risk, because that 100 period moving average is kind of slow, and you never know what happens in the market. Something, dramatic can happen like this, where you feel like it's going down, so you take that. Well, I guess that's a bad example, but you know what I'm saying. Like, you could get hurt by it kind of jumping up fast on you. Let's say you took this trade and it was going down, and something really newsworthy came out, like this could explode, and then you would need something to probably tell you, hey, get out before this goes to the freaking moon, right? That's just kind of the idea there. That's kind of just in general what I'm thinking about. It's not really part of the video, I guess. Alright, well, with that, I'm going to go ahead and wrap it up, and I hope you enjoyed this one. Make sure to check out the rest of them. This format seems to be getting good reception, so I'm going to keep putting these out. Thanks for watching. I hope you enjoyed it. If you haven't already, do the clicky thing to help me out, and then check out my other technical analysis videos. And I hope you have a great one. Hey there, YouTube. I'm the Augur. Today we're going to talk about the super trend indicator strategy and answer the question, does it really work? If you're new here, I'm a stock trader and options dealer. I do videos about my trading, my business, options, stocks, finance, economics, all that sorts of fun stuff. So make sure to hit the like button and we'll jump right into it. So I've gone ahead and pulled up the super trend indicator strategy on TradingView here, and let's take a look at it so we can answer the question, does the super trend indicator strategy actually work? Well, you can see that off the bat, for its strengths, for the pros of the super trend indicator strategy, it can work very well in trendy market. That one was pretty good. That one was pretty good. That one was pretty good. You had a winner there. You had a winner there. So on the surface, this looks like a very productive indicator. Let's talk a little bit about how it works. What this indicator does is it works by going back a certain length of bars, going from the highest point or the lowest point, taking a standard deviation, and then using that as a trailing stop of sorts. So on this bar, this is 3 standard deviations, and every time it moves up to make a new high, it's going to move this line up a little bit. It's a simple indicator, but some people say it's an effective indicator. So let's talk about some of the cons, some of the weaknesses to the super trend indicator strategy. That's a great one right here. In reciprocative markets, in choppy markets, it kind of doesn't work very well. You see, you sold there, like you sold the bottom down here, you bought the top up here, you sold the bottom down there, you bought the top there, you sold the bottom down there, and you bought the top there before one actually worked for you. So the question is, are all these little losses offset by these big runs? And let's find out. So hopping on over to the strategy summary, we look at the back test. This was a solid sample at 392 closed trades. 35% were profitable, It was almost a straight even profit factor, and we lost net $500, which is nothing because this thing's trading futures. So this thing basically didn't make money and it didn't lose money, which actually makes a lot of sense when you think about how the market works, right? A lot of, let's say, trailing stop indicators that are very basic will be net zero, because the chances in most cases that the market reverses some movement is on average about the same either way. So like the likelihood that it moves up 30 cents is about equal to the likelihood that it moves down 30 cents, if that makes sense. So if your indicator is set, let's do one like here. So if your indicator is set to 3 standard deviations, that happens to be 30 cents. So the chances it moved up 30 cents to trigger this indicator are about equal to the chances it should move down to trigger the indicator on the other side. So that's why it comes out net zero, if that makes sense. If not, post a specific question in the comments. I'll follow up with some more detailed information on the mathematics behind that. So that's the super trend strategy, the way most people use it. Now let's see if we can tinker with this thing a little bit to make it work a little bit better. So I've go ahead and modified the super trend. So now it looks really weird. We've turned the super trend into a series of super trends. And this is going to get hard to understand quick. So I'm going to try to explain it. And if you use one super trend as a longer length, triple, double, triple, something like that, than the first one, what you end up with is split signaling. So we know the super trend will end. We know the average length of the longer one because we have 300 samples or so of that. So what you do is you try to use the faster super trend to tell you when the longer super trend is getting weakened and starting to be attacked. So like in this one, that would be your entry, your exit would be where it hit here. This would be your entry, your exit would be here. And what this does, if it doesn't make sense right off the bat, is it gives you a, like on this short right here. Anyways, what this gives you is this gives you a stop and a target. Now this is still going to be relatively net zero, but because of the duration component of it, it will spend an equal amount of time, like over all trends, either arguing or confirming with itself. So basically, you know that for this bigger one to end, this one has to end first. So anyways, that's one way you can modify a super trend strategy to be more effective or to work inside of your preferred time frames better. This will effectively cut down the hold time to 1/3, and it will increase your success rate. At its heart, this is a mean reversion strategy. It's expecting that if it has deviated this far over this time and it has come back at least halfway, the likelihood of it reverting all the way to the mean is higher than it extending further, because over the last 300, 400, 500 samples, all of these trends have an average length less than the total combined length of this and that, if that makes sense. If not, again, post more specific questions. I'll see what I can give you as far as specific answers. Anyways, I hope that answers the question. Is the super trend strategy a useful indicator? Does the super trend strategy actually work? Question, like all the other ones, is yes and no. It depends how you use it. Depends on how well you know how to use it. Depends on what circumstances you're using it in. Depends on your own personal style and risk management and all these other things, right? But I hope it was informative. I hope you learned something. And I hope that this helps you become a better trader and investor. Thanks for watching. Hope you enjoyed that. And I hope that you learned something. If you liked that video, make sure to like it. And subscribe to my channel for more stuff like it. And yeah, I guess that wraps it up. You guys have a great day. Howdy partners! In this video I'm going to talk about the Bollinger Band strategy. Talk a little bit about the Bollinger Bands in general, how they work, what they look for, and then we're going to answer the question, does the Bollinger Band strategy work? If you're new here, I'm the Augur of Avon. I do videos about trading, finance, economics, stuff like that. So without further chit chat, let's get right into it. Alright, so I brought the Bollinger Band strategy up on TradingView. You can see the basic idea. It comes up and touch the top, and it comes up and touch the bottom. Buy at the bottom, you sell at the top, etc., etc. Now there are pros and cons to this strategy. You can see some of the pros right here when the market is chopping back and forth inside of a range. It works very well. The Bollinger Bands do a good job of measuring that range and telling you what the tops and bottoms would be as long as they are the same as before. The Bollinger Band works by drawing an average line through price, and it does that simply by taking price, the close of each bar, and running a moving average of them. And then top and the bottom lines are standard deviations. So it looks at the difference between, the average and the bars. So that's how it works, and it's a strength of it when it does work. So let's look at some of the cons to the Bollinger Band strategy. Here's a good example of one of the cons of the Bollinger Band strategy. As price wants to extend outside of the current trend, it will tend to ride the standard deviation either up or down in a continuous manner. And that's what a trend is. A good way to think about a trend is just continued deviation to one side or the other. So that's exactly why you would see this on the chart. So in trendy markets, the Bollinger Band strategy is not as effective, unless you're betting with trend, of course. So you can see it bought there. It's all day to hold. That's some choppy markets. Did okay there. But like right here, see that? That was a really bad one. That's the point. So the con of the Bollinger Band strategy, its weakness, is often your losers can be much larger than your winners. So you'd have to find a way to mitigate that to actually use it effectively in some form of strategy. Let's answer the question, does the Bollinger Band strategy actually work? So you can see the results of the Bollinger Band strategy, and this displays pretty much what I was talking about before when it's used in this way. When you're winning, it's going to be lots of small wins. 61% of your trades were profitable. And your profit factor was a little bit less than 1. So that means that your losers were a good deal larger than your winners. So your average trade was -6. So, and you can see that. You can see there were some really big drops in this chart where the strategy took its losses. You could do something simple like add a stop. However, that will increase your number of losses overall. So it actually might not be as simple as that. To make an actual working strategy, I feel like you usually need at least 3 components of it. You need an entry, you need an exit, and you need a timer component. And I feel like using any one of these individually is a great way to get into trouble. So I think that should answer the question, does the Bollinger Band strategy work? We have a pretty decent sample here, 298 trades, and it lost a little bit of money. The point is it didn't consistently generate returns. In a back test, you're looking for consistent return generation. You're not looking for something that chops back and forth over the 0 line in any measure, especially over 300 trades. That's just a little, it just doesn't work. I hope that didn't come as too much of a surprise to anyone that something as simple as throwing a Bollinger Band on there at 20 length and buying the top and selling the bottom didn't make money. But it didn't make money. Anyways, if you like this video, make sure to pound it like it's the ask button and you're trying to trade the RSIs. It just trades down and down and down and down and down. And subscribe to my channel for more. Thank you. You have a great night.
Hey traders, today we're diving into the fascinating world of technical analysis with a focus on TradingView's RSI strategy. The Relative Strength Index, or RSI, is a powerful tool used by traders to gauge the strength and momentum of price movement. In this video, we'll be exploring the ins and outs of the RSI strategy. We'll walk through some common settings, how to put it through the test on some back testing Bitcoin's 1-minute charts. So to kick things off, let's demystify the RSI with a walkthrough of RSI strategy. It's a momentum oscillator that measures the speed and change of price movements, typically ranging from 0 to 100. The RSI helps traders identify overbought or oversold conditions in the market. Now let's delve into the common RSI settings. Traders often tweak parameters like period, length, and other stuff to align the RSI with their trading preferences, seeking optimal signals for buying or selling. Now comes the exciting part, looking at some backtesting examples. Backtesting the RSI strategy on Bitcoin's 1-minute charts, we compiled a montage of key moments, showcasing trade entries, exits, and the overall flow of the strategy and actions. As we watch these snippets, pay attention to how the RSI reacts to dynamic markets. As we wrap up the backtesting phase, let's take a moment to digest the results. On Bitcoin's 1-minute charts, the RSI strategy didn't show stellar performance, ending up fairly flat after 100 trades. It's crucial to understand these outcomes to make informed decisions about integrating the RSI strategy into your trading arsenal. Now let's talk about some pros and cons of the RSI strategy. On the positive side, the RSI can be a robust tool for identifying potential trend reversals and market entry points. Traders often find success in aligning the RSI signals. However, any strategy is often met with limitations. The RSI may not perform as well in certain market conditions, and false signals can definitely occur, leading to suboptimal results. It's essential to consider both sides of the coin. So in conclusion, as we wrap up today's videos exploring the RSI trading strategy, remember that no strategy is foolproof. The RSI is a valuable tool, but it requires a nuanced understanding and careful consideration. I encourage you to share your thoughts and experience with the RSI strategy in the comments below. Happy trading, and I'll see you in the next video. Thanks for watching. Bye. Hey, welcome to TQFM Trading Strategies, your channel for all sorts of trading strategy stuff. My name is T, and today we're going to be talking about the Stochastic Momentum Index. TradingView recently added it to their list of standard indicators, so I figured I'd go ahead and make a video about it. So make sure to watch to the end so you don't miss any of the great details about how to use the Stochastic Momentum Indicator in your trading, if it might help you, if it might not, and look at all sorts of testing and backtesting examples. And either way, we'll both learn something about the markets from watching it go. So, with all that being said, let's get right into it. And I'm going to have my buddy Freddy the Robot explain a little bit about the Stochastic Momentum Indicator, and then we'll go over how to use it in the trading strategy and the backtesting.
The Stochastic Momentum Indicator, SMI, is a powerful tool widely used in technical analysis and trading strategies to gauge the momentum of a financial asset's price movement. It combines elements of both the stochastic oscillator and the moving average to provide traders with insights into potential trend reversals and overbought or oversold conditions. At its core, the SMI measures the relationship between an asset's closing price and its price range over a specified period. It typically consists of two lines, the SMI line and the signal line. The SMI line represents the difference between the closing price and the midpoint of the price range, while the signal line is a moving average of the SMI line. The calculation of the SMI involves several steps. Calculate the typical price, TP, for a given period, usually 14 periods, which is the average of the high, low, and closing prices, TP equals high plus low plus close, /3. Compute the difference between the current closing price and the in-period midpoint of the price range, where N is usually 14 periods. Equals. Minus. Plus. 2. Difference equals close minus. 2. Highest high plus lowest low. Normalize the difference to a percentage of the price range to ensure consistency across various assets and time frames. Equals. Price range times 100. Raw SMI equals price range difference times 100. Apply a moving average, signal line, to the raw SMI to smooth out fluctuations and generate trading signals. A common choice is a 3-period exponential moving average, EMA, of the raw SMI. The interpretation of the SMI involves identifying key thresholds, typically at 0 and plus or minus 40, which indicate potential buy or sell signals. When the SMI crosses above the zero line from below, it suggests a bullish momentum shift, signaling a potential buying opportunity. Conversely, when it crosses below the zero line from above, it implies a bearish momentum shift, signaling a potential selling opportunity. Additionally, extreme SMI readings beyond plus or minus 40 often indicate overbought or oversold conditions. An SMI above plus 40 may indicate an overbought market, potentially signaling a reversal or a pullback, while an SMI below minus 40 may suggest an oversold market, indicating a potential rebound or reversal in price. Traders and analysts commonly use the SMI in conjunction with other technical indicators and analysis techniques to confirm signals and make informed trading decisions. However, it's essential to note that like any technical tool, the SMI has its limitations and may generate false signals in certain market conditions. As such, risk management and validation through multiple indicators or analysis methods are crucial when using the SMI for trading purposes.
Hey guys, what's up? I'm back. Hope you enjoyed the robot and watching the back test. This is the results of all the trades. We made about $1,300 on 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, about 50 trades. On Bitcoin, I'm just doing some back testing. So the way I pulled this up is I went on over to the down here, stochastic momentum indicator on TradingView, loaded that up here. I didn't modify these at all, I left them as is. And for this back test, all I was doing for this strategy was buying it when it broke above the top, and I closed the trade when it broke back below. If it broke back down below, if it broke below the bottom, I would sell it, and if it broke back above this line, I would buy it back. And I just did that over and over. You see, it definitely had some choppy areas. It did a pretty good job on this trend here. I probably could have played that better, but it did pop back above here. Yeah, it's some good runs. It got that pretty good there. This one, that's particularly impressive up in here, huh? Buying down here at these lows, buying here, selling there, buying there, selling there, selling there, buying there, selling there, buying there. Pretty good. Yeah. Overall, a decent back test. I would go ahead and back test this on your own ticker and time frame. See if it'll help you out. I hope you guys learned something from watching this video, and I hope you enjoyed it. Thanks for watching. Watch the rest of my videos. Take care, guys. Like and subscribe. Bye.
Welcome back to TQFM Trading Strategies. It's always a pleasure to have you here with us. If you're new here, we discuss and test technical analysis-based trading strategies and talk about the markets. So if you're into that, make sure to subscribe to the channel for more valuable trading content. Today, we're about to embark on an exciting journey into the world of cryptocurrency trading. So, grab your favorite trading notepad and let's get started. In this video, we've got something special lined up for you. We're going to explore a powerful scalping strategy that harnesses the incredible potential of not one, not two, but three dynamic indicators, the Heikin Ashi, Ichimoku, and alligator indicators. And we're going to put this strategy to the test on none other than Bitcoin's wild 1-minute price data. Now, if you've ever wondered how to navigate the lightning-fast world of cryptocurrency trading, this video is tailor-made for you. These indicators, when used in combination, can provide you with a scalping strategy that's not just effective but also precise. But before we dive headfirst into the action, let's take a moment to understand each of these indicators and why they're such a game changer. So, whether you're a seasoned trader looking to refine your strategy or a newcomer eager to learn, you're in the right place. So, without further ado, let's unpack the magic of Heikin Ashi, demystify the Ichimoku cloud, and learn to ride the alligator's momentum as we explore this fascinating scalping strategy. Stay tuned because by the end of this video, you'll have a clear roadmap to potentially unlock profitable trades in the blink of an eye. Alright, folks, let's not waste any more time. The crypto market waits for no one. Are you ready to take your trading to the next level? Let's do this. Now, before we delve into the nuts and bolts of our Heikin Ashi Ikimoku alligator indicator combo, it's crucial to grasp why scalping is a must-have technique in the cryptocurrency trading arena. Cryptocurrency markets are known for their incredible volatility. Prices can swing dramatically in a matter of minutes, and that's where scalping comes into play. Scalping is all about making quick, small profits by capturing these rapid price movements. But, and this is a big but, it's not as simple as it may seem. Attempting to scalp without a well-thought-out strategy is like trying to navigate a stormy sea without a compass. It's risky, and you might find yourself adrift. This brings us to the core of today's video, the need for a reliable strategy. In the fast-paced environment of cryptocurrency trading, a strategy acts as your guiding star, helping you navigate through the chaos with confidence. Imagine having a set of tools and techniques that not only help you identify potential entry and exit points, but also allow you to manage risk effectively. That's what we're offering you today. By combining the power of Heikin Ashi, Ikimoku, and the alligator indicator, you'll gain the ability to read the market with greater precision, increasing your chances of making profitable trades even in the most turbulent conditions. So, by the end of this video, you'll not only understand how these indicators work, but also how to integrate them seamlessly into your trading strategy. It's like having a weather forecast for the crypto market, allowing you to set sail with confidence even when the waters get rough. Now that we've established the significance of scalping and the need for a solid strategy, let's roll up our sleeves and dive into the fascinating world of Heikin Ashi, Ikimoku, and alligator indicators. Alright, let's start by shedding some light on Heikin Ashi candles. These are not your everyday candlesticks, folks. They have a unique way of smoothing out price action, making them an invaluable tool for traders. So, how do Heikin Ashi candles differ from traditional candlesticks? Well, the key distinction lies in their construction. While traditional candlesticks rely on open, high, low, and close prices, Heikin Ashi candles take a different approach. Heikin Ashi candles are calculated based on the average of the open and close prices, which creates a smoother and less noisy representation of price action. This means they react more slowly to price changes, reducing false signals and noise. Now, let's talk about the default settings. When we use Heikin Ashi candles, we typically don't need to adjust any settings. The default settings work perfectly for our scalping strategy. So, no need to worry about tweaking anything there. Moving on to the Ikimoku Cloud, this indicator is a game changer in the world of technical analysis. It's like having a multidimensional view of the market's past, present, and future. The Ikimoku Cloud is composed of several elements, each with its own role in helping us make sense of price action. Let's break it down. First, we have the Tenkan-sen, which is often referred to as the conversion line. It represents the average of the highest high and lowest low over a specified period. Next, we have the Kijun-sen, or the baseline. It's similar to the Tenkan-sen but calculated over a different period, providing a different perspective on price momentum. Now, the Senkou Span A and Senkou Span B together form what's known as the cloud. These two lines project into the future and act as support and resistance levels. And last but not least, we have the Chikou Span, which is essentially the current closing price plotted backward on the chart. It helps us gauge potential areas of support and resistance in the recent past. And just like with Heikin Ashi candles, we're sticking with the default settings for the Ikimoku Cloud in our strategy. These settings have been carefully chosen to align with our scalping objectives. Now, let's sink our teeth into the alligator indicator, which might sound ferocious, but it's actually your ally in the crypto jungle. The alligator indicator consists of three components: the jaw, the teeth, and the lips. These intriguing names represent the different moving averages and their relationships. The jaw, represented by a blue line, is the slowest moving average and corresponds to the 13-period smooth moving average, SMA, at the midpoints of the price bars. Next up is the teeth, depicted by a red line. It's a bit faster and corresponds to the 8-period SMA at the midpoints of the price bars. And finally, we have the lips, which is the fastest of them all. The lips is represented by a green line and corresponds to the 5-period SMA at the midpoints of the price bars. But here's the beauty of it. Just like with our other indicators, we're sticking to the default settings for the alligator. These settings are finely tuned to our scalping strategy. So, there you have it, a crash course in the key indicators we'll be using in our scalping strategy. Now that we've got the basics down, let's combine them and unleash their power in the world of Bitcoin 1-minute data. Alright, traders, now it's time to dive into the heart of our scalping strategy. In this section, we'll break down the core concept, entry points, and the all-important risk management aspect. Our strategy's core idea is relatively straightforward yet incredibly effective. We'll be hunting for trading opportunities when the alligator indicator opens up its jaws and starts moving above the Ichimoku cloud. Now, why is this concept so powerful? The logic is simple. When the alligator indicator awakens from its slumber and starts moving above the Ichimoku cloud, it signifies a potential shift in market sentiment. This could signal the beginning of a strong bullish trend or a reversal from a bearish trend. But, and this is crucial, we don't just dive in blindly. Risk management is our guiding principle. We'll emphasize it throughout this video because, in the fast-paced world of scalping, protecting your capital is paramount. So, how do we identify those entry points that align with our concept? Let's break down the criteria for entering a trade in detail. First, we'll look for a bullish entry signal. This occurs when the alligator's jaw, teeth, and lips cross above the Ichimoku cloud. This alignment suggests a potential bullish momentum. Conversely, for a bearish entry, we wait for the jaw, teeth, and lips of the alligator to cross below the Ichimoku cloud. This signals a possible bearish trend. But here's the kicker, we don't rely solely on these crossings. We emphasize confirmation. This means we look for additional signs of strength or weakness in the market, such as candlestick patterns or support and resistance levels. Remember, scalping is all about precision, and confirming the alligator's move with other technical factors increases our confidence in the trade. Now, let's talk about the unsung hero of trading risk management. In the world of scalping, it's not just important, it's absolutely vital. Here's why. Scalping involves making numerous quick trades, and not every trade will be a winner. That's where risk management steps in to protect your capital and ensure you're in the game for the long haul. To manage risk effectively, you need to set stop loss and take profit levels. The stop loss is your safety net. It's the price at which you'll exit the trade if it goes against you. Always place your stop loss orders to limit potential losses. On the flip side, the take profit level is where you lock in your profits. This is the price point at which you'll exit the trade when it's moving in your favor. It's essential to set a take profit level to secure your gains. But, folks, here's the golden rule of risk management: maintain a favorable risk-reward ratio. In scalping, aiming for a risk-reward ratio of at least 1 to 2 is a good starting point. This means that for every dollar you're willing to risk, you should aim to make at least $2 in profit. By sticking to this principle, you can afford to be wrong in some trades and still come out on top in the long run. So, remember, our scalping strategy isn't just about spotting opportunities, it's about safeguarding your capital and ensuring your trading journey is a sustainable one. Now that we've laid down the fundamentals of our scalping strategy, it's time to put theory into practice. Stay tuned as we move on to the practical application segment, where we'll demonstrate how to set up and test this strategy on Bitcoin 1-minute data. Get ready to witness these indicators in action. It's about to get exciting. Before we dive into the practical application of our scalping strategy, let's talk about a crucial step in any trading approach: backtesting. Backtesting is like a crystal ball for traders. It allows us to peer into the past and see how our strategy would have performed under different market conditions. It's not just important, it's absolutely essential. Now, let's take a moment to put our strategy to the test. We'll show you the results of running this scalping strategy on historical Bitcoin 1-minute data. This step isn't just about showing off. It's about gaining confidence in your strategy and understanding how it performs in different market scenarios. Once you've entered a trade using our scalping strategy, the next crucial step is monitoring it effectively. Keep a close eye on the price movement and market conditions. Here's when you might consider adjusting your stop loss or even taking early profits if the trade is moving in your favor. Speaking of exits, let's discuss the criteria for exiting a trade. It's just as important, if not more, than the entry. Your exit criteria should be clear and well-defined. It could be hitting a predetermined take-profit level, seeing a reversal signal, or any other factor that aligns with your strategy. And remember, discipline is key when exiting trades. Don't let emotions drive your decisions. Stick to your plan. To wrap things up, let's recap the key points of our scalping strategy. We've covered the importance of combining Heikin Ashi, Ikimoku, and alligator indicators, identifying entry and exit points, and the absolute necessity of risk management. But here's the golden nugget: practice and discipline are your allies in this journey. It's not about a single trade, it's about the consistency and mastery of your strategy. We're almost at the finish line, but the conversation doesn't end here. I want to hear from you, our amazing viewers. If you have any questions or want to share your trading experiences, don't hesitate to drop a comment below.
And here's a friendly reminder: before you dive into the live markets with this strategy, practice, and practice some more. Consider using a demo account to hone your skills and build confidence. Thank you for joining us today on this exciting journey through the world of scalping with Heikin Ashi, Ikimoku, and the alligator indicator combo. Your support means the world to us. If you found this video valuable, please show your appreciation by hitting that like button, subscribing to our channel, and ringing the notification bell. It helps us keep creating content to empower traders like you. And remember, your success in trading is a journey, not a destination. Keep learning, keep refining your skills, and keep your discipline intact. Until next time, happy trading!
Hey, what's going on YouTube? It's TQFM Trading Strategies, again with another trading strategy. We're going to be covering a Bollinger Band double trading strategy today. We're going to set that up. We're going to go to Community Scripts, Financials, Technicals. We're going to go find the Bollinger Bands. So one Bollinger Band. We want two Bollinger Bands. We're going to be doing it on Bitcoin. So we're going to look at the first Bollinger Band. It's going to be 20 with 2 standard deviations. We're going to generally leave that one alone. Let's go ahead and cover the upper and lower one white. And we can go ahead and get rid of the basis. We don't really need the basis. And we'll go for the second one here. This one, we're going to triple. Let's go to 60. In the style, let's make this one black and black. And we're going to make this black. And thick. Then what we're going to do is we're going to take this and we're going to move this behind the other one. Then we're going to take this one, now we're going to move it behind the other one. And we're going to go ahead and take this, and I want to change the background to white. Alright, now we got this. This looks super silly, but watch what we're about to do with it. The goal of this strategy is to take advantage of runs in the marketplace using a double Bollinger Band. So we can go like right back to this here. Oh, I see it's starting to pop up out of here. So we can buy one of those. And then we'll watch it. It's going to trade. Keep watching it. We can still see the bars and everything. Alright, it's back under that cloud there. So you give it a second. It's probably done. So you go ahead and sell it. And it's the sort of trade you're looking for. We're going to go ahead and back test this a couple dozen times to get a good sample size. Then we're going to talk about how the strategy works, what works about it, what doesn't work about it, and how to use it in your own back testing to see if you like it. At the end of the day, a double Bollinger Band strategy didn't perform very well on this back test and lost us about $2,000 testing on Bitcoin in 1 minute strategy. I hope you guys enjoyed the video and learned something from this. Make sure to check out the rest of ours. Thanks. You have a great night. Bye.
Welcome to TQFM Trading Strategies, your go-to destination for exploring innovative and effective trading techniques. Today, we're diving into the fascinating realm of the double median indicator trading strategy. Whether you're a seasoned trader or just stepping into the world of financial markets, understanding reliable trading strategies is paramount. The double median indicator is an intriguing approach that we'll be exploring today. It's gained attention for its potential to identify trends, gauge market sentiment, and aid in decision-making. In this video, we'll unravel the inner workings of the double median indicator, exploring how it's calculated, its applications in different market conditions, and most importantly, we'll put it to the test. By the end, we'll have a clearer view of its strengths and weaknesses, helping us determine if it's a valuable addition to our trading arsenal. Stay tuned as we dissect the double median indicator, examining its intricacies and conducting live market analyses. But first, let's understand the fundamentals and rationale behind this intriguing trading strategy. So, grab your notepads, buckle up, and let's delve into the double median indicator trading strategy. Don't forget to hit the subscribe button and ring the notification bell, as we'll be unraveling more exciting trading strategies in our future videos. Now, let's get started. Explanation of median and moving average. The median and moving average are both widely used statistical indicators in trading, offering insights into market trends and smoothing out price data. While they share similarities in their objective of indicating the underlying trend, their calculation methods and resulting interpretations differ significantly. The moving average, a common tool in technical analysis, calculates the average price of a security over a specified period, smoothing out fluctuations and highlighting the trend's direction. It's calculated by summing up a set number of closing prices and dividing them by the chosen period. This method is effective at reducing noise and providing a clear trend direction. On the other hand, the median indicator determines the middle value in a dataset when arranged in ascending or descending order. Unlike the moving average, which considers all values equally, the median focuses solely on the middle value, disregarding extreme highs or lows. It's robust against outliers and can offer a more stable representation of the central tendency in the data. Description of double median indicator strategy. For our double median indicator strategy, we'll utilize two median indicators within TradingView. The first median indicator will remain at the default setting with a length of 3, acting as the faster-moving component in our analysis. This quicker indicator responds swiftly to price changes, capturing short-term fluctuations in the market. The second median indicator, set to a length of 21, serves as the longer-term component in our strategy. This indicator aims to provide a broader perspective by considering a more extended period of price data. The 21-length median indicator is comparable to a longer-term moving average in a traditional moving average strategy, yet it operates based on median calculations rather than means. By employing these two median indicators with different lengths, we aim to create a comprehensive view of the market, leveraging the quicker indicator for short-term trends and the longer-term one for a broader assessment of the overall trend direction. In essence, while the double median indicator strategy employs settings reminiscent of a traditional double moving average strategy, the crucial distinction lies in the use of median indicators instead of moving averages, offering a unique perspective on market trends with a focus on robustness against extreme price movements. Implementation of the double median indicator strategy. Our application of the double median indicator strategy revolves around a trend-following approach, seeking to capitalize on the alignment of both shorter-term and longer-term trends in the market. When both the longer-term 21-length and shorter-term 3-length median indicators signal a bullish trend simultaneously, it triggers a potential buy signal. Conversely, a sell signal is generated when both indicators align in a bearish direction. The strategy's buy signal occurs when the shorter-term median indicator indicates a bullish trend, supported by the longer-term median indicator also signaling a bullish trend. This alignment suggests a strengthening upward momentum in the market, prompting a potential entry point for a long position. Conversely, the sell signal emerges when both median indicators turn bearish, indicating a potential downturn in the market. This alignment signals a potential exit point for an existing long position or a potential entry for a short position, depending on the trader's strategy. Pros and cons of the double median indicator strategy. Pros. Objective trend confirmation. The strategy relies on clear buy and sell signals generated by the alignment of two distinct median indicators, providing a more objective confirmation of trends. Robustness against noise. Median calculations are less affected by extreme outliers compared to traditional moving averages, potentially offering a more robust representation of the trend. Simplicity. The strategy's rules are relatively straightforward, making it accessible to traders of varying experience levels. Cons. Potential delay in signals. As a trend-following strategy, the double median indicator strategy might exhibit a delayed response to rapid market changes, potentially missing early entry or exit points. Whipsaw in choppy markets. During choppy or sideways market conditions, the strategy may generate false or conflicting signals, leading to losses or frequent trades without significant gains. Risk of trend reversals. Relying solely on trend alignment might expose traders to the risk of missing potential trend reversals, especially in volatile markets where trends can change abruptly. While the double median indicator strategy offers a systematic and straightforward approach to trend following, traders should exercise caution, combine it with other indicators or analysis techniques, and adapt it to suit varying market conditions and risk appetites to mitigate its limitations and maximize its strengths. Closing thoughts on the double median indicator strategy. As we conclude our exploration of the double median indicator trading strategy, it's crucial to underscore the significance of two fundamental pillars in successful trading: risk management and diligent research. While the double median indicator strategy presents a structured and systematic approach to identify potential trends and trading opportunities, it's imperative to emphasize the paramount importance of risk management. No strategy is foolproof, and prudent risk management strategies are the bedrock of sustained success in the markets. Employing techniques such as setting stop-loss orders, diversifying portfolios, and sizing positions appropriately are critical to mitigate potential losses and preserve capital. Furthermore, conducting your due diligence is indispensable. Backtesting any trading strategy, including the double median indicator approach, helps you understand its historical performance under various market conditions. This process enables you to assess its strengths, weaknesses, and overall viability before implementing it with real capital. Remember, a strategy that works exceptionally well in one market phase might falter in another, underscoring the importance of adaptability and continuous evaluation. Lastly, every trader's journey is unique. While educational resources and strategies like the double median indicator can provide valuable insights and tools, your trading decisions should align with your risk tolerance, financial goals, and personal circumstances. Always supplement any strategy with your analysis, understanding, and intuition about the market. In conclusion, the double median indicator strategy serves as a valuable addition to a trader's toolkit, offering a structured approach to trend following. However, success in trading demands a holistic approach that encompasses risk management, due diligence, and adaptability. By incorporating these principles into your trading journey and continuously refining your strategies, you pave the way for more informed, confident, and potentially profitable trading decisions. Thank you for joining us on this journey into the double median indicator strategy. Remember to stay curious, stay informed, and trade responsibly. Happy trading!
Hey, in this video we're going to be looking at the double CCI strategy. It's one that commonly used in a similar sort of way to look at the market, or breaking up trends inside of trends and looking at the momentum inside of them. So without further ado, I'm going to go ahead and explain how the indicator works, the settings for the indicator, then we're going to run a 100 sample back test, and I'll meet you guys back with the results, and we can see if the indicator and the indicator strategy is effective or not, and if it's something you might want to use or think about when trying to become a better trader. Alright, so let's start with how this works. It runs off two CCI indicators, which is a commodity channel index, which is just a moving box. And we're going to set them up in a special way using some special settings. So here you go. The first one, this is going to be the longer term one, or we color the moving average red. You want to set the length for 150, then you want to set up the simple moving average for 100. And then you want to color red off. The faster CCI, that we're going to color green. You're also going to set the length for 100, but this time we're going to select the simple moving average and we're going to set it for 30. So you have a staggered one. You have this length set at 150 with the simple moving average at 100, and you have this one with the indicator itself set at 100 with a simple moving average of 1/5 of what total length is on this one. So that's what we call a 1:3:5 ratio, and you can take this and go ahead and color it red. So it's a very simple indicator. Now that we've set it up, you buy it when it crosses and you sell it when it crosses back over. You sell it when it crosses, and you buy it when it crosses back over. You can probably add some things to this to, make it more efficient, to optimize it. If you want to add a quicker cycle in there, a stop loss, yada yada, you might be able to make it a little bit better. But for this video, and just to understand how the strategy works and its basic function, we're just going to run it like this. This is more set up for a continuous chart, but it'll work fine for something we get. So with all that being said, let me go ahead and hop right into the back test. Alright, I'm back with a back test, and it made some very interesting results. So let's take a look at them. You can see that here we started with $5,000, took 100 trades, we won 46, we lost 50. That means we won 46%, but we made some money. So how do we do that? Well, it ran for a long time, and our winners were about twice as big as our losers, a little bit bigger than that. And if you look at the really interesting P&L chart here, we had lots of small losers and then some big winners mixed in there, and they're mixed in there evenly enough that you see them relatively often, and that has to do with trend and stuff like that. So this is just the market battling back and forth, and then it starts to break out, and you're usually on the right side. It keeps battling, and you're usually on the right side. Whether it's up or down, it usually gets you into a break in one direction or another with some, minor difficulties in there, depending on how you do it. This is actually very similar to the way that I do a lot of my trading, and this allows me to do some sort of interesting scaling and stuff like that, where when I lose trades, I get larger, but not larger by much, where, I bet, 100, then like 105, then 110, then 120. Then when I get a big win, I reset, and that's sort of how I do it. And I start off, betting a very small amount of my overall cap. So that's basically how I do risk management on a very similar strategy to this. Mine's a little bit more complicated with all the momentum and stuff I use, but the P&L graphs end up looking somewhat similar to this. So that's why I kind of like this strategy myself. Remember, you should probably run this on your own time frames and tickers, similar back tests and stuff like that, always to ensure that it's going to work for you. And again, past performance is not indicative of future performance, and it's at the end of the day, it's all about your risk management. So this is only part of the puzzle. Thanks for watching. I hope you really enjoyed it and you learned some useful stuff about the market. If you like that, make sure to like the video and subscribe to my channel for more related stuff. And have a nice night. Further ado, let's get into exactly how we're going to measure everything and exactly what we're going to do. Alright, so there's three parts to this sort of strategy that are all important. We're basically going to break up trend into three columns. We're going to have our very long-term trend. We're going to use an Ichimoku cloud. We're going to go over here to the settings. We're going to go ahead and take that conversion line all the way to 1. And we're going to take the base to 50 and the leading span to 100. Basically, we're just turning it into two midline averages at 50 and 100, and we're lagging them by 26. And that's going to give us this cloud, and it's not a normal cloud you'll see. It's about half as slow. It's sort of a long-term trend. It lasts about 100 bars average on each side. And then we're going to further break this up. So we have our 100 bar trend, and then we're going to add a volatility stop. Volatility stop is going to be about 1/5 ratio. So about a length of 20 and a multiplier of 2 will give us a nice quick volatility stop for our intra bars. And the last thing we're going to want to do is we're going to want to change them to Heikin-Ashi, which will give us about a 2 to 3 bar smoothing depending on the speed. So now we have a 100 bar, 50 bar, 20 bar, and really quick 1 or 3 bar, a stack of averages. So what you can do is when these are all in alignment, you can take pretty much any old thing because you have a series of stops, a stack of momentum, and hopefully chaos will be on your side. And you can go ahead and do this by taking any old bar, if it's an uptrend and you want to go long, and if it's a downtrend, you want to go down. And you want to wait until they're all in alignment. Easier said than done. So like right here, they're all in alignment. You have red bars, you have a red V-stop, and you have a red cloud. So you can take any of these old trades from here to the V-stop. I guess that was probably the highest risk one you can take. Ideally, you want to be a little closer to the V-stop, but still on a red bar. I want to wait till you get green bars, you might not get them. And you're going to take it up to the V-stop, and you're going to want to take 2.16 times your risk on the V-stop, on the original V-stop. This is going to trail down, obviously, so this stays put and this trails down. So it's got to hit one of these. And seeing as trend and everything else is all stacked up in this downward momentum's favor, we expect the downward resolution to be more likely than the upward resolution, just at random in general over time under these circumstances. But those specific circumstances don't exist often. Let's say like any of these bars, you have a green V-stop and a red cloud. You can't do anything. You have a red V-stop and a green cloud. Not as it do. You have a green V-stop and red cloud. Nothing to do. But then when you get here, you have red bars, red V-stop, red cloud. You can take any of these, any one of them. So to back test this, because we're going to back test 100 samples of this, I'm going to wait until it's in alignment. Alignment. Then what I'm going to do is I'm going to roll a 20-sided dice from the first bar in alignment, and if it stays in alignment, whatever that 20-sided dice gives me, that's going to be our entry bar. Granted, it's not red, so it will skip the red ones. I mean, I'll still count them, but like if it rolls, like let's see, 1, 2, 3, 4, 5, 6, 7. like if it rolls a 6 and then like it's here, so 6 from here would be would be this one, but it's a red one, so we'll wait till the next green one, and then we'll do the long trade from this bar, just like that. And that would be our stop. This is our target. It's it. The reason I say you can do this chaotically is you could take this trade off this bar here. You could also take it off this bar here. You could also take it off the next bar here. Any bar will work. It's all, statistically speaking, the same thing. At least when you're looking at it like this. So that's why it's a little bit of a chaotic strategy. You kind of flow with the chaos, right? Ideally, you have like a random number generator, or maybe you're even a dealer and you're taking order flow from someone else. And you'd use this to make, this is ideally just a little scalping thing. A nice little scalping trade for if you're going to use like a 1 minute or something like that. Alright, this is where we're going to record the back test. We're going to do 100 trades, and we're going to see how it turns out, how it works. So without any more blither blather, I'm going to get right on to it. Alright guys, I'm back with the completed back test. So we started with $5,000, enough to buy 10 shares of the SPY, the SPY Index ETF. And that's what we did. It was, well, you can see it was a decent strategy. It had about a 62% winning percentage over the 100 sample. It took us 24 days, about a solid month, 9,361 minute bars to collect that sample. We won 62 trades, we lost 38. Our average trade made about $3. We had a total P&L of about $375, which is about 7.5%. This is just on this one sample. Make sure if you're going to use this to back test it on your own products and with your own risk management and your own systems and stuff. It's a very quick strategy. In some cases you were not holding it very long at all, 10 minutes, 15 minutes, sometimes longer than that, up to an hour or so. Now you can see it had some periods where it had consistent drawdowns, where you lost several trades in a row. That was fairly obvious or fairly common for this strategy, but it also had plenty of periods where you won plenty of trades in a row. Basically the way this works is when markets are trendy, it'll work great. When markets are consolidating, it won't, and market seems to flip back and forth between those, but you do have a decent win-to-loss spread at about a 1.472 average win-to-loss ratio. So yeah, Ichimoku Chaos Heikinashi strategy is not a terrible scalping strategy, but it's incredibly high volume, and if you pay that much in fees or have too much slippage, I could certainly see this being eroded incredibly quickly and this not being very viable at that scale or that commission and fee rate. Not all these things would be things you'd have to kind of test for yourselves. I don't know what your fees are. I don't know how your technology works, that sort of thing. So anyways, I hope you enjoyed this video. Thanks for watching. If you liked it, make sure to check out my other stuff. And I hope you have a great day. Goodbye. Hey, in this video, we're going to use some simple indicators to mimic strategy used by professionals to trend trade, scalp, position trade, and swing trade all over the place. We're going to use a super trend and two Bollinger Bands to construct a methodology similar to Hurst cycling or my own TQFM. A lot of my work is based on the work of Hurst, who was a technician who did a lot of work around cycling and price action in the 70s, 80s, and 90s. You can find his equations all over TradingView. We're going to build our own using simple scripts provided by TradingView. In this case, namely, so what we're going to do here today is I'm going to show you how it works, the settings for the indicators, talk you quickly through the methodology, and then we're going to run a 100 sample backtest to see how it performs, so you can learn a little bit more about the market to make yourself a better trader and investor. So let's get into it. So the setup for this indicator is pretty simple and yet kind of complicated. So the market's just a series of trends and waves, pushes and momentum, exhales, inhales, that sort of thing. We can start looking at this by turning these off and looking at these one at a time. So let's take a big Bollinger Band here. The settings on my big Bollinger Band, I usually like to just keep it at 100, and we're just going to run one standard deviation because I want to see when it's moved away from the line and by how much. So basically on this now we have 4 zones that price can be in. Let's go throw on a second Bollinger Band. This one's much shorter, and it kind of reciprocates around and bounces off the big one. And the settings for this one are going to be 1/5. So I go about 20 and a standard deviation of 1. And that gives you something that looks like this, where you have one Bollinger Band popping out from behind the other one. And to do that, you want to set the smaller one to be behind the bigger one visually. So bring the big one to the front, and then make sure that price is on front of, that the price bars are in front of all of that. So now we don't even have 4 zones. We have 4 zones, and then when it gets outside into these 2 extra zones, we have additional zones. So we don't care about these zones when it's inside of here, but we care about it when it's outside of here. So wouldn't a great trade be, we know this big one's in an uptrend, and now we have everything separated into zones. Assuming price will continue to do as it does until something changes, just buy it when it enters that most bullish zone. And you kind of hold it until it starts getting into the less bullish zones. And you can actually label this very mathematically. 1, 2, 3, 4, 5, 6, 7, and 8. That sort of idea. And then we can use that to just throw on a quick little trend reader to help us out. This is just a super trend. We're just going to set it to 20 and 2. If that makes sense. So I want the super trend let's look at both of these. I want the super trend to be triggered when it crosses here. I don't want it to get upset and flip back over until it crosses the other side. So see, the super trend is basically telling us which area this broke out of last, to the upside or to the downside. And when we combined all of those and we sandwich the super trend in between the big Bollinger Band and little Bollinger Band, we get something that looks like this. So how would you use something that looks like this? And why would that make sense? Well, like I said, this is all under the understanding the market tends to do as it does, or as it is doing, until it changes its mind. And this is just a very mathematically objective way to measure that. So the market's going up, we can measure that with the advancing large Bollinger Band. And then inside of that larger going up, we want to take the strongest points. So mathematically speaking, that's going to be when price breaks into that first zone. So a very easy trade would be buying when price breaks into that first zone, and then selling when price gets into zone 3. So we come in here, pops up, you can buy that. A stop would be, well, the stop's when the green thing goes away and turns red. So that's your stop. You're gonna carry this up until it hits there. I made about $1 there. And then on the downside, here it comes out here, flips red. You can short that, and you can take it all the way till it turns green down there. It's a solid trade. And the most important part about this is it's very mathematically objective and consistent. So with the explanation out of the way, I'm going to go ahead and start backtesting. Hey guys, I'm back, and we had a successful back test, and it was nice and fun because it's something that I'm kind of proud of. So the B-band scalp formed admirably. We started with $5,000. We took 100 trades. We won 54 trades. We lost 46. That means we only won 54%. If you do a million of these, it's probably going to be about 50% even. But we made some money, a good bit of money. So how do we do that? Well, our average win was about 2.3 times the size of our average loss. You can see in the chart, we had lots of bigger wins and lots of little losses. And that seems to be the tendency of these sorts of strategies, where they tend to get good chunks out of very strong trends and otherwise just take little boops back and forth, whether it's like $2 up or like $1.90 down or whatever it is, and then sometimes they have the big wins. So anyways, I hope you guys enjoyed that, learned something about the market, and help you become a better trader and investor. Thanks for watching. Make sure to check out my other related content. If you like this, you'll like that too, and subscribe to my channel for more. Have a great night. Bye. Hey, in this video, we're going to take an in-depth look at the very popular triple EMA scalping method. It's been reviewed by quite a number of channels, and I'm going to take my own whack at it. I'm going to talk a little bit about how to set up the indicators, the entries and the exits involved in the strategy. Then we're going to run a 100 sample back test to answer the question if the triple EMA scalping strategy is effective. And hopefully along the way, you can learn something about the markets to help you become a better trader and investor. So let's hop right into the settings. To do this, you're going to need 3 EMAs. Very simple technical setup. The first one at a length of 20, the second one at a length of 50, and the third one at a length of 200. I colored the fast one green, the middle one 50 white, and the slow 200 red. So the idea behind the strategy, for long entry, if price is trading above the 50 and the 200 moving average, wait for a pullback to the 20 moving average, and then enter. The goal of the trade is to get to that last high, and the stop that is most commonly used is 1.5 to 1 risk to reward ratio. So that's what a long trade will look like. It comes back, pulls back to the here, you enter, and it breaks the high to continue trend, and you exit the trade. It's a quick scalp, and you wait for it to pull back, and you buy it there, set up to the last high or so, and you're looking for 1.5. And it just about stopped out there, but did eventually end up getting your trade. If you were stomped out, you just wait for it to come back, do another reciprocation, and you try it again. But the idea on this is that your winners are larger than your losses, and you'll win a little bit more than you lose. And the same thing on the short side. You wait for it to pull back to the line, you take it to the last low, and then you're looking for a 1 risk to reward. And there's your scalp. So with all that being said, I'm going to go ahead and start the back test. Hey guys, so I'm back with the back test, and well, the results were surprising. It didn't perform as well as some people might have suggested it might. It still made some money, but really not a lot. You can see we had $5,000. We took 100 trades. We won 46 of them, and we lost 54 of them, for a 46% win-to-loss ratio. That might go up and down, but I have a suspicion that it's gonna hover right around 50%. We had a total P&L of $46, or an average trade of 47 cents. This was taking 10 SPY shares at a time. We had an average win of $6.60 and an average loss of $4.75 for a risk to reward ratio of 1.389. It would be closer to 1.5, and I'm sure it'd probably be just about exactly 1.5 at a 50% win loss ratio. So what happened here? That's a good question. And I can answer that because I know my way around some math. You can see a lot of your winners, what happened was you won the trades in which the pullback from the high was not that large. That was your most common winning trade, was when it was a small pullback and it had a really short profit target. It also had a very small stop. You won a lot of them, but some of the markets in which there was a bigger pullback and you had a larger profit and loss target, you often lost though. You did have a couple of big winners in there, as you can see, but a lot of the bigger trades that got executed were on the losing side as far as distance from entry. So that's kind of the overall results. Anyways, I hope you enjoyed that. I hope you learned something about the marketplace, and take a chance to look at my other content if you found this interesting. Alright, you have a great night. Hey there, in this video, we're going to check out a crypto scalping strategy. It utilizes the Bollinger Band to act as a midline and a repellent sort of bouncing off of it to continue trend. They can be very effective in trending markets, and we'll see just how well it works on Ethereum and in crypto in general. It has very fast trades, it's pretty easy to set up, and some people really enjoy it. We're going to cover the settings, how it works, the entries, the exits. I'm going to do a 100 sample backtest. So the settings for this indicator are pretty simple. It's only going to take one Bollinger Band. You're going to want to set it at a pretty lengthy length. 100 should do. And you're going to want to set your standard deviation to less than 1. I like 2/3 or 0.66. So the entire idea of this strategy is the Bollinger Band is acting as a midline and a repellent area. As it's trending and going higher, when it comes back and goes into the Bollinger Band, take a scalp in the direction of trend. Your stop is going to be the other side of the Bollinger Band at the point it broke into it. And the target is about 1.5 reward to risk ratio. Let me show you what that looks like. So it comes back here, it touches this. We're going to take a long position to the bottom of the Bollinger Band, and then we're going to look for 1.5. That gets tough with the pennies. That's close enough. And you just take until it either hits the stop or the target. That's a long trade. Short trade functions very similarly. It comes through, breaks the band, comes back up, touches it, take a short to the top of the band, and then we're going to look for 1.5 risk to reward ratio. So they're just quick little scalps, and you're supposed to get multiple of them in trend as it goes. So that was a very quick explanation, and you know how it works in the settings. So with all that out of the way, I'm going to start running a backtest. Hey guys, what's up? It was a fun backtest because it was a bunch of fun quick trades. Let's talk about how it did. For the B-Band Crypto Scalper, we started off with $5,000. We took 100 trades. We won 46. We lost 54. That's a 46% win percentage. Made $74.32 in total. That's using 3 Ethereum per trade, so about $3,900, $4,000 per trade. We made 1.49% return on capital in about 7 days, or 2,700 bars. Our average win was $12.63. Our average loss was $9.39 for a 1.345 reward to risk ratio. You can see looking at the chart, it had a nice strong start, but it finished pretty choppy. All in all, I think the strategy was a little too fast for most people to employ. You're really only in most trades for a couple of bars, even though some of them take quite a while. Depending on your fee structure, you could probably employ this with some sort of algorithm or some sort of technical work like that. But for most people, I don't think it would be a very feasible strategy to employ. Now, with all that, I hope you learned something about the marketplace and help you become a better trader and investor. If you liked the video, I make all sorts of videos like this, so you probably enjoy those too. And you probably check them out. Alright, well, thanks for watching. You have a great night. Hey there, in this video, we're going to take a look at a stochastic scalping strategy for crypto and forex. We're going to cover how it works, the indicator settings, entries and exits for long and short trades, and then we're going to do a 100 sample backtest. So let's begin. So the idea behind this strategy is relatively simple. A stochastic is just a moving box. When it begins to break that moving box to the upside or the downside, that can signal trend, beginning in one direction or the other, as it's breaking above prior highs or lows. So we're going to use that to take a price action based trade. So the indicator settings, you're just going to want one stochastic, and you can go ahead and get rid of the simple moving average or the D. We're just going to use the K, set at 1 with a length of 14. That's going to go ahead and have the stochastic look back a certain number of bars, in this case 14, as a close that breaks that last high or low. So for example, a long scalp would be set up when the stochastic breaks above the 80 point and closes. So we're going to take a long scalp there, and our stop is going to be the low of the last bar, and then our reward is going to be 1.5 times our stop. That's what it would look like. So what a short trade would look like, comes down and breaks this 20 stochastic low down there. You're going to go to the high of the last bar, then we're going to look for 1.5 reward to risk ratio. This one you need to wait a little while, but you got it. And now it sets up a lot of individual areas you can take a trend or a trade. We're only going to stay in a trade, one trade at a time. So with all that out of the way, I'm going to begin our backtest. I'm back with the backtest. So we used the dollar-yen pair to backtest the stochastic scalping strategy for crypto and forex. We start off with $5,000, but that might be misleading. I don't know exactly what the standard lot size is on your forex broker. Some it's 100, some it's 1,000. So I just did 1,000, which you may or may not be able to do with $5,000. It kind of depends on leverage and all sorts of stuff like that. But anyways, we had 100 trades. We won 55 of them. We lost 45 of them for a 55% win percentage. We made $1,005 for an average trade of $10.05, which is a 20% return. But that might be misleading again because I don't know the sizing on that. It took us 4 days to finish this backtest. That's 1,560 bars. Your average win was $46.95. Your average loss was $35.04 for a 1.34 reward to risk ratio. You can see looking at this chart, it had a lot of chop, but it also had some big moves when it caught trend. When the market was trending one direction or the other, it had a habit to put up multiple wins in a row. And that's the reason the chart looks the way it does. I hope you enjoyed watching this video, and thanks for watching. If you did, check out the rest of the content on my channel. You'd like that stuff too. And I hope you have a great night. Goodbye. In this video, we're going to take a look at a Kellner channel cycle trading strategy for stocks, crypto, forex, all sorts of stuff like that. I'm going to cover how it works, the settings for the indicators, entries and exits for longs and shorts, and make sure you all watch to the end to check out the data from our 100 sample backtest so you can see how it performs in live markets. So let's begin. To start off, this is going to take 2 Keltner channels, and it's going to be very similar to our other cycle strategies that we've covered on this channel and TQFM in general. However, this is a much more simplified version, even to Hearst. Very simplified cycle trading strategy. So you're going to take 2 Keltner channels. The first Keltner channel is the big one, the black one. You're going to want to set it at 100 length with a multiplier of 1.5. And I like to color it black and put it on top, just so I can see when the white one is disappearing behind it or emerging from behind that. In the faster Keltner channel, we're going to set to 20, and that's a 1:5 cycle ratio. Similarly, with a 1.5 multiplier. The idea behind this strategy is you're going to trade the cycles, the short cycles, inside of the long cycles. And to do this, you're simply going to look for extensions for the longer cycle to continue to start an uptrend. The shorter cycle has to begin breaking out from behind it. That's the entire logic behind it. And for this to begin to reverse, it has to first hide behind the black one. See, it has to hide behind it, and then it comes out from above it. It doesn't get all the way outside of it without first peeking out from behind it. And it doesn't get all the way back in it without first sticking back inside of it. It sounds simple, but cycling can be an effective method for trading. So the short entries, we have one here. The fast band starts to peek out from behind the slow band and take a close. Your stop is going to go to the top of the slow band, and it's not going to move. Your target is going to be a 2-to-1 risk-to-reward ratio, or you will exit when momentum fades, when the band peeks back behind the black one completely, and that will enter a trade on the upside. A long trade is going to function similarly, where the fast band starts to peek out from behind the slow one, and you're going to buy a close. Your stop's going to be at the bottom of the band, and you're going to look for a 2-to-1 risk-to-reward ratio. Now that you know how it works, how the indicators are set up, and the entries and the exits, I'm going to go ahead and begin back testing. I do love to trade cyclers. We started with $5,000. We took 100 trades. We had a 46% winning rate. Our average win was $18.94. Our average loss was $8.62 for a 2.198 risk-to-reward ratio. Some of the losses were trailed off, and that really helped us get a little bit better than that 2-to-1 we were looking for. We had a total winnings of $405.90, or an 8% return on capital in our 41-day backtest. In conclusion, this strategy overperformed my expectations, and this can teach us a lot about how the market functions and cycles of momentum. And this can help us make better decisions as traders and investors. If you enjoyed this video, make sure to check out all my other ones. They're similar to this, and if you like this one, you'll like those too. And make sure to subscribe to my channel for all sorts of new videos along similar lines. Thank you. You have a great night. Hey, in this video, we're going to look at a no sure thing trading strategy for crypto, forex, and stock. We're going to go ahead and cover how it works, the indicator settings, and the entrance and exit. Make sure to watch to the end to see the data from our 100 sample backtest so you can see how it performed. So let's begin. This strategy takes advantage of cycles inside of trend to make short-term trades in all sorts of continuous markets. The indicators used are the Ichimoku cloud and the known sure thing indicator. The settings for the indicator are as follows. Ichimoku cloud is just the standard settings, conversion line of 9, a base setting of 26, a leading span of 52, and a lagging span of 26. The no sure thing indicator is set in its default settings. You have 4 staggered rates of change at 10, 15, 20, 30, and you have 4 SMAs at 10, 10, 10, and 15 with a signal length of 9. The way this functions is as the market coming down in a downtrend, you can take any of these short trades, enter here, and you can exit down there. To spice this up just a little bit more, what we're going to do is we're going to change it to smooth Heikin-Ashi candles. This just gives us a little bit better smoothing in our trading inside of trend. So the way this works is there's a downtrend, and the indicator starts moving down. It makes a bearish roll. So you take your short trade here, and then you're going to follow it till it's done. You can see it actually kind of price follows the blue line. This starts to curl up. This goes ahead and turns. You go take a long position and take it all the way to the close. You can see it follows the blue line again. Alright, with all that being said, I'm going to go ahead and begin the back test, and I'll see you guys back here in a little bit. Alright, I'm back with the data. We started with $1,000. We took 100 trades on Ethereum. We had a winning percentage of 45%. Our average win was $8.87. Our average loss was $6.49. This gives us a 4.24% return over our 7-day backtest. Trades were very quick. That gives us an annualized leveraged return using 3 Ethereum of 773%. In conclusion, this strategy, it kind of met expectations. It underperformed just a little bit. It had a lot of losers, and the reward to risk ratio was not outstanding. However, it does run very fast. If you enjoyed this video, make sure to check out my others and the rest of my channel, and I hope to see you soon. Thank you, and good night. Welcome to the channel. In this video, we're going to take a look at a scalping trading strategy for crypto, stocks, and forex. This strategy uses 2 common free indicators and the widely available Heikin-Ashi candlesticks, so anyone can set it up easily to backtest it for themselves. In this video, we're going to cover how the strategy works, the indicator settings used, and entries and exits for the strategy. Make sure to watch to the end to see the data from our full 100 sample backtest, so you can see how it performs. Well, let's get into it. This strategy takes advantage of trend because it has to start somewhere, and we can find these reversals in the market using Bollinger Bands and stochastic RSI. So the settings for the indicators: the Bollinger Band is going to be your standard settings with a length of 20 and a standard deviation of 2. And your stochastic RSI is going to be changed a little bit, with the stochastic length of 14, your RSI length of 10, your D of 6, and your K of 4. So it's staggered in speed. There's a few ways to use this strategy, and I'm going to give you some examples. A long scalp is started when the stochastic RSI rolled upwards from the bottom of the Bollinger Band. The Heikin-Ashi candles turn green and close with 1 green candle. You can take a trade at the open of the next bar, or the open of this bar anyway, the close of this bar, to the bottom of either the Bollinger Bands or the last red candle, whichever is bigger. And you set your target for 2 risk to reward ratio. This one's still working, it looks. That's what the trade would look like. A short scalp example functions much the same way, where we have the stochastic RSI rolling down, price moving off the top of the Bollinger Band, closing with 1 red Heikin-Ashi candle, and we can take a short from there to the last green candle or the top of the Bollinger Band, whichever one is bigger, and we're looking for a 2-to-1 reward to risk ratio. This is also a pyramiding strategy in which, if you choose to, you can take a short trade. That one closed pretty early. Let's just say you're in it for a long time, and then a long trade sets up while you're in the short trade. You can enter a long trade at the same time in the opposite direction if you have the ability to. A lot of brokers won't let you do that. Or you could start a pyramiding stack where you like buy one, sell one, buy one, sell one, buy one, and you end up with plus or minus based on however it goes. But you can also do multiple trades. You could take multiple trades in a row if you want. this one's still working. Let's say this one was still working. I know this one finished, but let's say this one's still working. And then the second short trade sets up here. You can take another short trade if you wanted to have more than one trade open at a time. So while I only ran the back test with one trade running at a time, you can do multiple trades at a time if you prefer to do it that way. Each one is individually important. It's not like one is dependent on the other as far as the signals. Well, with all that said, I'm going to hop right into the back test, and I'll see you guys back here in just a little bit. Okay, I'm back with the data everyone's looking for. We started with $1,000 using triple leverage, and we took 100 trades using Ethereum. Our winning percentage was 61%, with an average win of $10.33, an average loss of $8.31, giving us a total P&L of $306.21, or a 30.62% return on capital, with a 1.244 return to risk ratio on average over our 49-day backtest, which gives us an annualized leveraged return of 872% and 873%, which is an incredible backtest. Be sure to test all strategies using your own time frames and tickers to make sure it's going to be helpful for you if you're going to test it. And in conclusion, this strategy definitely overperformed my expectations. For something so simple, it performed very well. And this can teach us a lot about how the market functions and help us make better decisions as traders and investors. So if you enjoyed this video, make sure to check out the others on my channel because you'll probably enjoy those as well. Thanks for watching, and you have a great night. Hey, in this video, we're going to look at a moving average trading strategy for crypto, forex, stocks, whatever you really want to do. We're going to cover how it works, the indicator settings, and our entries and exits. Make sure to watch to the end to see the data from our 100 sample backtest so you can see how it performs. So let's begin. So the way this strategy works is pretty simple. We're going to attempt to get in a longer term trends by entering into shorter term trends. And we're going to do this with a 2-to-1 risk to reward ratio. Hopefully any mistakes we make in the larger term trend are corrected by the fact that we have a larger reward to risk ratio. So the settings for the indicators, we're going to have two moving averages. The first one set at 10, the second one set at 20. I've colored the fast one green and the slow one red. And then I've gone ahead and tossed up a strategy with 10 and 20. And the strategy is just there to put our entries on the chart. A long trade for this strategy would start with a long signal when the fast average crosses the slow one. You can enter there, and your stop's going to be at the lowest close of the last downtrend. If this is an uptrend, then it's a downtrend. So the last low of this downtrend is here. That makes sense. And then we're going to look for a 2-to-1 risk to reward ratio. And we got it quick. Came up, touched there, we're out. What a short trade with this strategy looks like is the same thing upside down. It comes down, it crosses. We're going to sell and put the short at the top of the last uptrend, and we're going to take a 2-to-1 risk to reward ratio. Now we just got it there, but if we didn't get it there, we would have got it down here. So you surprisingly gets it right down there. So that's how the strategy works and the basic idea behind it and the entries and exits. So without further talking, I'm going to jump right into the back test. I'll see you guys on the other side. Hey guys, I'm back with the data. We started with $5,000. We took 100 trades on Ethereum. Our winning percentage was 41%, with an average win of $10.67, an average loss of $7.62, for a reward to risk ratio of 1.4. This gave us a total P&L of negative $12.17. We lost about a quarter of a percentage over a 36-day backtest. In conclusion, this strategy underperformed expectations, and this can teach us a lot about how the market functions and help us to make better decisions as traders and investors. And if you enjoyed this video, make sure to check out my others and the rest of my channel, and because they're streaming coming soon. Thank you guys. Have a great night. In this video, we're going to look at the home run RSI trading strategy for stocks, crypto, forex, and commodity. We're going to cover how it works, the indicator settings, and the entries and exits. Make sure to watch to the end to see the data from our 100 sample backtest so you can see how it performs. Let's start off with how it works. This trade is going to be utilizing trend and an incredibly high reward to risk ratio and try and make more money than it loses. The indicator settings you're going to use is you're just going to need a RSI, and a base RSI at 14 will do. And to use this strategy, you also need to set up the simple moving average at a 14 length on the RSI. So the way this works, is as trend comes down, there's a little trade there you'll probably lose, a little trade there you'll probably lose, and then this trade here on the long side, it breaks the simple moving average, it closes above it, and take a trade with a stop to the low and a 5-to-1 risk to reward ratio, very high. And eventually you'll get the final higher low in trend, and it'll continue on for you. And hopefully you win enough of these that they beat out all the little losses. Same thing on the short side. Took a trade there, you lost a little one. You might have, I don't know if you lost. Hey, you took a trade there, maybe. It's the same, it's like 3 cents. So you might have taken a trade there and stopped out. And then you took this trade here. And the same way on the long side, it closes below to the top. And we're going to look for 5-to-1 restored ratio. This is basically working off the principle that the average trend only makes 3 measurable extensions. Some make more, some make less, but on average it's about 3. If you're trying to make 5-to-1 and you're betting on each one of these little extensions reversing, eventually you're going to be right. And with all that being said, I'm going to start the backtest. I'll meet you guys back here in a second. And I'm back with the data. We started with $5,000. We took 100 trades on the SPY. We had a winning percentage of 34%, with an average win of $18.04, and an average loss of $6.88, for a reward to risk ratio of 2.62. We made $159, or 3.19% over our backtest of 61 days, which was a long time. Some of these are very long trades. In conclusion, this strategy actually overperformed my expectations. I didn't expect to win as many as we did. That might have been a fluke of a trendy market. I would take the time to backtest this on your own tickers and with your own risk management strategies. And this can hopefully teach us a lot about how the market functions and help us become better traders and investors and make more educated decisions. And if you enjoyed this video, make sure to check out all my other ones and the rest of my channel. You'll probably like those too. Thanks. You have a great day. Welcome to the channel. In this video, we're going to take a look at a scalping trading strategy for crypto, stocks, and forex. This strategy uses 2 common free indicators and the widely available Heikin Ashi candlestick, so anyone can set it up easily in order to backtest it for themselves. We're going to cover how the strategy works, the indicator settings, long and short entries and exits, and make sure to watch to the end to see the data from our 100 sample backtest so you can see how it performs. Let's begin. This strategy takes advantage of a divergence to spot possible trend reversals in order to make short-term trades in continuous markets. The indicators used are the divergence indicator and the super trend indicator. So here are the settings for the indicators. The super trend indicator is going to be backed out just a little bit to a factor of 4 to make up for the smoothing in the Heikin-Ashi candlesticks. And the divergence indicator is at the standard settings with a period of 14, a pivot look back right of 5, a pivot look back left of 5, a max look back range of 60, and a min look back range of 5. And we're only going to be looking at the bullish and the bearish divergences, not the hidden ones. So a long scalp example is the divergence indicator shows some divergence, and then the super trend indicator flips bullish. This allows us to enter a long position on the first green bar, the close of it, with a stop at the bottom of the super trend. This does not trail like the super trend, it stays put. And our take profit is going to be 2 times our risk. So we have a 2-to-1 reward to risk ratio. A short trade functions much the same way. You see bearish divergence, and then the super trend indicator flips. So you can do the first red bar to the start of the super trend. And just like with the long trade, we're looking for 2 times our risk and reward for a 2-to-1 risk to reward ratio. Alright, with all that out of the way, I'm going to start the backtest. I'll meet you back here in just a little bit with all the data. Alright, I'm back. We started with $1,000 using triple leverage on Ethereum. We had a winning percentage of 39% with an average win of $61.46, an average loss of $25.40, which gives us an average risk to reward ratio, which gives us an average reward to risk ratio of 2.419. It took us 49 days to run this back test, and over that time period we returned 84.74%, giving us a leveraged annualized return of 1,276%. Remember, it's always good practice to rerun any back tests to make sure that the strategy will be interesting on your time frame and ticker. In conclusion, this strategy definitely overperformed my expectations. A lot of the trades took a long time, and 10 or 15 trades in, we were down a good chunk of money. And I really didn't think it was going to pull it around, but it started putting in some really big hits, and it did really well. It just took a really long time. It took almost 2 months to run our 100 sample backtest, and there was a whole lot of waiting around relative to a lot of the other strategies I test on this channel. Anyways, this can teach us a lot about how the market functions in general, and it can help us make better decisions as traders and investors. So if you enjoyed this video, make sure to check out the other ones on my channel. They're a lot like this one. If you like this, you'll like those too. And I hope to see you again. Thank you for watching, and you have a great night. In this video, we're going to look at a parabolic support and resistance, or chandelier stop, and chop brick curve indicator trading strategy. We're going to cover how it works, the indicator settings, the entries and the exits. Make sure to watch to the end to see the data from our 100 sample backtest so we can all see how it performs. Well, let's begin. So the way the strategy works is when the chopper curve, a very long-term momentum indicator, is in an uptrend, you wait for the parabolic support and resistance to alternate to the downside, in which you take a trade. At the bottom of this, you're going to go to the top of the parabolic support and resistance, if I can ever find it. There we go, and you're going to look for 1-to-1 risk to reward. And just like that, in a very simple scalping trade. And it comes up here, there's another one. You buy, you set the target for the top of the parabolic support and resistance, you set a 1-to-1 risk to reward ratio, and there you go. On the short side, the same exact thing. In a declining chopper curve, it comes down, breaks the parabolic support and resistance. You can take a target to where it begins on the other side, take it a 1-to-1 restore ratio, and it clears in a couple minutes. There's another one here, it comes up there, like that. So settings for the indicators on this strategy: the chopper curve, you set the WMA length to 100, the long ROC length to 300, and the short ROC length to 200. The setting for the parabolic support and resistance are its standard settings: 0.2, 0.02, 0.02, and 0.02. And with all that being said, I'm going to start back testing the strategy. I'll meet you guys back here in just a second. We're probably going to be using Bitcoin or Ethereum to do this, and it needs continuous markets. And ideally, this is a very long-term indicator. It doesn't like gaps. Hey, I'm back with the data on the chopper curve scalper. So we started with $5,000. We took 100 trades. Our winning percentage was 48%, and our average win was $14.46. Our average loss was $14.92, which gives us a reward to risk ratio of 0.969. So we had a total winning percentage of 48%, and we lost $81.47 for a return on capital of negative 1.63%. In conclusion, this strategy underperformed expectations, and this can teach us a lot about how the market functions, and it can help us make better decisions as traders and investors. If you enjoyed this video, make sure to check out the other ones on my channel. They're similar to this, and you'll like those too. Thanks for watching. I hope you have a great night. I make a lot of more advanced technical analysis content, but I haven't really made that much for the beginners. So this is my take on that. Welcome to Technical Analysis 101. If you're a beginner and you're looking to learn the very basics of what we're all talking about, this is a great place to start. What this video isn't is a suggestion to use one broker or another, telling you which assets you should trade or how you should go about doing that. This is simply a very foundational video for people who want to examine price in a mathematical manner of anything we're talking about. So with that, let's begin. Let's start with some terminology and definition, just get that out of the way, just so you're not confused by anything I say in the immediate future. Let's start with price. Generally, when we mention price, we're talking about the price of an asset or a security. Talk about a market. A market is a place where people buy and sell assets. And when I use the term entry and exit, it simply means to either buy or sell a position to open, or to buy or sell a position to close. Either entering or exiting a either investment or trade or anything along those lines, buying or selling of something. So what are we going to cover? Well, in general, we're going to cover how people commonly evaluate prices using charts, what a chart is, some common things people look for when they start to examine price, such as trends in price, and areas that price might begin or end a trend. We call those areas support or resistance. We'll get into that later. We'll also talk about patterns in price and patterns in the market in general, because it's also patterns in time. Lastly, we're going to cover structured ways to evaluate price, different equations people commonly use, commonly termed indicators, and we're bringing that all together for a quick discussion about what market structure is and supply and demand represented over time in the price of an asset or security. The most common thing you see when you hear people talking about the price of something in a market is a chart that looks a lot like this. This happens to be a candlestick chart, but there's plenty of ways to chart price. This just happens to be the most common one people like to use. You can also use a line chart, a bar chart, which is very much like a candlestick chart, or some more interesting ones like a Heikin-Ashi chart, which is a smoothed candlestick chart. Then some more fancy ones such as a line break or a kanji or a point and figure plot. There's a bunch of different ways to graph price, but the most common one is a candlestick chart, and that's the most common one people talk about in videos on the internet talking about technical analysis, and it's the most common one that analysts at institutions will use. What this represents is observations of price over time. You can see all these little bars, and you can see the time at the bottom. So what this represents is the open and the close over this time period, with the wicks being the low and the high. So what this is saying is over this time period, it's going to be Tuesday the 19th of July. Price opened at this level. It reached a low. It at one point traded just a little bit lower, then traded higher the rest of the day to come up to at one point a high price of that, and it finished the day at this price. And that's how to read it. And open at one point and dropped down that far, at one point it went up that much, and it closed there. It opened there, at one point dropped down that far, at one point went up that much, it closed there. And the same thing on the downside. It opened there, at one point it traded up that high, at one point it traded down that low, and it closed there. So let's talk about breaking this up and adding this together in trends. The easiest way to draw a trend is a simple line like so. This just represents price moving in a general direction over time. Same thing can be said about candlesticks. Like for instance, if we drop down to the 1 hour, and you see these 4 candles here, if we look at the 4 hour, all those candles make up this bigger candle. In the same way that if we go down to the 1 hour, and we zoom out, and we can say this big trend here makes this little trend on the 4 hour. The market is a fractal structure in which smaller things come together to make bigger things. Smaller movements in price come together to make bigger movements in price. These charts are simply the way we observe the changes in price over time, graphed in a nice, pretty, and interesting way. So let's talk about support and resistance. When price or trend might reverse. It tends to be the question that everyone wants to know. What past prices are going to be important for future prices? And well, the answer is all of them. But generally speaking, the places where it stopped and reversed before will be important or might be important in the future. But this is all kind of sort of general areas and, rule of thumb stuff. It's not exactly an exact science, especially when doing it randomly painting horizontal lines. Let's talk about what is support and resistance. What is actually happening in the marketplace? Well, what a trend is a group of people who all feel the same way for some reason. And this is going to be acted out in the marketplace. And this is actually acted out in all aspects in life. Let's say a new phone comes out and it's really cool. You're going to have your people that jump on the phone right away. They're going to get the phone the day it comes out. And there's going to be some people who wait for those guys to kind of test out the phone and see if it's good. And if it works for them, they're going to buy the phone too. And then there's going to be a group that, at a certain point, everyone else has bought the phone, and they're the only ones who are left who haven't, so they're going to buy that phone as well. But the market's a very tricky place, so now that everyone's already bought the phone and there's no one else to buy it, people are going to immediately begin selling the phone, because there's people down here that saw people buy the phone before from these prices, so they're going to do the same thing again. Because they're later adopters in an even longer trend that comes from another area, if that makes sense. So as traders, we're essentially playing hot potato. We're trying to get in here and hope that people continue to do as they do, and we can give it to someone later. And if we hold it too long, we get burned. It's hot potato. Generally speaking, it's common terminology to call areas that price bounces up from support, and prices it rejects off of resistance. Meaning there's groups of people who want to buy down here and support price, and there's people who want to sell up here and resist further appreciation. Every trend has to start and every trend has to end somewhere, and support and resistance is how we describe the areas in which it might start and stop. So let's talk a little bit about patterns in price in the auction and how that flows into the fractalization from earlier. So as price moves up and down, it creates these, changes in price, which are represented by candlesticks. These are often analyzed by technical analysts to speculate on future results. And one way to commonly do this is to look for groupings of these bars or patterns in them in order to categorize them and form understandings about the market action inside of this time period and the possible action it might have in future time periods. I guess you could get technical and you could call trend and support and resistance all patterns in price as well. But here we're specifically referring to more complex ones, like triangles or wedges. For instance, if a trend is a group of people who feel the same way about something, who will slowly adopt to that feeling over time until they're overcome by a more powerful group of people who feel differently, then you can make speculations about the market in general. Like in this instance, the people who were buying were stronger than the people who were selling. So perhaps that indicates that in the near future, there will be future strength in the marketplace and other ideas along that line. You continue that further, a lot of people will continue to draw these downward trend lines, and as long as they are broken to the upside within a certain amount of time, they will consider this a continuing uptrend. This is just the same way as drawing a line across the bottom, because if each of the bottoms are smaller and smaller, this line just keeps going up. So it's the same thing, same way to look at it. So now let's talk about the next level up in doing this with your eyes, which is using math to do this, which works on the same things as your eyes. Your eyes work on math. So it's not that hard to go from one to the other if you know what you're talking about. There's various kinds of indicators people use, but all of them are just different ways to analyze price and time. Each one of these closes, or the highs, or the lows, or the opens are all an observation. This can be a data set, and this can be analyzed to understand things about the market. For instance, people commonly use a moving average to get a more or better defined smooth price. But this is just a way to understand price itself over time. The power to technical analysis and to indicators in general and the math behind it is it allows you to be consistent and to analyze data as sets versus individual occurrences in which you have no prior information about. This allows you to form realistic expectations and even at a very high level teach your computer how to do all the work for you. Well, not all of the work, but do a lot of the work for you. Well, this is a technical analysis 101 video. So we're just covering the basics here. And let's wrap it all up and bring it together. Different people have different names for what they call an understanding of their technical analysis or an understanding of price over time. But a very common one is going to be market structure or price action, just simply how the market's put together. And bring that all together very simply. And then start, we can say price bounce there, price bounce there, which is higher, price bounce there, which is higher, price stop there, which is up, price stop there, which is up. So it's zigzagging higher and it's building a trend. And on the upside, you can do the same thing, high to high, building a very consistent trend. And we can add an indicator to that to display that consistently. This is a 30 period simple moving average, which is just the close of each bar from, say, here. This line is the last 30 bars. All the closes all added together and then divided by 30. So it's just a simple average. However, we can say things like the average is increasing. That means that the lows are getting higher and the highs are getting higher, because the average price over time is going up, which is a great way to define a trend. If I'm coding a program for a computer and I want to define a trend, the slope of a moving average can be a great way to do that consistently and mathematically, so I don't have to sit here and stare at it. However, understanding how price functions and the market structure is integral to doing anything of that sort. So you need to understand how to, crawl before you can walk and then eventually run. And that's what this video is all about. And that wraps up Technical Analysis 101. Now you can go out there and, look at all your own candlestick prices and candlestick patterns and see, understand more about what you're looking at, about what we're all talking about, and what they're talking about on television. Most of the time they use line graphs, but it's the same sort of thing. Price over time. Understand people talking about different indicators, different measures of price over time, and, trend and support and resistance, reversals. Is this the bottom? Is this the top? Stuff like that. Well, thank you for watching. Depending on how this does, I'll do some more videos for beginners and some other stuff about, more basic things as opposed to some of my more advanced videos that I do a lot of. So, make sure to like this video and let me know if it's something you want to see more of, and I hope you have a great day. You're here because you're probably like me. I remember when I first started trading, it seemed so hard to learn how the market works and how to use common technical indicators to understand price action and market structure. You spend days and nights staring at the market, trying to understand it, pulling out your hair in frustration every time you enter a trade, and then the market immediately reverses and stops you out. Well, this video is for you, to help you understand how the market works. To do that, we need to understand the math behind the market, the gearwork that makes it tick, and how to read that through the use of indicators. Indicators specifically designed to peel back the mystery of the market and help us understand what market makers and algos are doing to manipulate price to target you and stop out your trades. Make sure to watch through to the end to fully understand everything we learn from backtesting these indicators using real market data to better defend yourself from the hedge fund market makers and high-frequency algo traders after your capital. In this video, we're going to look at a 1-minute scalping strategy. It utilizes several common free indicators so anyone can test it out and see for themselves how it works. This strategy uses 2 Bollinger Bands and the Heikin-Ashi candlesticks, as well as the Fibonacci retracements. Fibonacci is a special numerical sequence developed by a mathematician of the same namesake way back in the day, and it's been used for countless things between architecture and physics, understanding nature, and just the way the universe works in general. So we're going to apply it today to the market to see if it can teach us anything that can help us become better traders and investors. So let's begin. The way this works is you're going to use 2 Bollinger Bands, a very long-term one set at 100 length with a 1 standard deviation, and a short-term one with a 20 length set at a 1 standard deviation. And we're also going to use Heikin-Ashi candlesticks to better show trend as it progresses. So we actually have 3 bands. We have 1 band, we have 2 bands, and we have 3 bands that operate in a staggered pattern. And we're going to use the Fibonacci retracements to better understand price levels inside of these bands and across trend over time. So the way this works is, let's look at a short trade. Start here when it starts to pierce out of the fat slow band, indicating that trend could be changing. We're going to draw a Fibonacci retracement from the point it pierced to back to the last high, and that's going to give us our levels. And from here we can wait for it to retrace or enter here, or just add. For this back test, we're going to start right here, because you can't mess that up. So we're going to buy here, short here actually, we're going to short here, and we're going to put a stop at the top of the fib retracement or the top of the band, whichever one makes more sense to you at the time. And we're going to drag our target down to either the red or the blue. For this test, we're going to use the blue because it's going to have a higher hit rate and, I believe, better results. And there's your short trade. Now let's look at a long trade. In much the same way, you wait for price to pierce the fat band.
take your Fibonacci retracement, take it from the pierce down to the last low or high, respective. And then what you're going to do is you're going to take a position, we're going to take a position, and we're going to put a stop at the bottom of the band or the last low, whichever one makes most sense. Right now this one pierced it on the last low, so I don't want to do it again because the equal low, it would stop me out. So I'm going to go to the bottom. And then we're going to take a shot at the blue. And you can see this trade also was successful, and that is a long trade. We're going to do a 100 trade back test to see how this performs using real market data to help us understand more about the market and make us better traders and investors. So I'm going to get right to that, and I'll see you guys on the other side with the results. Hey guys, I'm back with the results, and it was a fantastic back test, as I hope you all saw. There was a lot of nuance in there that if you didn't get to catch, I suggest you go back and watch, because there was a lot of trades that kind of set up funky and were hard to kind of call. So if you want to try to mimic this yourself and understand this test, run it yourself, understand more about the marketplace, then I suggest before you do that, you go ahead and make sure you watch that montage to get a total grip and handle around everything we cover. So, the test, it lasted 22 days or 8,581 minute bars. We had a simulation account with $1,000 in it. We took 100 trades. 65 of those trades were winners, 35 of those trades were losers. That gives us a 65% win rate. We had a total P&L of $347 on that $1,000 for an average trade win of $3.47 per trade. That results in a return on capital of 34.70%. For an annualized leveraged return of 2,134.80%. Your average win was $8.86. Your average loss was $6.54 for a return to risk ratio of 1.355. You can see that it had very steady climbing, where the average loss and the average win were close, with the average win being higher, and then you had a better than 50-50 hit rate. So you get to see this nice stair-stepping chart. In conclusion, this performed better than I expected, and it can teach us a lot about
And this can teach us a lot about the market, as well as how participants think using Fibonacci, whether they plan to or not. I hope everyone enjoyed the video. Thanks for watching. If you enjoyed this, you'll enjoy my other ones, so make sure you check those out too, and subscribe to the channel. If you're going to replicate this test, make sure to replicate it on your own tickers and time frames to make sure it's best suited for your style. And as always, I hope you have a great night. What's going on, guys? And I'm back with another strategy video after my hiatus. And this one is going to be a 1-minute scalping strategy that focuses primarily on cryptocurrency. This strategy uses the Bollinger Bands because I love those, along with a volatility stop, and utilizes the Heikin-Ashi smooth candlestick bars. So you can go and set your Heikin-Ashi bars up here, and you can go ahead and use an overlay. Bollinger Band is standard. The settings for the Bollinger Band are standard 20, and I reduced the standard deviation to 1. Your volatility stop, again, is going to be unchanged from the standard settings, just to give us a good reading of trend and to give us a 2 standard deviation reading along with our 1 standard deviation reading. We're going to use this to scalp a trend inside of trend in a way that we have done before in several of our other videos, and we're going to demonstrate it here. The way this strategy works, as you see, the volatility stop is broken and flipped, meaning that price has moved 2 standard deviations in the opposite direction that it was moving, at which point you're going to wait for it to break the Bollinger Band or move 1 standard deviation from a 20 period moving average. What this does is signifies the possible start of a new trend by breaking the previous one and showing strength by moving beyond what it has before. And what we can say is we expect that this trend, if it will continue, will stay above this 2 standard deviation mark below, and hopefully will move with, we're looking for a 2-to-1 risk to reward ratio on this. And this one got it. You just had to wait a little while. This can be a scalping trade where it works incredibly quickly, and sometimes when it has a larger reversal, it takes a little while. It's an iterative trading method. So if you took that one and you closed the trade up there, you just have to wait for it to come back inside of the Bollinger Band with a red bar in the case of a long trade, or a green bar in the case of a short trade. Let's see what we have. Yeah, like in here. If you took one here, and then you paid out there, or somewhere down here, you could take another one there, or there, or there. The way you got stopped out there. Now this takes advantage of a greater than 1 risk to reward ratio while using essentially a 1 standard deviation target and a 1 standard deviation stop, but starting from either price or the mean respectively to create a spread. Again, a short trade would be It flips the volatility stop to indicate the trend could be reversing. It's outside of the Bollinger Bands, indicating that it's strength beyond previous, and you can take a trade any of these red bars outside. And you're going to want to go ahead and set your stop for the volatility stops. And you're going to want to set your target for 2-to-1 risk-to-reward ratio. And you got it like, it's like right there on that bar. It's a little bit high up here. It gets really sensitive with the Bitcoins. I mean, you move dollars real quick. It's a big number. What we're going to do to demonstrate how this strategy works is we're going to run 100 simulated tests. Now you can watch along with me in the little montage or skip right to the data at the end, where we cover how the strategy did. And hopefully we can learn a little bit about how the market works to make us better traders and investors. So I'll see you on the other side. And I'm back with the back test. This one did very well, but depending on your fee structure and how much slippage you experience, it might not work for you because a lot of these trades were incredibly small. You can see here $10, $31, $25 for something that is a $20,000 asset. Those are incredibly small trades. Lots of scalping in there, as you saw in the playback. It took us 13 days to get 100 trades. We set it at $10,000, just assuming you use 2-to-1 leverage. You won about 63% of your trades, and you had a total P&L of $1,540, or $15.40 per trade, for a return on capital of 15% and a little bit more. Your average win was $48, your average loss was $40, to give you a risk-to-reward ratio of 1.196. That means you could have gotten an annualized leveraged return of 3,140%. But again, that is a simulation, and well, you might want to backtest this on your own tickers and in your own time frames to make sure it works for you. This is just a robot running it, so in real life it might not be as clean as this, especially, like I said, taking these small little $10 on 20,000. Like, if you don't hit the button that second, that could be $10 loss. It's really so I don't like a lot of these strategies that tend to put really small trades on really big assets, because I don't really find that it's realistic. But that's just my thinking about it. Anyways, thanks for watching the video. I hope you learned something. If you like this, you'll like my other videos. And have a great night. Bye-bye. Hey there, thanks for joining me. You're here because you're probably looking to learn more about technical analysis and trading in the stock market. And well, this video is for you to help you understand how the market works. To do that, we need to understand the math behind the market, the gearwork that makes it tick, and how to read that through the use of specific indicators, all designed to peel back the mystery and help us understand what market makers and algos are doing to move price around and target traders. Make sure to watch through the end to fully understand everything we're going to cover today and get the most out of the video, and help defend yourself against all the people that are out to get you. In this video, we're going to take a look at a 1-minute trading strategy, not quite a scalping strategy. A lot of the trades run a little long. It uses common free indicators that anyone can experiment with, so you can test this for yourself and learn and follow along.
So this strategy works by using the linear regression channel indicator on TradingView along with an RSI. And the way this works is you're looking at the RSI as basically a reading of trend inside of the regression. And we're going to trade using the standard RSI methodology just to see how it works under these conditions. The settings for the indicator are going to be standard. You're going to set the default settings on the linear regression and default settings on the RSI. I'm using Heikin-Ashi candlesticks just to better demonstrate overall trend. So the way this works, a long trade is you wait for this to come down here, the RSI to tap the bottom, and you're going to, go through this bottom line, and you're going to take a long trade. And your target is going to be the top of the regression channel, and you're going to go for a 1-to-1 risk to reward ratio. Now it's difficult because the linear regression channel updates in time as you go along, and it goes back 100 bars. So it's really hard to pull this back and show you this one. You're going to have to watch the montage here to see a bunch of live trades to see how it's set up and run. But short trade would function much a similar way. To go back to find one where it breaks the top over here. So if it was the channel would probably be like this. So you would take a short trade off and didn't quite break it anywhere in there. Now let's just say it did for example's sake. Just say it did for example's sake. So you come up here, you have this thing, you draw that down to the bottom of the regression channel, and then you take a 1-to-1 risk to reward ratio. 1-to-1 risk to reward ratio. You see this one actually ended up working like that. If that was your trade, I don't know exactly where the linear regression channel set up there, but you'll see how it works out in the montage. Speaking of the montage, I'm going to go ahead and jump right into that, and I'll see you here when I'm done. Alright guys, I'm back with the back test. And it did, it was an interesting test, let's put it that way. So it started out losing a bunch of trades as you saw, and they kind of turned it around, and it was a lot of choppiness. I'd say till about 75 trades through the 100 sample. It was kind of hit or miss, and they kind of had a nice run at the end to put up some halfway decent results. But overall, it was not a great strategy, not a bad one. You just probably have to run this under your own conditions and on your own tickers and time frames to see how it works for you and see if you can get anything out of it. But it does show us a lot about the structure of the market, looking at the linear regression channel relative to the RSI as that moves over time. You can see a lot of similarities between the way the indicators react with price, and you can also tell some interesting differences. That can show us a lot about the market and help us become better traders and investors. Well, I hope you enjoyed it. Thanks for watching. If you like this one, you'll like my other ones, so make sure to check those out. And I hope you have a great night. Hey everybody, thanks for joining me on this video. Today we're going to cover a 1-minute scalping trading strategy used for Bitcoin, crypto, other stuff like that, maybe forex, stocks, whatever you want to use it for. So we're going to hop right in. Alright, in this video I'm going to quickly cover the indicators used for this strategy, the basic idea behind this strategy, how to set up trades long and short, and then we're going to do a 100 sample backtest to see how it performs. So this is a whole moving average strategy using average true range as well. So you're going to need to set up a couple of indicators if you want to run a similar backtest. Learn a little bit about the market, help make everyone better traders and investors in their own practices, doing whatever they're going to do. So this one I'm going to start off with a long-term whole moving average, and this one's going to be set at 100. And then we're going to do an even longer term whole moving average. This one's set at 500. Then we're going to run some Keltner channels off a 1 length just to set that right to the bar. And then we're going to use a 3 multiple of 20 ATR to give you these average true range bands. So the basic idea behind this strategy is the faster whole moving average crosses the slower one. Both of them are very long term, but one of them is faster than the other one by about 5x. So it crosses this one, and you're going to use the average true range to set a stop and profit target. Assuming that if trend has failed that far across such a long-term trend, it'll continue at least for the next little bit. So let's say here you take a short, and you're away from the cross. You go here, you take your stop up to the average true range, your target down to the average true range. It should be about 1-to-1 restore-reward ratio. And if you keep going, we might have to keep waiting for it, but this one will probably close for profit. And that's a short trade. A long trade is going to set up very similarly, where you wait for the whole moving average to cross. The short one, or the short-term one, the faster one, crosses the slower, longer-term one, and you're going to take a long position. Take it at the end of the first bar that crosses there, and go down to and then that's your quick little scalp trade for the long side. You could set this up to take multiple trades inside of that if you wanted to run it like one that's set like a couple of these, and so you could take a trade every time one of the faster ones crosses the slower ones. It's going to create like a rainbow effect. Or you could just run one at a time. For simplicity's sake, we're just going to run one, and we're going to start the back test here in a second. So I hope you guys enjoy that, and I'll see you on the other side to go over the data. Hey guys, I'm back with the data. I finished the back test. I hope you guys enjoyed it, and it was pretty interesting. So we set this up to have $10,000, so you could buy 2 Bitcoins with forex leverage, and that's about what we set up these trades for. So we kind of went up or down about $100 each time. We took 100 trades. We won 68 of them. We lost 32 of them for a 68% winning percentage.
We had a total P&L of $4,970 and an average trade win of $49.70 to give us a leveraged return on capital of 49%. It took us about 46 days to run this back test, and our average win was $114 and our average loss was $87 to a risk and reward ratio of 1.306 reward for your risk. That gives us an annualized leveraged return of just over 10x. But it's a very risky strategy, and every time you see an annualized leveraged return like that, failure is definitely a possibility. And I would suggest that you run this test on your own tickers and time frame to get a best idea of what we're trying to communicate here, so you can learn a little bit about the market and become a better trader and investor. And with all that, I hope you enjoyed the video. If you like this, make sure to check out the other ones on my channel. They're just as good. And I hope you have a excellent week and evening. Hey, welcome to the channel. This is TQFM Trading Strategies. I trade stocks and options, make videos about it, and to help you take your own trading and investing to the next level. So that sounds cool. Make sure to subscribe and like the video, and check out the rest of them. So today we're going to be looking at a strategy utilizing 3 RSI in a sort of waveform function. This will allow us to look at trends, support and resistance, and make all sorts of trades, long and short. Okay, so in this video, we're going to break apart the strategy, how it works, talk about the indicators involved, the settings for those indicators. They're all free and available for anyone to use, so you can set it up yourself, follow along. Then we're going to run a bunch of tests on the strategy to see how it performs using the historical market data, all in an effort to better understand the market to make us all better traders and investors. So let's go ahead and start off with how the strategy works. So this strategy works, well, it's kind of simple to see in this couple of setups. You run a series of RSI with stacking lengths. When the faster length RSI crosses over the 2 slower ones and holds it, it's going to show you that trend is building in that direction. When it's reciprocating back and forth, this shows you how price is behaving inside of a range when they all get stacked up and tight like that, meaning that it's all over these last couple of time frames, it's all within the same blocks. So it's more of a square market than a line. If that makes sense. Square market, all bunched up. Line, all spread out. So 2 kinds of markets you can have. Either a consolidating one, or it's a box, or a line, or it's a line. So this is how we're going to set up these RSIs to understand what we're looking at. The fast one is going to be your standard setting. I just keep it at 14. The second one is going to be about twice as long, about 30. And the third one is going to be twice as long as that, so about 60. That gives us this triple RSI setup. So the trades themselves, in a ranging environment, you can see that the RSIs are not making any higher lows or higher highs or higher lows, and reciprocating around the middle. So what you can do here is, as long as it's not breaking out above the top or below the bottom, you can trade it back towards the middle, if that makes sense. So if it comes up, you can trade that back towards this middle line here. It goes down below it, you can trade it back towards the midline. It goes up, you can trade it back towards the midline. It goes down, you can trade it back towards the midline. Until it breaks one side or the other. See how it's broken out of this range right here. At that point, you're going to probably, or if you haven't already, you want to switch to more trend trading. Trend trading with the triple RSI is waiting for it to cross below here, and you can take a position and you can hold it until it gets all the way back out, or take it any time you have profit in here. Same thing on the upside. It crosses up, take a trade, and you can take it at any point in here that you like, or when it crosses back over down here. And then going the other way, you can take a trade anywhere in here, then you can sell it in here, or when it crosses back over. That'd be kind of a tough trade. It's kind of a scratch if you wait for it to cross back over. Basically, it's back into consolidating there. But if it goes from trend to consolidating and you're still in the trend trade, just wait for it to chop back down to where you consolidating for you, right? So with all that being said, let's hop back into some back testing and run a bunch of trades and see how it performs. You can see some good sample trades there. You see this one coming here, breaking down below, and take it anywhere in there. You can sell these, put a stop up there, and you can ride all the way down. It's a nice 6 or more risk to reward ratio trade there. It comes up on the upside here, breaks back above there, and buy that. Stop at the bottom, and trade all the way up there. It breaks back down there, and you're about flat. You have all that time there to take your trade off and make profit. Comes up here, breaks above there, and bottom there, and then you got all this. And if you're not up by there, you kind of messed up. And it's another great trade. See this guy here, comes breaks up there. Take that to the bottom of there, and right there. Look at that. A short trade here. Anywhere in there. Alright, well, thanks for watching. I hope you enjoyed that and you learned something about the markets. That'll help you become a better trader and investor in your own activities. And with, all that being said, I hope you have a great night. And I'll catch you later. Remember to like and subscribe to the channel. And, bye. Hey there, today I'm going to try to go over some risk management strategy. And it's my own special take on a rather traditional methodology. So I'm going to take some time to go through it. I hope this is, helpful for everyone who's watching and you all get some value out of it. So what are we going to be covering? Well, we're going to be covering a brief introduction of the wheel strategy in general, and then my changes to it. Then we're going to cover selling puts for accumulation purposes. We're going to cover accumulation and inventory management practices. And then we're going to go over selling call premium for distribution purposes. And finally, we'll cover some distribution and warehousing practices. So the introduction and background. First of all, what is this video exactly and what isn't it? This is more about risk management, how I look at my sizing, my risk, my business flow, my operational flow to help me keep everything consistent level, which is a very important part of any storage strategy. It's not exactly anything to do with any sort of indicators or entries, exits, anything like that. It's more about how I manage the value in my account, the value in different positions, how I move value around a sort of cycle and systematic way that I do my business. And I think everyone needs to develop some sort of framework for conducting their business and their business operation to manage their risk and help them, understand their risk, because it's hard to manage a risk you don't understand. And this is how I do that for myself. So what it isn't is, again, it's not like anything about buying or selling anything in particular. It's more about how I go about doing that and why, right? Now, first of all, we're talking about stocks and options. A stock is, if you're watching this, I assume you know what a stock is, but in particular, we'll be talking about the S&P 500, because that's what I deal, and that's what I have best examples for. I can kind of talk through plainly enough. And then the options involved are just contracts to buy and sell a intangible asset at a specific date and time at a certain price. You can also have them in metals market, commodities, whatever it is. It's just a promise to buy or sell something in the future. So like, for instance, if you wanted to say, go to your car dealer and be like, I'd like to buy this car for $25,000. Can you hold that price for me for a month? And he's like, yeah, I'd love to do that. Just put down a little $50 deposit. We'll call it a day. That's an option. And the same thing is done in most markets in the modern world, and that's kind of what we're going to be talking about here. Which begs a quick question. If people want options for stocks, how are they manufactured and distributed? Well, they're commonly done through premium sellers, different sizes, whether you're a large firm partnered with an institution to kind of do what they need to do around the whole Dodd-Frank thing, or you're a much smaller person in the retail space kind of
being quick and fast on it. One way or another, there's various parties of various sizes that kind of dedicate their time to manufacturing these options because people want them so dang badly. I was looking at a graphic the other day, and it was talking about total volume of notional S&P 500 that crossed the wire, and we got like 40% in a month was just short-term options contracts inside of a week. Whereas, for instance, before 2000, that number was zero. There was no short-term options contracts. So to see such a rapid adoption of a trading vehicle, right, is very interesting, and it's a very dramatic change for a marketplace that was before this whole thing kind of came about, relatively similar to itself for long periods of time. The stock market in the 30s was very similar to the stock market in the 80s and the 90s. But then that sort of all changed as tech made a lot of things a lot easier to do, made things a lot faster. You saw people kind of adding all sorts of derivatives contracts to all sorts of things that they didn't have them on before. I mean, you can get short-term options on individual stocks no one's ever heard of before. There's liquid options trading on it, which is just incredible when you think about all the back-end stuff that has to get done to have that accomplished, and have a liquid options market for every ticker and every strike on every duration is quite an undertaking. Just data-wise, speed-wise, we're talking tens of thousands of quotes a second that change every, a couple of times a second. And when you're talking about taking all that, putting it into packages, distributing it across the market so people can look at it or use it, stuff like that, it just takes a lot of tech. So it just wasn't something that people could do before. So that brings us to stock. Well, that's the traditional premium sellers, why they exist. And so the traditional wheel strategy is relatively simple. A put is just a contract to offer to buy something at a price. So someone who is an options writer will go ahead and write a put, which is offering to buy stock at a price. They'll usually write one at or below the price of the market. If they win, they get some money. If they lose, they have to buy the stock. If they end up buying the stock, they're going to go ahead and write a call on that stock, which is simply an offer to sell that stock, usually at that market price or a higher price. And if they win that, then they'll get the money. And if they lose, they'll have to sell the stock. Their whole idea being that over time, the average purchase price and the average sales price will be different by a spread if you wanted to sell them out of the money, or they're going to be equal to each other if they're sold at the money. Because if you're selling things completely randomly, then on average, your entry price is just a variable. But we'll get into that later. But that does bring us to the next bullet point here in our introduction and background, which is stock trading as traditional mercantilism. So traditional mercantilism, that's a fancy way of just saying how people buy and sell other things in a traditional manner. You go down to Walmart and you look at the way they're buying and selling their items. It's a very traditional manner. And it's very difficult to look at a operation that utilizes or distributes intangible products such as stocks, bonds, insurance contracts, anything like that, to look at that the same way you would as traditional, let's say, brick and mortar stores. But the idea is very, very similar. You're just trying to manufacture or purchase something. You either make it or buy it for less than you can sell it for. And you want to make sure that the costs on that production or that purchase can be financed, and the cost of that financing can be added to the costs of making or selling it or buying it. So when you sell it, you still make a profit above your financing costs. It's a business, and that's going to be the same whether you're a Walmart or a premium seller. So it's something that it's kind of a different perspective, I guess, than most people approach the market with, where a lot of people come in here and they're looking to do the proverbial buy low, sell high. But that's looking at things just differently, where Walmart isn't exactly trying to buy things low. They know that they can
because they have things like scale and connections and stuff like that. They're not exactly bidding on things, right? They have a price, and that's their price. They'll buy it at that price. If no one wants to, if the people selling the thing to Walmart don't want to sell it to them at the Walmart, what Walmart wants, Walmart will go elsewhere. And that's the sort of thought process you have to take, where we're not bartering over goods. We're producing something, and then we're distributing it. So it's all about consistency and operational flow and managing some risks that come along with doing this sort of thing. So I guess that kind of takes care of the next bullet in a lot of ways. You can have goals and risks, and then it's not what you think. Ideally, your goal is to beat your financing costs, which is a lot different than other people's goals. And a lot of people just come in here and look to do something silly like triple their money. And risks. It's not exactly losing a trade, where when you're selling premium, like, if you're running a wheel, when you lose a put, well, that's part of the game plan. You have to lose a put eventually to buy stock, and then to eventually sell that stock, you have to lose a short call. So it's kind of an operational flow that just kind of pushes money around in a circle. So the risk isn't exactly losing. That's not really what people think. It's not kind of how people look at it, but really your risk is all liquidity related. Let's call it getting locked out, where you have so much stuck into one part of the cycle, you can't progress in the cycle, and things kind of grind to a halt for a period of time. And that's going to be your greatest risk when writing options, really, in my opinion. Unless you're doing it in a different way, in which you're realizing lots of cash losses and you're not holding any inventory or anything. But as far as what we're talking about here, and traditional wheel strategy, and then my broken wheel take on it. So, all that introductory blather out of the way, let's go ahead and jump into step 1, which would be writing puts or selling put premium for accumulation purposes. So there's various ways you can use put contracts traditionally. A lot of people just love to freaking buy them to speculate on these days. Try to buy it for $50, sell it for 60 or whatever it is. Make quick $10, whatever the right area is there. Unfortunately, that's a predominant part of the market. Most people who trade short-term options are buyers, just by numbers, not by money. The greatest number of traders tend to be buyers. The largest traders tend to be sellers, if that makes sense. And that's just kind of part of the way it works, because it takes a lot more capital to sell an option than it does to buy it. So even though the risks are even, each side is, statistically speaking, putting up the same amount of notional risk. Your chances of making or losing $100 are about even, if you're talking about a $200 option. But to sell that option, it's going to take you thousands of dollars in collateral, where to buy it simply takes you $200 or less in cash. So just by the product of that truth, most people tend to buy them as speculative instruments, as cheap leverage. But it's not exactly cheap leverage, because if you're actually just going to take a loan to borrow the same amount of money, you pay a much lower interest rate. This is sort of like if traditional margin trading is buying stocks on a business line of credit, trading stocks on option speculatively is sort of like buying stocks with a credit card, an incredibly high interest rate on it. That's also why I tend to sell them, and a lot of other people tend to sell them. That's a big idea behind it. So traditionally, in a traditional wheel strategy, where you're selling the puts to buy the stock as one lot at a time, to sell the calls and then sell the stock one lot at a time, it's a very slow process, where it's just one contract, If it works, you take the money, then there's another one. And it has a fairly decent lockout risk to it, where if you get into, too many short puts and you get assigned too much shares, and the price of the stock has dropped too far from your cost basis, you might not be able to collect much premium offering the calls back to the market. Which doesn't mean you lose money, it just means you make a lot less of it and you might have to wait a long time. But that's still a risk, especially if the entire idea of the operation is to beat a financing hurdle, right? So how do I get around this? Let's talk about my broken wheel. Let's call it modification. Tristan's broken wheel strategy here. So instead of running round lots, where you sell an entire put contract to buy 100 shares, to sell an entire call contract to sell 100 shares. What you could do, if you wanted to do the math and be clever, is, especially with how liquid and fast the markets have become in the options, you can sell a put and then you can utilize a stop, or you can utilize a limit order on a lower contract, something that will limit your risk in the event the stock falls. So instead of taking assignment on a whole 100 lot of shares, when the trade doesn't do exactly what you expect it to, you can simply take assignment of 1, 2, or 5 shares. That's the idea. And what this allows you to do is reduce the chances of getting locked out. So it reduces your major risk on the strategy, but it increases your workload. You're going to have to do a lot of work relative to just writing a single options contract once a month. Because you're doing, at this point, we're talking to make up for a standard, $40,000 to $60,000 spy wheel that runs 12 contracts a year. You're probably talking at a broken wheel at 40 to 60K, you're probably talking several hundred trades a year, especially if you really want to milk those 0 and 1 day options that they have recently added to the marketplace, where the exponential decay on the time value is at its greatest point. This is a little bit from my options guys here, but as a percentage of your risk, let's call it interest charged on the options contract is exponentially greater. So a week from expiration, if nothing happens, the contract might lose 20% of its value as measured by what it started at that morning. The next day, it's going to lose, say, 15-30% of its value, something like that's going to lose more. And in those last 2 days, it's going to measured by its relative starting point each of the mornings. It's going to lose a lot. So what I tend to do, and what I tend to go after in this is, and the reason I do it this way, is I want to capture as much of that short-term decay as possible. So that's how puts are used differently in the broken wheel strategy. So let's talk about accumulation, inventory management, size, scale, and, risk management as well. And just kind of lob it all into accumulation and inventory. And what's going to happen is, as the broken wheel makes its turns round and round, it's going to produce a lot of trades. When those trades go well, they're going to generate cash, which can be immediately recognized. But when they don't go well, you're going to have to accumulate inventory. But that's fine, because what that is doing is it's shifting out an otherwise recognized loss into an unrecognized loss, into a product that will probably make a profit if you give it enough time. We're talking the S&P 500. So along with the options you're able to write on it, it becomes very unlikely you're going to be forced to recognize that loss if your timetable is indefinite. So we can use that to our advantage.
And essentially, as long as everyone keeps working and piling into their retirement accounts, there will eventually be someone who wants to buy it at the price I want to sell it for. That's the way I think about it anyway. So that's how your accumulation's going to work. I'll pick up, 1, 2, and at most 4 or 5 shares at a time. And it does take time. I mean, it really only trading 15 to 20 trades a week, maybe, is what I do. Sometimes I'll do a little bit more on the put side, a little bit less, but that's probably a good average. So I try to win a good portion of those too. So I'm usually only taking like 5 to 10 shares a week is probably a good eyeball on it. But even that, that seems a little high. There are times where it's much lower. And then you'll be distributing at the same time. So it's not exactly like you pile up 5, 10 shares a week. It's just that's what your total accumulation is. Or at least what mine tends to be. So let's talk about size and scale and inventory management. What I kind of mean by that is how much available inventory do you want to be able to take on versus what you're running. And basically I try to set it up so I'm taking I try to have 2 years lead time, if that makes sense. So I understand what my average purchases are a week off the short puts. I know what my average sales are off the short calls. And then I judge how my trade frequency and my size, my risk, which governs how many shares you accumulate when you do lose, is your risk on the individual trade. All that's governed by a 2-year lead time. So if things stay as I'm used to them being, I can continue to do it for 2 years when things aren't working out and I'm not being able to distribute. When I'm able to distribute, you can run, it has an indefinite lead time because you're getting rid of shares faster than you can buy them. So that's not a big deal. But we're just talking, it's more of a risk management thing where you're all right, in the worst circumstances, how long can I continue to pile these things up before it becomes a problem? And I tend to like to have 2 years or more. Like I said, a 2-year lead time to just kind of give me, when you're talking with indexes and stuff like that, it's really hard to see a 3-year bear market. It's really hard to see a 3-year bear market, especially with inflation and everything. It becomes really tough. So, end of the day, inflation will save your butt. Well, that's the idea anyway. If all else fails, right? I guess that kind of covers risk management at the same time. I probably should group those together. But your inventory management and your size and scale, that is your risk management. And that's kind of the entire name of the game. If you notice, I haven't said anything here about when to buy, when to sell, when to take inventory. I haven't brought up a single chart. That's not what we're really talking about. We're more talking about how to manage the back end, how to size things, how to defend losers, stuff like that. So let's talk about using call sales or short call premium for distribution purposes. Traditionally, in a wheel, short calls are sold individually, like I said before, on sort of a month-to-month basis. When the call expires in the money, the shares are sold. So I do it a little differently, and it's not as frequent as the put sales, where in my broken wheel, I'll be writing them constantly. It's much more dependent on the cost basis of the inventory I've accumulated. And that's where we get into the nuances in risk management, where the call strikes I'm writing and when I'm writing them are based on what I paid to accumulate the shares and the additional premium I've collected on other calls. So often I have a accumulated or carried loss that I'm assigning to my inventory. So let's say I have an average cost of, I don't know, just pick a number out of the middle of the air here, 400 on my shares, and I have a carried loss of about 20 bucks a share. So that means I'm trying to write my short calls at strikes at 420 or better. And if I can't do that, if we're trading too far below 420 for me to collect premium on the 420 strikes within, say, a couple of days to a week, I'm probably just not going to write the calls at all. And once we start to approach that number 420, I'm going to write the calls more aggressively and closer in time, to the point when I'm writing them basically at the money, in like 1 day or 0 days out, to just offload the shares once we get to that point. So it changes a lot more than the puts, where the puts are sort of just the same thing over and over. This is kind of dependent on how that other operation falls. But the idea is you're just trying to cover your losses with your call distribution. Right? That's generally what I'm trying to do. So that I can kind of have a environment where when I make money on my short options, I get to put it right into my pocket and book it up. And when I have any trouble on any of my open trades, I just kind of defend it and roll it around, and I'm never actually forced to recognize anything red, which makes me feel nice and comfy. It's not like I don't lose money. I mean, technically, when you buy something and it decreases in value, you've lost money. But if you don't sell it, well, you haven't lost money yet. It's just kind of like a mark-to-market thing. So I like to make the joke that I never lose money, but like notionally, if you look at my net lick marked to market day to day, yeah, of course, it goes up and down. But as far as realized wins and realized losses, we're only realizing the winners. All the losses get kicked around, cans get kicked down the road until they're no longer an issue, even if that takes a couple of years. So, distribution warehousing practice, I kind of went over some of those already, where I was talking about how long you want your runtime to be, and you don't want to get locked out. That's your major risk when you're running wheel strategy, whether it's a traditional wheel or kind of a fancy augmented one like I'm talking about. I do. But generally, your warehousing is, I consider it how you account for your shares, and it's more like accounting warehousing. It's the same thing, because these are intangibles. I tend to look at it as a last in, first out sort of thing, where I end up holding the shares at the highest cost basis for the longest period of time. But that's kind of more preference and stuff like that. And then risk management is, again, you want to kind of have that 2-year lead time, or like for me, I can hold, say, just kind of talking about my own sort of practice, I could probably hold about 350 SPY shares. So running a plus minus, I do, my average accumulation or distribution runs at like usually 5 to 10 when it's bad, and then even or negative when things are neutral or bullish. So in a bearish drawdown at 5 shares a piece at 50 weeks a year, that gives us like 250 for the first year, and then like 250, so it could get to 500. Like, so it's about 2 years, year and a half lead time. That's under the worst circumstances. And I can always pull in more cash if I need to. So that's kind of how I look at my lead time and my lockout risk, and my warehousing. So with all that, I'm going to hop into some examples, looking at the chart, just kind of talking about sort of some of the topics I covered to give a more. So if you watch this far, you're probably sort of interested in what this really looks like in the real world and in practice and stuff like that. But I'm going to try to provide a couple of examples. This is kind of just how I set up a short-term TQFM wave setup off the fractals. There's a bunch of these running in the background as well. The whole idea behind this is the market keeps a similar reciprocation through momentum across all sorts of measures, literally every measure. Sort of is a bifurcative process. And I just kind of measure and trade around that, as a lot of people do, whether they know it or not. Actually, the reason it exists is because of the way they think and trade around it. So if they aren't directly a supporter of it, they are a contributor toward it, unbeknownst, right? So, essentially what I'm doing is I just kind of use these to play momentum, and I very much am a momentum trader. What I'm trying to do is buy stocks at lows during the day and not be in seriously risky positions when things have a chance of falling. So what I'll do here is, something like this. I'll see momentum building somewhere in here, and I'll just take a stop, or I'll just buy somewhere up on here or down in here, somewhere along this first pop, with a stop down here at the bottom, like everyone else in the world is doing. And that's exactly why this happens. And say it were to lose, say it's going to come down here and it's going to hit my stop. Well, what I would do is I would go ahead and say, on this put I lost $30. So I'm going to buy 2 shares. I'll buy 2 shares at, say, $3.95. And I'm going, let's say I lost $30 and buy 2 shares, so I'm going to add $15 a piece. So that brings us up to $410. Yeah, $410. So what I'm going to do is I'm going to buy those shares at $3.95, but I'm actually going to book them at a cost basis of $410. And then when I go to sell calls later on in the cycle, let's say this was much higher, and we're writing calls on these downward momentum waves, or writing calls as these kind of get overextended to kind of buy back into the other wave, however you want to trade in general momentum cycle, however you read it. This is kind of how I do it, to kind of give an example of what it looks like. Anyways, then when we're selling calls on the other side, we're looking at prices around 410 for those related shares to be distributed off a call, a short call that loses. So we're going to wait till it gets to about 410 or so. In this instance, say we bought all the shares at that same price. Then it's going to get to about 410. And we're going to start writing calls against it on downward momentum waves. And whenever we lose one of those, I'll sell a share back to the market at 410. And because I did that, the difference between where we bought it and where we sold it, and then the premium involved, is going to be greater than the loss incurred on each side, which means that you can just kind of ignore the losers. And that's how I kind of look at it. And that's kind of a sped through example. But, if you're familiar with my other content talking about my business and other stuff on my channel, then that really shouldn't surprise you, because I've talked about it quite frequently. If you watched all this, thanks for watching. Make sure to put any questions you have. I'm sure there's tons of them. I'm sure this long video I missed a bunch of stuff. So make sure, if you want to learn anything, like anything specific, have a question about, make sure to drop in the comments below. I'll do my best to get around to answering them. And thanks for watching. You have a wonderful night. Hey there, in this video we're going to go over how to use a triple stochastic trading strategy and how to use multiple stochastics in general to better understand trend and reciprocation inside of said trend. To do this, we're going to use some commonly available free indicators that everyone can play around with and see for themselves. Forward test, back test, see if it's going to work in your own tickers and time frames. And learn how to understand what the market looks like evaluated through stochastics in general, because it will make you a better trader and investor. Before we begin, I'm the Augur of Avon, and this is TQFM Trading Strategies. I trade stocks and options and make videos about it to help you guys become better yourselves and kind of open up your mind to all sorts of different possibilities. Well, with all that being said, we're going to hop right into the chart. Let's start with how to set up the indicators. So you can use 2, 3, 4, or several stochastics at varying lengths to use this sort of methodology. Here, We have the first one set at 10, the second set at 100, and the third set at 300. Chop the market up into 3 different moving averages. We have the stochastic that alternates back and forth on a 10-minute cycle. We have the stochastic that alternates back and forth on the 100-minute cycle. And we have a stochastic that alternates back and forth on a 300-minute cycle. So the way that this works is we can look at the short-term stochastic for the individual ups and downs inside of a larger trend. We go to the next largest stochastic and use it to demonstrate the overall trend up or down. And we can go to a very slow stochastic to look at the strength of that trend relative to others in its local area. So the way that this would work is we see the middle stochastic crossing below the midline, signaling that a downtrend may be forming. And we see it pick up some steam, cross below its lower bound, and hold there for a little while. We see the longer term stochastic follow it. Then we see the short term stochastic pop up with some short term buying. This is where you could take a short trade, like so, and then as it follows down, you see it push one and come up and make another one. And this is where things get really important. We watch it trade around until this point here, where I guess it hasn't. I guess this point here, somewhere up in here where it breaks the fast stochastic to the bottom. At that point, you adjust your stop to the last high. So you're in it there. So you're in it there. You come out to this next low in your short trend, so you can adjust your stop to break even. And you do get stopped out, but it's no big deal. Let's look at some more. This is a nice trendy one. So we see the stochastic coming down below the 50 and holding there for a little while with some big red bars signaling a downtrend, maybe beginning. And then it comes up to touch the top of the short-term stochastic. We can look down at the very long-term stochastic and see that this is, relative to other trends, has some strength. So we can take a short trade here off this high where it crosses. We put our stop at the last high and we can wait. It's going to come down, it's going to make the first low, it's going to come up, and it's going to make another low. Each one of these, since this is the last high, don't adjust your stop. And it comes up here, it makes a high, and then you gotta wait a long time for it to get back there. And you probably got stopped out on this one for probably about even. You probably would have adjusted your stop to break even somewhere around here. And that would have taken you out because you're already below it. So let's just grab another one randomly. Let's see, this one's kind of popping up. This one would have stopped you out as well. And this looks like it's going to hit you a lot. And that's sort of what happens. But they're very small. And this is going to be a decent trendy one. We see it breaking above the 50. We see it come down. You see it's not super crazy, but it's something. So we can take a long here. Stop down there. See it comes up, makes new highs. Bottom makes new highs. So you can adjust your stop to this low, which happens to be just about break even. And stop you out. Feel free to take profit anytime along the way as well. This is just a way to minimize your risk and trade on the stochastic trend, right? So this is a super trendy one. We see it coming down here, breaking below. We see it come up here, so we can take a short, and that's a long. We can take a short. Let's use this bar, be conservative, or be aggressive and say that we took the, just for risk reward, conservative. This, we go up to the last high. And we watch it come down, boom, and come up, and then come down, boom, again. So we get to adjust our, no, I can't go reverse like that. Okay, so we get to adjust our stop to this right here. It goes down, boom, comes up, comes down, boom, comes up. And then it comes down and hits it here, so it's gone from the top to the bottom down there. So you can adjust your break even to the top there, and it stops you out. So you made some money on that one. And then on the way, I want a guys, it's a very choppy market. I want something, yeah, it's a nice trendy day here. So we can see it down here. I think this is the one I used for the thumbnail. So we can see it come down in here. This is a nice big push here. It pops it up over that. It comes down, catches it here. So you can take a long because it's still holding above there and it's above there, right? Long on this. That's a short. What am I doing? And you take a long on the yacht, and then It comes up, hits the top, comes down, hits the bottom. So you can adjust your stop to the bottom there. Then it comes up, hits the top, it comes down, hits the bottom. Same one, same level. It comes up, hits the bottom. It's all the same level. And then it comes up and hits the bottom, so you can adjust your stop. This low there. And then it comes out and stops you out. And you made like $26. And when it doesn't work, you're most of the time getting stopped out at break even. So it's very similar to some ways that I do some things. This one also worked here. So it comes down to here. This is actually kind of happened back up here. Well, this stochastic breaking below there. You use these highs. Comes down here, makes a low, makes a high. So you could use that, I guess, or you could use this. So let's be conservative for demonstration's sake and say we use this. And then it's gonna come down. It makes a low, it makes a high, and then it makes a low. So you adjust your break even there. And then it comes and stops you out. And then it makes another low. You just stop you out one there. You're going to get stopped out one way or the other, but the question is, where is it going to stop you out, right? Is it going to stop you out like a penny below where you entered, and at the same price you entered, and be on an equal low because the trend gets broken at that point, or is it going to carry and continue? And you can make this faster if you want faster reciprocations to update your stop quicker. If you want, a more reciprocations inside of a trend, you can make this one faster, or you can make this one slower and make this one faster relative to it. And if you want a better idea, lay of the land, you can use this guy and you can either back him out like wicked far to represent like a daily chart or something, or you can move him in to be almost the same speed as this to kind of give you a sort of oscillator up and down. But it's all sort of preference, and a lot of people do this a lot of different ways. And this is just kind of one way you can do it, and it's something I play around with because just understanding the way that this kind of fractal reciprocates back and forth will give you will teach you a lot about how the market functions in general. Because it's all sorts of trends. Like these are little trends, and these little trends have to be strong for this one to be strong. And then this needs to be strong for this one to be strong. So that's just kind of how the market is. It's just kind of a relay, passing back and forth over time frames. This is one group of people who will buy because they're super aggressive and they see a little short-term bottom, so they're gonna try to buy with stops below that. And if they don't get stopped out and they make money, other people are gonna see that, and then they're going to get on the adoption cycle. If that makes sense. Like these are the first people to buy the iPhone, right? And if the iPhone's great and they love the iPhone, then these guys also buy the iPhone. And if this is great, and both these guys have a great time with the iPhone, then these guys also eventually come and buy the iPhone. And that's what I mean by it's not like an adoption cycle. And that's all the market is just infinite series of adoption cycles playing out on all sorts of time frames. And using multiple stochastics lets you have a very consistent and relative way to monitor that and measure that, to trade consistently around that reciprocating fractal. So what are some other things we can see when we take a look at this kind of pattern here, this fractalization? Well, we can also say that if the two longer term ones are trading in the particularly bearish zone down here, there's a lot of selling, then it was probably above average time to take reciprocations counter trend in the shorter term. So this one comes up and hits the top. We see these two are still down at the bottom. So there's above average chance that this one is going to result in a quick reciprocation to the downside to continue these trends. And if it doesn't, well, these trends will fail, like here, where it came up and it didn't make it, and then it pushed these back up above these and it didn't work. It actually came back to just about flat to where you entered there. That's all if the market's marking up or marking down in short reciprocations, and that will build the larger term ones, and then the larger term ones will build the even bigger ones after that. To take good here, like this one had to be strong to push this below, and then this had to be strong to push this below, so that if these are both below still, when this gets back to the top, it's probably a decent time to take a short for the reciprocation down to where they're both, well, to where they're all, because it likes to all get back to the same spot,
First is all break apart. And all this is predicated on the fact that if this wants to continue to go down, the downward moves on these have to, on average, be stronger than the up moves on these. So if you want, a good way to take 50-50 bets, you wait for it to go down, and then you start 50-50 betting on it to go down until it's going up, and then you can start 50-50 betting on it to go up in the same way. And there'll always be one that catches you off guard, but if you're, risking one to make one and you win 2 or 3 for every one you lose when the trend breaks, you'll do alright. It's another way to optimize off this. So you can say sort of here, for instance, the medium term one's kind of at the top, the longer term one's kind of in the middle, and the short term one's at the bottom. So like right here in real time, if you wanted to, you could take a trade. And what we want to do is we want to find that last low down here that broke the bottom, and we can wait, and if this continues to stay nice and bullish, then by the time this gets back up to the top, this should be back at the top here. That could take a little while, and yeah, we'll see how this works. Paper trading in real time. So we can see it ultimately didn't work, but before it did stop you out, it got back up to the top of the short-term stochastic and gave you an exit. So it reciprocated, just not enough to make you any money. And we can see that trend broke after that, and we're going down. So if you're using this methodology, you'd probably be waiting for this to get back up toward the top, or at least above the midline. Take a short to see if this trend would continue. Anyways, I hope you guys enjoyed that. Thanks for watching. If you like that, you'll like the other ones on my channel, so make sure to check out those as well. And I hope to see you guys around. Hello, I'm the Augur, and the channel is TQFM Trading Strategies. I trade stocks and options and make content to help you take your own trading and investing to the next level. So if that sounds awesome, make sure to like the video and subscribe to join my little growing Augur army and help us grow, take over the entire world with future talent. Starting out in trading is really tough. I remember exactly how hard it is to learn how the market works and how to use all sorts of technical indicators to understand price action and market structure. You can spend days and nights just staring at the market trying to understand it, pulling out your hair. And this video is for you to help you understand exactly how that market works and help us all become better educated traders and investors. So in order to do that, we need to understand the math behind the market, the gearwork that makes it tick, and how to read that through the use of math and indicators. All this math is specifically designed to peel back the mystery behind price and the markets and help us understand what market makers and algorithms are doing to move price around and target you and other retail traders. So make sure you watch all the way through the end so you fully understand everything we're going to cover today, so you can learn as much as you can to help better defend yourself from everyone who's out to get you. So in this video, we're going to be taking a look at how to use a double Ichimoku Inko Hayo for either scalping or some sort of swing trading. And you can use it on the 1 minute chart, the 5 minute chart, whatever you want to do. It basically is just using the fractal patterns that are present in the market to better understand trend and make decisions based on that. So what we're going to do today is we're going to talk you through how the strategy works, how to set up the indicators for the strategy, entries and exits for both bulls and bears, and we're going to do a little bit of back testing to see how it works using real market data to see if the double Ichimoku strategy is helpful and useful in today's marketplace. So let's get going. So this strategy is actually quite similar to a lot of the other strategies I've shown on this channel, where it operates on a sort of trend inside a trend function. But the Ichimoku Inko Hayo is a very interesting indicator, which has several trends inside of it already. So it already does a somewhat decent job of displaying the sort of fractal pattern I look for in the markets. And this is just deviation over time. It can deviate a little bit or it can deviate a lot. In either way, it always reciprocates back to a mean over time, because that's just a function of mean reversion and moving averages in general. It doesn't mean that it's going to be higher or lower when it gets back to those means, it just means it's going to get there eventually. At least when we're talking about the shorter term charts. If you go out to like a monthly chart or a yearly chart, it doesn't actually have to get back to the moving averages. Inflation, growth, other things, keep it far away from those for, well, ever. You will die long before it gets back to a 1,000 year moving average, I bet, but who knows. Anyways, back to this. The way this strategy functions is similar to a lot of other ones. We're looking for it to, well, the way the strategy works, let's break down how the indicators work first. You're going to have two Ichimokus. The first one you're not going to touch. It's just going to be your standard settings, conversion line of 9, baseline of 26, a leading span of 52, and a lagging span of 26. I usually turn off the lagging span. The second one, the slower one, is just going to be twice as long. You have an 18 conversion line, a 52 baseline, a 104 lagging span for the B length, and a lagging span of 52 for the initial. And I go ahead and turn off that lagging span, and some other ones for the slow one, so because those are actually just going to sit on top of the other lines, so you don't really need too many other lines. What you really want to look for is you got these two fast lines here, and then you have these two slower clouds. When the fast lines break below both clouds and price is trading below both of those, you can look to take a trade in that direction. You can use the clouds as your stop, and what you're looking for is a fractal exit. And let me explain how that works. You see, you have a bunch of lines here, the blue one, the red one, the greenish one, and the orange one. And those are all going to be the ones that aren't part of this white cloud. So if you're using the white cloud at stop, that's your exit, you want to be taking profit on a faster fractal of some measure. So watch what happens. It breaks down below this and the trend is continuing. This fractal line, this mean reversion, is going to push, push, push. And then it kind of makes this little, basically it's making a trend, right, as it goes. And then when this orange line encounters price, that's usually my exit on a fractal trade, at least a trend trade. This one didn't work amazing, but it's just an example of a bearish trade. A lot of them do work great. And really, all this is about the risk to reward. You can get a really tight entry with a little bit of risk and a decent play on it. The idea is, well, hopefully you get a decent, you're looking further back to optimize this with some sort of support and resistance or something like that to get better entries. But worst case, you can always use the fractals. So let's look at some more of these fractals. So let's look at a couple more of these fractals. Let's look at the next one. It comes up, let's say you stopped out of there or you didn't, either way. It comes back down here, it gets back up into these little lines here. Let's say you're going to take another trade. So you're going to take a short again, your stops are going to be above this cloud, and you're just going to let it trend. And you're going to see let's use the orange line here. And you can see the orange line working its way along. You can just drag a line, just keep dragging that line. Just keep dragging that fractal line. And it's going to get all the way down here, and it's going to hit price either here or down here. And that'll be your fractal exit. See, you entered here, you started tracking it at literally the same price, and you just dragged it down the entire way. Let's look at this trade to the upside. It comes and breaks out of these. You can take a trade anywhere in here with a stop down here that's about 3-4 points. Then you're going to follow it up here. You start drawing your line. You start drawing your line, following the orange one or the green one, or following the orange one in this case. Drawing your line, drawing that orange line, drawing that orange line, drawing that orange line. And somewhere up in here, it smacks the orange line and it cuts you out. And you see that's a really good trade. It took, maybe 6 points in risk, and you made 18 or so. So there you go. So some of them have really good risk to rewards, and even some of them that don't work, like if you look at this one here, it definitely didn't work, right? Come in, you breaks out, wait for it to get back in between these two lines, take a trade, you're looking down here at like either the green one or the red one. Let's use the red one, we've been using the red one, so, and track it along, you're hoping it goes up, and it just doesn't. So somewhere in here, there and there, you take your loss, and that's still a very small trade. It's honestly, it's
the bars that break it are like almost touching bars that touch your entries. So it's almost the same price. And it actually saved you, if you think about it, taking your loss there versus taking your loss there. It saved you a point or two. So when you're only taking a couple points in risk on these sorts of trades anyway, saving a point or two on taking the first fractal versus the other fractal. Alright, and to test out the double Ichimoku strategy, I've gone ahead and set up a back test on Ethereum. So we're going to go ahead and run 100 of those, and I'll be right back with you after the quick little montage. And I'm back with the back test. You can see it performed pretty admirably. We took 100 trades. We had 36 winners. We had 64 losers. So we had a 36% winning percentage. Our average win was $46. Our average loss was $12. So that's about a 3.75 risk to or reward to risk ratio. It took us about 12 days or 4,600 bars. That could be a quite large annualized leverage return. Granted, it doesn't go bust. You can see it had some big winners and then a bunch of little losers. And it's kind of how it looked like in the beginning and kind of how I explained it. So it did sort of how we expected it to do. But it was a pretty trendy market over the last couple of weeks where we tested it. So it might not perform as well in a choppier market. That being said, make sure to backtest it on your own time frames and tickers to make sure you've learned everything you can about this strategy to help you in your own trading and investing. Alright, thanks. Glad you. Well, thanks for watching. I hope you enjoyed it. If you like that, you'll like my other ones on my channel, so make sure to check those out too. And I hope you have a wonderful night. Bye. Hello and welcome to this exciting video on trading strategy. In this video we will discuss a powerful strategy that you can use to become a more informed trader and investor in the stock market. We will cover everything from the indicators and settings being used to implementing a solid entry and exit strategy. But before we dive in, I want to encourage you to watch this video until the end. You won't want to miss any of the crucial insights and tips we will be sharing, as this strategy uses free and widely available indicators so you can follow along while you do. And if you find this content valuable, please consider hitting the like button and subscribing to our channel to stay updated on our latest trading strategies. Also, we'd love to hear from you in the comments section. Let us know your thoughts, questions, or even your own experience with the strategy and backtesting. So, without further ado, let's get started taking your trading game to the next level. Alright, let's get started on the median commodity channel indicator strategy. So as the name indicates, it uses two free indicators, the median indicator and the commodity channel index indicator. The settings for the median indicator, and we're going to change the median length to 10, and we're going to change the average true length to 100. And we're going to keep the average true length multiplier at 1. Well, actually, I think we brought that down from 2 at the original outset. And the settings for the commodity channel index are going to be set to a length of 33 with a smoothing of 5 on the simple moving average. This is going to give us a set of indicators that work pretty well in tandem. You can see when trend is going up, the commodity channel index does a good job of showing that by trading above the midline. And when it extends above previous highs, the commodity channel index pushes above that upper bound. And the same thing on the low side. Zoom in right here and see it's trading a trend. This trend is broken and then pushes down past this prior low here. It pushes down to the bottom of the commodity channel index. So we can use that to trade trend and reciprocations in a way that we have in a lot of other indicators on this channel.
So we could say that when this is to start a trend, this needs to first break out of the top here on the commodity channel index. And we can see that with it moving above the median. So we could take a long here. And we could do it on the big bar just for the heck of it. Then we're going to bring our stop down to the purple area there. It doesn't have to be exact. I give it a little bit of room because sometimes it tags it like there. I mean, it's just the last average true range. So I give it a little bit of space beyond that purple area. You don't have to be exact. I don't really have an exact measurement for that. I just use like a couple of ticks beyond it. Then we're going to look for 2-to-1 restored ratio. And that's the entry and exit example for the trade on the long side. So let's look at a short. This one looks like it might not have worked, but let's take a look at it anyway. So take a short position as it breaks down below there and take that short, or move it to the top of the green right there. And no, we definitely didn't get it. So you would have gotten stopped out when it broke back above here, but then that was your entry for the long that we showed you earlier. So let's look for a short example. It's a pretty good short example here. See, it breaks the bottom there. Probably take it to the top of that green band. You look for 2-to-1 restored ratio, and you get it there. Let's look at this another long example here. It crosses above there, and by that, you gotta put your stop down the purple area. You look for a 2-to-1 restored ratio, and you get it there. You can probably modify this by adding a longer term trend rate to give you a better idea of overall trend in the marketplace, as well as perhaps you could add another median indicator or Bollinger Band at 2 standard deviations to give you better stop placement if you don't like to get stopped out as much. Getting your stops tighter is ultimately what you want to do, even if you end up getting a lot of smaller losses, as long as you're able to get some nice big trades, right? Another way to run this is to just try to hold it as long as you can. So once it breaks up here on the commodity channel index and indicating a trend is starting, try to hot potato it and hold it as long as you can in that trend until you see it start to break below the commodity channel index, indicating it's ending this longer term trend. But that's probably easier to do with other indicators than these, but you can do that with this strategy. Anyways, let me know what you guys think about this one, and hope to catch you later. To wrap things up, we hope you found the information helpful and insightful. If you have any questions or feedback, please leave them in the comments section below. And if you enjoyed this video and want to see more like it, please consider liking and subscribing to the channel. By doing so, you'll stay updated on our latest trading strategies and tips, helping you become a more successful trader and investor. Remember, trading is a constant learning process, and we're here to help you every step of the way. So thanks again, and we'll see you in the next video. Hello and welcome to this exciting video on triple Bollinger Band trading strategy. In this video, we will discuss a powerful scalping strategy that you can use to become a more informed trader and investor in the stock market. We'll cover everything from indicator settings to trade to implementing a solid entry and exit strategy. But before we dive in, I want to encourage you to watch to the end of the video, that you won't want to miss any of the crucial insights and information we will be sharing. Now, this strategy uses free and widely available indicators, so you can feel free to follow along while we do. And if you find this content valuable, please consider hitting the like button and subscribing to the channel to stay updated on our latest trading strategies. Also, we'd love to hear from you in the comments section below. Let us know your thoughts, questions, or even your own experience with scalping. So let's get started and help you take your trading game to the next level. As the name implies, this trading strategy uses 3 Bollinger Bands. Let's start with a fast one with a length of 10. We set the standard deviation to 1. The second one, we have a length of 50, and we set the standard deviation to 1. And the third, we have a length of 100, and we also set the standard deviation to 1. This gives you a series of overlapping bands, and I like to set them up so the longest one, the slowest one, sits on top of the faster ones to give you this sort of fan shape to reflect price reciprocating inside of trend. So the way that you'd use this, the way that I use this, is I use the longer term trend and the shorter term trend inside of it to create a sort of jump roping situation. What I like to do is wait until the price breaks down below the longer term band or breaks above the longer term band, and that gives me a trade. So in this instance, we take a short trade here at the close of this bar. I like to put my stops around the length of the longer term, or the other side of the longer term Bollinger Band, and I'm going to let it run for a little while. The idea of this trade is to hold it as long as possible, and I tend to use it to sell premium, but you can use it however you want. In this instance, this one would continue all the way until it broke the band on the other side down here, which is a pretty decent trade. That gives you a solid 13.28 risk to reward ratio. However, this is probably one of the better ones. Most of them do not have that kind of risk to reward ratio, but they can, and that's the point. So let's look what happens when it doesn't work. The trade immediately before it, if you wanted to take a long, you wait until it crosses the band here. You could probably buy that, put a stop below, and let it run. And it's going to run, it's going to run, it's going to run, and it's going to stop you out. Which isn't that bad. And if you wanted to get out, you had plenty of opportunity to get out and take the trade. When this band crosses back a little here, you could probably exit for a break even, or when it comes up, it starts breaking down back down into these, you can take it off there. You have plenty of chance to get out if that's how you wanted to play it. But ultimately, that one didn't work. Let's look at another one that worked. This one here, it comes breaks below. You take a short there. Move one there. You're gonna let it ride, and it breaks back above over here. So if you hadn't already taken it off when it started breaking back up into the band here or into here, or even if you were smart and you took off one of these lows, if you used a faster reciprocator like a much faster length RSI or stochastic, and you kind of held it for a good amount of time, you waited for a low in trend to take it off, you could do that too. Trying to maximize your risk to return. Try and maximize your risk to reward. But in this case, you made 1.4. Another one here, breaking up above. Take a long. And it goes like that. It goes like that where you're going to stop out. So the entire idea behind this strategy, and let me know if you've heard this one before, a common adage in trading is you want to cut your losers quickly and you want to let your winners run. And this is simply a very consistent mathematical way that I attempt to do that in my own trading. I obviously have different ways to maximize my entries and exits. There's a lot of time where I use this as a longer term trend identifier and I'm trading faster reciprocations inside of it. Sometimes, I also, measure the average time it stays above and below this band by calculating the absolute value of this band relative to this one, and then it gives me a nice reciprocated one. And I can start saying things like, well, this thing will last about 100 bars in general, and this has lasted, 250 or whatever. So somewhere around here is probably where it starts to get old, and I can trade a counter trend, or however I'm going to do it. I use this sort of idea in numerous ways, and I'm not the only one who does this. This is a idea behind a lot of indicators in one way or another, where you're looking at changes in momentum over time across different time frames. So if this sounds interesting, I suggest you experiment with it on your own tickers and timeframes to see how it performs for you in back testing and forward testing. I personally like this for selling options, because in the way that I do it, a lot of times it burns a good amount of time, even if it's going to stop you out, and then stops you out pretty close to where it got you in. You know what I mean? So if you're short an option and you have enough theta decay, this trade, even though you lost because of price, could very much have ended up as a small winner or a scratch break even. And then in that case, when it does run, I can really milk that short option as much as I want. So it breaks down in there, and if you got in there, that's a pretty good swing on a short option. You would have roasted a lot of the premium. So that's how I use it a lot. And I don't use this specific band setting. I have a slightly augmented one that kind of has a lot more relatively built into it and runs off of stochastic, but it's the same sort of idea. Thank you for watching the video on the triple Bollinger Band trading strategy. We hope you found the information helpful and insightful, and if you have any questions or feedback, please leave them in the comment section below. We'll be happy to get back to you as quickly as we can. And if you enjoyed the video and you want to see more like it, please consider liking and subscribing to our channel. By doing so, you'll stay updated on our latest trading strategies and tips, helping you become a more successful trader and investor. Remember, trading is a constant learning process, and we're here to help you every step of the way. So don't forget to hit the like button and subscribe to the channel. And I'll check you in the next video. You have a great night. Hello and welcome to this exciting video on trading strategy. In this video, we will discuss a powerful strategy that you can use to become a more informed trader and investor in the stock market. We will cover everything from the indicators and settings being used to implementing a solid entry and exit strategy. But before we dive in, I want to encourage you to watch this video until the end. You won't want to miss any of the crucial insights and tips we will be sharing, as this strategy uses free and widely available indicators so you can follow along while you do. And if you find this content valuable, please consider hitting the like button and subscribing to our channel to stay updated on our latest trading strategies. Also, we'd love to hear from you in the comments section. Let us know your thoughts, questions, or even your own experience with the strategy and backtesting. So, without further ado, let's get started taking your trading game to the next level.
Trading successfully using fractals. Fractals are repeating price patterns across time frames that come together to build similar structures on larger time frames. They are a powerful tool that traders can use to identify potential buying and selling opportunities in the stock market. Let's start by discussing some common indicators that can be useful for identifying fractal patterns. Moving averages are an excellent example of how fractals work by repeating patterns of divergence. By studying how these structures interact on smaller scales, traders can gain insight into what the eventual shape of the larger structure will be. Specifically, when the 5-period moving average crosses above the 10-period moving average, we can expect the 10-period moving average to eventually cross above the 100-period moving average, forming a fractal pattern. Fibonacci retracements also work in fractals by identifying time-analogous ratios. By measuring distance based on the previous so many bars, rather than the dollar price on the right of the chart, traders can identify potential support and resistance levels within a fractal pattern. This can help traders identify potential buying and selling levels. Now let's talk about some strategic ways to buy and sell using fractal patterns for profits. Trend trading using fractals involves expecting the pattern to continue. By identifying the trend, traders can enter a buy position when the price breaks above a previous high or a sell position when the price breaks below a previous low. Counter-trend trading a fractal pattern involves predicting when the trend will end inside the pattern. Traders can use Fibonacci retracements and other technical indicators to identify potential support and resistance levels and overbought and oversold levels to enter buy or sell positions accordingly. Range trading. A fractal pattern involves counter-trend trading, a fractal that's getting smaller and tighter, resulting in an overall range-bound pattern. It's essential to remember that successful trading using fractals requires a combination of technical analysis, risk management, and discipline. By applying principles from physics and mathematics, traders can identify and trade fractal patterns profitably. In conclusion, using fractals for trading can be a useful strategy for identifying potential buying and selling opportunities in the stock market. By understanding how fractals work and using common indicators such as moving averages and Fibonacci retracements, traders can develop effective trading strategies such as trend, counter-trend, and range-bound fractal strategies. With proper risk management and discipline, traders can use fractals to trade profitably in the stock market. Let's create an example fractal trading strategy based on the ideas and indicators mentioned above. Our strategy will be a trend-following strategy that uses the moving averages to identify fractal patterns. Specifically, we will use the 5-period moving average, MA, and the 10-period MA to identify potential buy and sell signals. First, we will look for an upward fractal pattern, which is when the 5-period MA crosses above the 10-period MA. When this happens, we will enter a long position, as we expect the 10-period MA to eventually cross above the 100-period MA, forming a larger fractal pattern. Next, we will look for a downward fractal pattern, which is when the 5-period MA crosses below the 10-period MA. When this happens, we will exit our long position and enter a short position, as we expect the 10-period MA to eventually cross below the 100-period MA, forming a larger fractal pattern. We will use a stop-loss order to limit our risk on each trade. Specifically, we will set our stop-loss order at the low of the previous bar for long positions and at the high of the previous bar for short positions. Now, let's speculate on why this strategy might be effective given current economic understandings of capital markets. The fractal pattern is a recurring pattern that occurs in many different systems, including the stock market. By identifying these patterns and using them to trade, we can take advantage of the natural rhythm of the market. Additionally, using moving averages as our indicator allows us to smooth out the noise in the market and identify potential trends. Finally, using a stop-loss order helps us limit our risk and protect our capital in case the market moves against us. Overall, this strategy combines the power of fractal patterns with technical analysis and risk management to create a potentially effective trading strategy in the stock market.
To wrap things up, we hope you found the information helpful and insightful. If you have any questions or feedback, please leave them in the comments section below. And if you enjoyed this video and want to see more like it, please consider liking and subscribing to the channel. By doing so, you'll stay updated on our latest trading strategies and tips, helping you become a more successful trader and investor. Remember, trading is a constant learning process, and we're here to help you every step of the way. So thanks again, and we'll see you in the next video. Hello and welcome to this exciting video on trading strategy. In this video, we will discuss a powerful strategy that you can use to become a more informed trader and investor in the stock market. We will cover everything from the indicators and settings being used to implementing a solid entry and exit strategy. But before we dive in, I want to encourage you to watch this video until the end. You won't want to miss any of the crucial insights and tips we will be sharing, as this strategy uses free and widely available indicators so you can follow along while you do. And if you find this content valuable, please consider hitting the like button and subscribing to our channel to stay updated on our latest trading strategies. Also, we'd love to hear from you in the comments section. Let us know your thoughts, questions, or even your own experience with the strategy and backtesting. So, without further ado, let's get started taking your trading game to the next level. So let's start with the thumbnail and talk a little bit about this picture and what it shows. This shows a trend as described using double money flow index indicators, an average directional indicator combo, and a moving average with a ribbon on it. So let's talk about the settings for these indicators. Your moving average ribbon doesn't really matter. It's just to give you a visual representation of trend on the bars. So this is set at the standard settings. One moving average at 20, one moving average at 50, one moving average at 100, and one moving average at 200 to create the ribbon. The second thing we're creating is the money flow index double combo. And this is done with a standard money flow index set at 14, and then a slower one set at twice the speed at 28. We've colored the fast one green and the slow one red. This shows you reciprocations in volume and price over time relative to itself in a way that gives you a trend inside of trend understanding. So we can say here, this trend began as these moving averages rolled over. But you can also see it began on the money flow index combo when it broke below the midline and stayed below it. That was the force, the money flow, that dragged these moving averages over. Furthermore, we have an average true range indicator at the bottom. We have the very, very fast one set to 1. This will give you a bar by bar representation of relative movement over time. Then we have an average on that average true range of 10 to let us know which bars are larger or smaller than the others in that trend. So we can use this setup to say things like the money flow has begun to go down. The moving averages are beginning to roll over. The ADX is beginning to move into a new range, or the average true range is beginning to move into a new range of movement. So as the money flow remains on average negative, it will continue to pull these moving averages down. And the larger bars in this trend, the spikes in the average true range, bar by bar, will represent the largest down moves in the pattern. So how do we make these lines, and what do they mean? Well, these lines were created all starting when it first broke below and held the midline on the 80, or when it first broke below and stayed down there on the money flow index combo, signifying money flow had turned negative. People were selling. So we can start drawing these lines. And I put a line every time it broke down below the bottom range and touched it again, created this line. And then we have another line down here where it does it again. They kind of sit on top of each other. This will represent the bottom trend line in the downward trend overall, where money flow is pushing price into new lows over this longer time period. Then we have extra lines where it comes back, breaks above the 50. So it breaks down and then back above, and it creates one line. And then it goes down and breaks back above. That creates another line. And it breaks down and back above. That creates a third line. And breaks down and back above, sorta. And that's where it's going to hold. So I put an extra line there. And here it comes and breaks. It holds the upper band of the money flow index and then goes to break the top, indicating buying, lots of it. And you can see on the average true range, the larger bars have switched to be the buying bars. And I'll color them in. You can see that somewhere across the bottom here, probably right there, it goes, the average true range goes from showing you that the red bars are the bigger bars on average. There's one too, there's another one. But up until this point, the very bottom pretty much, the larger bars in trend are the red ones. And that makes sense because for a trend to continue, on average, the red bars need to be bigger than the green bars. Generally, you can have some weird trends where like this is like super slow and that's a super crazy like bounce back in one bar and then super slow again, but that's not very often. And that would show basically as two small trends on the money flow index combo. So how would you use this for trading entries and exits? Well, it has to start from somewhere, so we have to go back a little bit of ways and say it was a period of buying, right? You had some reciprocation down here, like I just said, where it shows you two trends where it breaks the top and then breaks the bottom. It's just a split trend, like a little reciprocation, trading in a range. And then there's a lot of buying. So coming off that buying, once it breaks below, say you start watching it anytime in here and you're not already in a long, you're just going to wait for it to start to break below. And then you can start plotting your pattern and see how it turns out. You can either take that first entry when this red breaks below here and gives you that first push, or you could wait for it to come up, but it doesn't always do that. Sometimes this goes on for a while before it gives you a little bump. So this is going to be your kind of aggressive entry here, and that'll be your conservative entry if that makes sense to you. Depending on your risk tolerance, it'll be one or the other. If you wait for this, you might end up missing a chunk of the trade. If you go here, sometimes you'll end up getting hit with a harder stop. So where would you hit a stop if you're going to take this trade on, say, this aggressive entry? Well, the way I like to do it is the last high and then like double it, or 50%, because sometimes the market likes to swing up. Basically, I'm putting my stop where this would break out above the money flow index combo. Not when it breaks back into the midline, but when it breaks back above the top, like here or over here. So that's sort of, I was going to code this into a computer. I would have the computer put a moving stop at wherever this mathematically computes to as it follows it down. And then would stop out. That's why I put this line here. It would stop out here if you did that. But the better way to play this is to hold it kind of like a hot potato as trend continues. Hope you don't get stopped out. And then when it's in this lower band, or preferably down below the bottom down here, you're going to aim for one of these large red bars as indicated by the average true range indicator. This would be a good exit here. That's a good exit there. That's a green one. That's a red one. It'd be a good exit there. That's a good exit there. That's a good exit there. So you're just waiting for, because ideally if you're short, you want to sell into weakness, or you want to cover your short into weakness. You're I guess selling into weakness up here too, but you want to cover the trade into further weakness. I'm getting a little tongue-tied there. So let's look at some more of these. We talked a little bit about that one, so let's do a different one. You can go here. This is one. You see it stays above the band, so this is a trend. And you can see it stays more or less below the band here, so that was a trend. Let's look at, this is a pretty interesting one here. So let's start drawing this out. This happened overnight, so these are kind of small bars, but you can still kind of see how this works. So we had some kind of range trading where it's hitting the bottom, hitting the top, hitting the bottom, hitting the top, hitting the bottom, and then it's kind of staying below there. And it's worked this red one down here. You could have taken this long, but that would have stopped you out here, and you wouldn't really have lost much. It would be a small trade. And then you could take this, sell this weakness, this small weakness, hoping at the start of a trend. But you're seeing the moving averages are starting to come down some more, right? Starting to pull down. That's one. Then the upswing isn't that strong, so hopefully the downswing is stronger. You can see you got some reciprocation, and then it kind of comes up to this and holds it. That's just kind of how you can use the visualization, or you can just trade them all if you're going to use a robot, but that gets very time intensive really fast, so most people tend to pick and choose, right? So let's talk a little bit about this. It comes down, breaks the bottom, so you can start drawing your lines. It's the first one. It comes up a line there, and it's going to go down, stay below it, stay below it, stay below it, come up, and then do we have it the end of this pattern? There it goes, touch the top over there. So this one actually lasts quite a long time, but didn't go very far after the initial. You know what? We can wrap it up on this one. That's close enough. If you got super technical, it's probably right on the line. We'll call that a new high over time, because it breaks this high by a little bit. So then let's start doing the middle lines here. So it's gonna come down here, touch, break back up, go down, break back up, start there. Back up, down, and break back. And you can start here. It's going to go down, back up. Where's the last one here? Was it here? It's going to go down, touch the bottom, back up to midline, and then it finishes. So there's your trend, and that's how I drew the pattern. And there's it repeated on another downward trend. We'll do a long after this. But you can see, like, you'd enter here on this weakness, or you could get the conservative entry when it comes back up here. And then you're going to wait for some big red bars as trend continues. This is the first push here, that's one, then makes another one, that's two, and then it kind of has a flat one, that's three, and then ends. And this is just how you would draw that sort of reciprocation and momentum using the moving average, or not moving average. This is just how you would draw that reciprocation and momentum using the money flow index combination strategy. And again, you could take a short like here. You go to this high, that's $4, so we go to like $6, give it some room just in case it wants to test it a little. and you're going to go down. See, that's a big red bar. You could take that one if you're really greedy, but ideally you wait for like this full wave to finish and then you go do another one. Most of them get 2, so that would be 1, 2, and then 3. They can continue. They can continue as long as they want, really, till they come back up to finish. But you're most likely gonna get 1 and then 2 at least. Sometimes you just get the 1 and it stops you out, but that's then you're going long because it would be back up above here and indicating a trend the other way. And sometimes it can just flip you back and forth. So in a ranging market, it might just be best to not do this. So we come down here. If you want to be kind of the person who does a trailing stop, the way you can also do it, you can have your computer compute where this midline is, and then it comes back up here for the conservative entry and breaks back down, and then you can have it do a trailing stop on this midline, and then it would take you out when this crosses here, whatever the price is at that point. But down here, I mean, even if you took the second big spike here, not the first, but you took the first big spike, that's not a bad trade either, but the first, second, or third big spike are all really nice exits. And then it kind of dwaddles around. So if you really held on to it for dear life and you had it all the way to like that spike or like this spike way down here, like you did a little bit better, but how much better, right? This is a pretty cool long. So let's look at this. So you can see, let's see, it's kind of waffling around. Well, I guess it's kind of a downtrend, these two. Like I said, a lot of times they get 2, but sometimes they don't. This one got 2 up top. I actually got 3. 1, 2, 3 on top. Then I had 1, 2. I mean, this skin's kind of chunky, 2 or 3, depending how you want to cut it. Sometimes it's a little iffy when the range isn't that wide, right? But then it breaks back up here, and it's going to hold this a little bit. So you have your aggressive entry here, or your conservative entry there. And you can see the average true range is starting to spike up, right at the open too, to indicate there's a lot of buying, because these are, the green bars are big. I mean, the red bars are big too, but it's going up. Trend is going up. Everything looks like it's going up here, and it's going to stay above the midline for the most part. Like it looks like it brings the red line down to it for a little bit, but it doesn't really draw that shorter term or the longer term one. It doesn't really draw the longer term one, beneath it. So this trend's kind of continuing. Let's see. So you got continue to draw it out. We have a line where it breaks the top, and then a line where it breaks back the bottom. And then we can go and breaks up and it breaks back down. So that's the first cycle. So we can start a line here. We can go for it to break, call that the same one. Break up and then break down here. Let's call that one line. And start here. And go on, break down, break back up. And then we're going to break down again right up here. So that's line 2. And then we got down, up, and down again up here. So it's line 3. This one gets kind of compressed at the top, and then in this trend, you just hold it around for the first one, wait for the second one or the third one if you have the stones for it, and you get one of these big spikes here. These green bars here is a good exit in the second wave. Maybe even this one here. If you see some of these red ones here and you want to get out of it, it's actually not a bad exit overall, because it kind of, after it hits here, it kind of flattens out. But either way, you get several decent exits up here. Even this one's even better, this big spike way up here, but that was way far into the third wave. So you got, you got 1, you got 2, you got 3, 4 for this trend. That's a long trade. So, see, so you're going to take the aggressive one, the aggressive buy. Where would you put your stop? Well, you're going to go for the low down here, just 4, and then you're going to give it a little bit, so like 6 or 7. So I'd put my stop like over there. What's that, 48? Probably go down just a hair for around 48, just a little bit below 50. And let's say you held it to this spike here. It's going to give you about 3 to 1 risk to reward ratio for a good solid trade. And see, you got even some more big spikes if you wanted to keep on going. One there, another one there. But ideally, if you are long, you want to sell into strength, which can be identified using the money flow index around the top, along with the average directional or the average true range spiking when graphed at 1 bar at a time. To wrap things up, we hope you found the information helpful and insightful. If you have any questions or feedback, please leave them in the comments section below. And if you enjoyed this video and want to see more like it, please consider liking and subscribing to the channel. By doing so, you'll stay updated on our latest trading strategies and tips, helping you become a more successful trader and investor. Remember, trading is a constant learning process, and we're here to help you every step of the way. So thanks again, and we'll see you in the next video.